Okay, let's now move to the area of security valuation, which covers multiple aspects. I think this is one of the biggest chapters of the lot, has a very lot of items to be discussed on. Broadly, the chapter is broken down into equity valuation and non-equity valuation. So the first heading is, there's an error here, it is equity valuation and non-equity valuation. So first we do equity, then we do bond valuation, then we do money market instrument. A combination of equity is called convertible instrument, and some miscellaneous areas are there as part of the chapter. In equity valuation, I have a lot of models of valuation starting from Walter, Gordon, step up growth, H model, P multiple, earning growth, and FCFE. Apart from this, there can be something else added on also. I'll directly get into models of valuation. One simple rule of valuation is present value of future cash flow. Anything you value, you want to value an equity share, present value of future dividends and price, future dividends and price. You want to value a bond, present value of future interest and principal payment, future interest and principal redemption. Anything which you want to value, it's present value. I want to value this building, present value of future rental and property price, future rental and property price. So in that, the first thing is Walter's model. Now what Walter said is, an organization can do two things with the dividend. It can either retain the dividend, or that is earnings. It can do two things with the earning, either retain the earnings or pay it as dividend. If you pay, the value for that is D by KE. Value for that is D by KE. Whatever dividend is paid, I am dividing by the cost of equity. Why we divide by cost of equity is to give a flavor of a perpetuity, because dividend does not have any end. Dividend does not have any end. Plus, on top of that, there's another component of valuation. Which is called R by KE. What is R by KE? Is comparing the return on equity with the cost of equity. Whatever money you are retaining, on that company earns return on equity. So whatever profits you are generating, E minus D, on that company earns return on equity. So technically this is dividend by cost of equity. The second segment is when you create a fixed deposit, you get interest income. You can do two things with it. You can withdraw it, or you can keep it in the FD. What you withdraw is called D by KE. What you keep it in the FD, you earn interest on interest. So on whatever money I retain, I first earn something. That is divided by cost of equity, and then that is further divided by cost of equity. Why it's further divided by cost of equity? It's interest on interest. So to convert interest on interest, first I have to bring it to interest. So understand the logic. Logic is dividend by cost of equity is the first part, which is like interest by KE. The second part is whatever you are retaining, on that you are earning interest on interest. So first I divide by cost of equity to bring it to interest. Again I divide by cost of equity to bring it to the normal value. So D by KE plus R by KE into E minus D divided by KE. What concept says is, if you are earning more than cost of equity, then everything should be in this part of the formula. That is, you should retain everything. If you are earning less than cost of equity, then you should pay out entire amount as dividend. D by KE plus R by KE into E minus D divided by KE. The logic is very simple. If you are earning more than what shareholders want, please keep the money with yourself. If you are earning less than what a shareholder want, give the money fully to shareholder. If you are earning equal, indifferent, you want to keep money, keep it. You want to give it to the shareholder, give it to the shareholder. So there are two parts to the calculation. One is D by KE plus R by KE into E minus D divided by KE. In this, whatever you calculate, P naught is called fair market price. D is called dividend per share, which can be calculated as total dividend divided by number of share. Or you can do EPS into payout ratio, or you can do dividend rate into face value, or you can do dividend yield into market price, or you can do dividend yield into market price. R is return on equity, other name is internal rate of return, other name is rate of return on retained earnings, other name is return on investments. Few question will use return on investment, few question will use the word return on retained earnings, few question will use the word return on equity, few question will use the word does all the four remain same? No, it doesn't remain same. It's just that in your exam question they give different words. Assume one question give all the four, it is only return on equity. They will not give all the four, but some question they'll use the word IRR, some question they'll use the word. What is ROE? Is the rate of return earned by the company. What is KE? Is the cost of equity paid by the company, or rate of return earned by the investor. Rate of return earned by the investor. So if some question says an investor is earning 20%, that is KE. An investor is earning 20% is cost of equity. Return earned by the investor is cost of equity. Return earned by the company is return on equity. Return expected by an equity shareholder is cost of equity. Return paid by a company to an equity shareholder, cost of equity. What does a shareholder get is called KE. What does a company pay is called KE. What does an investor want is also called KE. Then what is ROE? ROE is the rate of return earned only by the company. Earned by the company. Some question will say rate of return earned by the investor. I will take it as only as KE. I will not be taking that as ROE. I will be taking that as cost of equity. Cost of equity is otherwise called as investors required rate of return, opportunity cost of capital, rate of capitalization, cost of capital, equity capitalization rate, different name. I'll not be doing a problem on Walter's model. There are three problems in your metal on Walter. We'll do this MCQ. We are kind of done. Let's do MCQ together. EPS equal to 10, payout 25%, cost of equity 10%, return on equity 5%. What is the price of share as per Walter's model? Price of share as per Walter's model. You will do it along with me. Please start doing it. Write the formula. P naught is equal to D by KE R by KE into E minus D. This is one chapter which again with MCQ you can complete fully. Capital budgeting as a chapter with MCQ fully is not possible because there are a lot of complex questions there. This chapter, if I complete only the concept book also, it is sufficient. Only the concept book also it's sufficient. For practice you can do more question also, but only that itself is sufficient. What is the dividend in this example? Dividend is 25% of EPS. 25% of EPS 2.5. What is the cost of equity? Please write it as 0.1. Cost of equity, don't write it in percentage. Sometimes you will make a mistake. Decimal alone you write. What is the return on equity? 0.05. Cost of equity 0.10. E minus D. What is the earnings? 10. Dividend divided by 0.10. First part of the formula is 25. First part of the formula is 25. Second part of the formula, do. How much second part? 37.5. Put together is 62.5. Put together is 62.5. That's the value of the share as per Walter's model. Value of the share as per Walter's model. What is the return on equity in this example? 5%. Cost of equity? 10%. So company is earning lesser. Company is earning lesser. They should declare 100% dividend. They should declare 100% dividend. If they had declared 100% dividend, value would have been 10 by 0.10, 100 rupees. Second part will not be there. When you declare 100% dividend, retained is 0. Retained is 0. So if you follow the optimum rule, value will go up. If you follow the optimum rule, value will go up. What is optimum rule? Comparing R and KE. Comparing R and KE. If you earn more than equity investor, if you are earning more than equity investor, please keep every money with you. If you are earning lesser, give them the money. If you are earning equal, indifferent. Any doubts on this? Very simple. There are 2-3 questions in your study material on Walter's model. In fact, there's a 3 into 3 9 type of a question which is there. You can see all of them. Not very critical from an exam point of view, but good to know it. Next is Gordon's model. Gordon's model is nothing but perpetuity valuation, which we have used in many places. where P naught is equal to D1 by KE minus G, or you can say D0 plus or into 1 plus growth rate, or you can say EPS 1 next year, EPS into 1 minus the retention, into 1 minus the retention. One headache with Gordon's model is knowing whether it is a D0 or D1. The problem will not be very clear. The problem will not be very clear. We will be making assumptions at few places. We'll be making assumptions at few places when I do not have clarity whether it is a D0 or D1. So P naught is fair market price, D1 is dividend of next year. This is one important assumption, as the question would not be clear whether it is a nearby dividend or distant dividend. D0 does not mean current year dividend, D1 does not mean next year dividend. D0 means dividend which is going to be immediately paid. D1 is something which is going to take longer time, to be paid. Example, 2024 dividend in the month of January is D1 because it will be paid only by August or September. Maybe if you read July, it may become D0. It may become D0. So D0 or D1 is practically on the basis of when is the dividend likely to be paid. When is the dividend likely to be paid? In problems, you have this headache. Some question will clearly say dividend already paid, dividend to be paid. So if some clarity is there, D0, D1, no problem. If clarity is not there, assumption will be needed. Majority of the ICA solution will take the given dividend as D1. Majority of the ICA solution will be taking the given dividend where clarity is not there. I'm talking about where clarity. There are also majority. Majority means few questions they may take it as D0 also. So we will give two answers in exam. Our primary answer is taking the given dividend as D1. Alternate answer is taking the given dividend as D0 and adding growth. Taking the given dividend as D0 and adding growth. K is cost of equity, which is same as per Walter's model, different names I said. G is growth rate. There is a formula. There's another approach I'll discuss in some time. Formula is ROE into retention. We have used that at few places. Let's start this. Long-term growth rate is 8%. Company is expected to pay a dividend of 4 per share next year. 4 per share next year. In MCQ, you will not have this confusion. In MCQ, you will not have this confusion. Let's do cost of equity. P naught is equal to D1 by KE minus G. What's the D1? 4 KE. Growth rate. 100 is the fair price of the share as per Gordon's model. 100 is the fair price of the share as per Gordon's model. Computation of price of different years. We'll apply some questions on Gordon's formula later on. I'll be doing some question on Gordon's formula later. Computation of price of different year. Now, what is this concept is? I invested in a company. I calculated the price for today. I want to know first year price. I want to know second year price. Or I want to know third year price. Or I want to know fourth year price. Fourth year, third year price can be calculated using Gordon's formula if you want, which is P2 is equal to D3 by KE minus G, or P3 is equal to D4 by KE minus G. But certain limitations will come as we proceed because growth will change, cost of equity will change. So how do we give effect in those situations? Price is very simple. Today, price is 100. Tomorrow, I want the price to go up by 12%. What is 12%? Is my return. I want a return of 12%. So this has to go up by 12%. So I want 112. Company is saying, wait, we will not make it 112. We'll give you dividend of 2 rupees. We'll give you dividend of 2 rupees. Then I have no problem. If you give me dividend of 2 rupees, price can be 110. Price can be 110. I want 100 to become 112. You are saying you'll give me 2 rupees dividend and price of 110, I'm okay with it. Next year, 110 should go up by 12%. How much? 110 should go up by 12%. In that, again, you are paying some dividend. Dividend you give, balance should be price. Dividend you should give, balance should be price. My logic is very simple. Give me 12%. Give me 12%. So P1 is equal to P naught into 1 plus KE minus D1. P1 is equal to P naught into 1 plus KE minus D. I don't remember the formula. Logic is very simple. Today prices, let's take an example. Price at end of year 3 is 300. Cost of equity is 20%. Company will pay dividend of 10 in year 1, 30 in year 2, 16 year 3, what is the price today? Reverse order. This is reverse order. I have been given price of year 3. I have been given price of year 3. Let's do price of year 3 is equal to price of year 3 is equal to price of year 2, price of year 2 into 1 plus KE, 1 plus KE minus dividend of year 3. Price of year 3 is equal to price of year 2 into 1 plus KE minus dividend of year 3, minus dividend of year 3. Logic is simple. Whatever was the second year price should go up by my cost of equity, should go up by my cost of equity. I can deduct the dividend. 300 equal to P2. What is the KE in this example? What is the dividend of year 3? 60. Do the calculation. Tell me P2. What is P2? You will get same 300. You will get same 300. Then I have to do year 1. Then I have to do year 0. I'll keep doing the calculation. Now, what is the logic we are saying is today the price is 300. I want what return? Which is 60 rupees, which you are giving us dividend. I don't want any extra. I don't want any extra. I wanted only 20%. You are giving me 60 rupees dividend. I am very happy. You are giving me 60 rupees dividend in year 3. I am very happy. That is what I wanted. Next, price of year 2 is equal to price of year 2 is equal to price of year 1, price of year 1 into 1 plus KE minus dividend of year 2, minus dividend of year 2. This is technically, if you remember, it's Modigliani-Miller formula. This is a Modigliani-Miller formula which you would have done at CA Inter. So 300 is equal to P1 into 1 plus 0.2. What's the dividend of second year? 30. Tell me the price of year 1. 270. What is 275 into 20%? I want 55. You are saying only 30 rupees dividend. You are saying only 30 rupees dividend. Where is the balance 25? Increase in price. Where is the balance 25 is increase in price. My expectation is very clear. Give me 20%. Give me 20%. Whether you want to give dividend or you want to give increase in price, I am least bothered. Next, price of year 1 is equal to price of year 1 is equal to price of year 0 into 1 plus KE minus dividend of year 1. The MCQs are going to be excellent in this chapter. Once you do MCQ, the entire chapter is kind of taken care of. That is how the MCQs here are excellent. Capital budgeting, I don't have that much comfort. So good examples are there, but not full comfort is there. 275 is equal to P0 into 1 plus 0.2. What's the dividend in the first year? 10. What is the price of year 0? 237. It is easy to work forward. Working backward sometimes can be a challenge. That is why I did this question on backward working. What is 237.5 into 20%? Into 20%. 47.5. 10 rupees dividend. 37.5 is the increase in price. 37.5 is the increase in price. Any doubts on this? Now, this is not only for equity valuation. This is also there for bond valuation. When you do apply for bond valuation, P1 is equal to P0 into 1 plus KD minus I1. 1 plus KD, cost of debt, minus I1. What is I1? Interest of year 1. Minus I1, interest of year 1. It's not only for debt, it is also there for this property. Price of year 1 of this property is equal to price of year 0 into 1 plus the cost of equity I want minus the rental income of year 1. Minus the rental income of year 1. So somebody wants to forecast the price of this property next year. Today's price, add 10% which you want, minus the rental income. Minus the rental income. So this formula is not only for equity share or bond, it can be used for anything. It can be used for anything. Any doubts on this? Holding period return, you know this. Holding period return is nothing but D1 plus P1 minus P0 divided by P0 into 100. Ex dividend price and cum dividend price, very important concept. Okay, what is ex dividend price and cum dividend price? Is when you buy a share, there is a point at which when you buy, you get it along with the dividend, and there's a point at which you get only the share, not the dividend. Only the share, not the dividend. Cum dividend price means share can be purchased inclusive of dividend. Ex-dividend price means share can be purchased without dividend. Without dividend. As we learnt in mutual fund, cum dividend price minus the dividend is equal to ex-dividend price. Cum dividend price, that is share price, is theoretically, mutual fund is 100%, but here it is theoretically expected to fall by the amount of dividend. Expected to fall by the amount of dividend once the share becomes ex-dividend. Once the share becomes ex-dividend. There it is not, there it is 100%. Here it is theoretical. Here it is practically 90% time it happens. Sometimes it does not happen also, because in market buying, selling keep happening. So because of that, certain changes can be there. Now, any model of valuation you do, it can only accommodate ex-dividend price. It can only accommodate ex-dividend price. It cannot accommodate cum dividend price. It cannot accommodate cum dividend. Any model of valuation we take, it can accommodate only ex-dividend price. Then why am I learning cum dividend price? Because in practical world, the price is only cum dividend price. Practical world, the price is cum dividend price. At some day, it will become ex-dividend. At some day, it will become ex-dividend. So assume you did a calculation, you calculated the fair market price, and now you want to compare FMP with AMP. Both cannot be compared, because fair market price is ex-dividend price, which you calculated. Actual market price is cum dividend. So if you want to do comparison, either convert the apple into orange or orange into apple. You will have to ensure that both are apples or both are orange for doing the comparison. So any model of valuation can only give you ex-dividend price. Assuming last question, you calculated here 100. This is ex-dividend price. If dividend is going to be paid now, add the amount of dividend until cum dividend price. Add the amount of dividend until cum dividend price, because market only has the cum dividend price. Market only has the cum dividend price. Example, the cum dividend price is 11. The cum dividend price is 11, including a dividend of 1. Growth rate is 5%. What is the cost of equity? What is the cost of equity? Now write K is equal to D1 by P naught plus growth rate. K is equal to D1 by P naught plus growth rate. That's the formula for your cost of equity. This is the same formula of Gordon only. This is the same formula of Gordon only. What is the D1 here? 1 is what? Cum dividend means it is going to be paid in 2-3 days now. It is going to be paid in a very limited period. So this is D0 only. This is D0. What is D1? 1 point. What is the price? Price cannot be 11. Price cannot be. Any model of valuation can only take ex-dividend price. This is nothing but, if you see, P naught is equal to D1 by KE minus G. KE minus G goes the other side. D1 by P naught and G goes the other side. It is not a new formula. This is Gordon's formula. This is Gordon's formula. So Gordon has said I can use only the ex-dividend price. I can use only the, so denominator is 10, growth is 0.05. 15.5%. 15.5%. Unfortunately, this got tested as part of a bigger question, and students started with a wrong K. Students started with a wrong cost of equity, because they had given the cum dividend price. They had given the cum dividend price, whereas I need the ex-dividend price. I need the ex-dividend price. Clear? Any doubts on this? This can also be used the other way around. You calculate the fair market price and you want to compare with actual market price. Fair market price with actual market price. How to compute growth rate? Guys, please. The two ways of computing growth rate. One is called ROE into retention ratio, or IRR. IRR, ROE, rate of return on retained earnings. You can use different names. How you calculate ROE? EAES by amount of equity, or EPS by book value of equity. Example, IRR of company 20%. IRR of company 20%. This is IRR or ROE. IRR or what is investors required rate of return mean? That is the cost of equity. Can you tell me what is the retention ratio here? Dividend to EPS 5. Retention. 60%. So 20 into 60%. 20 into 60% is the growth rate. 20 into, you can use IRR, you can use ROE. Are the two same always? No, they are not two same always, but question will not give both. They'll only give one of them. They'll only give, sometimes they'll use the word IRR, sometimes they'll use the word return on equity, sometimes they'll use the word rate of return on retained earnings, sometimes they'll use company's return. Different names can be used. Second approach is going by the past data. Going by the past data. What do you do by going by the past data? You look at the historical data of the company. You look at the historical data of the company and calculate the past dividend and say the same will be reflective of the future. Same will be reflective of the future. Growth is futuristic, but I'll take the past data. I take the past data. Example, dividend of 1996 is 2.115. Dividend of 2002 is 3. Whenever you give me two data points, the previous time is called present value, the later time is called future value. For example, 2024 with 2020 comparison. 2024, we are in 2024, and you compare with 2020. Cash flow of 2020 is present value. Cash flow of 2024 is future value. Cash flow of 2020 is present value. The earlier period is called present, the later period is called future. So this is present value, this is future value, present value. So what we can do, present value is equal to future value into present value factor. Present value factor are divided by 1 plus r power n. Using this, somewhere you will get the growth rate. Using the PVF, you will get the growth rate. In this example, 2.115 is equal to 3 into PVF. Can you tell me the PVF? 2.115 divided by 3. 0.705. The gap between 96 and 2002 is 6 years. So PVF of 0.705 is 6 years and 6%. 6 years and 6%. So 6% is the growth rate. 6% is the growth rate. This is based on historical data. Based on historical data. Any doubts on this? Clear? Next is growth rate. There are two types of growth rate you can calculate. One based on earnings per share. Second based on dividend per share. What is based on earnings per share and dividend per share is, I look at historical data. I'm talking about historical data. EPS growth rate and DPS growth rate should ideally be same. Why same? Because this is EPS. This is DPS. DPS is a subset of EPS. Dividend per share is a, if EPS is expanding, DPS will expand. If EPS is contracting, DPS will contract. But sometimes EPS may have gone up, but dividend may have gone down in a company. Our dividend may have gone up, EPS may have gone down. These are temporary feature. These are temporary feature. Over the long run, earnings growth rate and dividend growth rate has to be same. Over the long run, earnings growth rate and the dividend growth rate has to be same. So what they say is, if you are calculating growth rate based on past data, I'm talking about based on past data, then you should give weightage to EPS and not DPS. You should give weightage to earnings per share and not dividend per share. You should give weightage to earnings per share and not dividend per share. Because if earnings was growing, automatically dividends would have grown. Can there be a difference in the two growth rate? Historically, yes, because company may tinker with payout ratio. Company may tinker with payout ratio, but otherwise it has to remain same. Certain time value of money concept, I'm not discussing it, but good to go through for them. That is, how do you calculate future value? How do you calculate present value? What is future value of annuity? What is present value of annuity? What is future value of a perpetuity? Or sorry, present value of perpetuity? All this is good to know. I'm not discussing this time value of money with certain examples so that you are clear on your time value of money part. You're clear on your time value of money part. There's a link between EPS, BVPS and ROE. If you remember, we saw in one question where MPS, I told to split as EPS into P multiple, decomposing. And EPS was split into ROE into book value per share. ROE into book value per share. So my ROE is equal to EPS divided by book value per share. Do this example and tell me the ROE. Do this example. DPS is 4, payout is 25%, which means EPS is 16. EPS is 16, so 16 divided by 100. 16 divided by 100. How to compute return on equity? We have already seen this in the earlier chapter. I'm not going to take you through this example. But return on equity is equal to EAES by book value of equity or EPS by book value per share. Anyway, do this. Okay, do this example. Calculate the return on equity. Net worth, the share capital plus reserves minus fictitious asset. All this I've explained earlier. Please do this. EAES by book value of equity or EPS by book value per share. How much is the EAES? 10 lakh minus 50%, which is 5 lakh, minus preference dividend of 1 lakh, minus preference dividend of 1 lakh, which is 4 lakh. What is the ROE number you get? So what is the book value? Sorry, net worth. What is the net worth? Share capital plus reserves minus fictitious asset. 5 lakh 50,000 into 10 plus 45 lakh, which is 50 minus fictitious asset 10 lakh. So you get number as 40 lakh. You get the number as 40 lakh. So 4 lakh by 40 lakh is 10%. 4 lakh by 40 lakh is 10%. I cannot directly get into problem solving. I have to discuss at least 15-20 concepts and then only I can go. That is why I'm discussing the concepts first. I left with no choice. It is not like portfolio where I can do one-to-one mapping and then keep doing it. How do you calculate cost of equity? First simple formula is D1 by P naught plus growth rate. D1 by P naught plus growth rate. Give me the answer to this. Is D0 this 4 rupees D0 or D1? No confusion there. Okay. In MCQs, confusion will not be there. 4 divided by 100 plus 8%. When company is planning some new issue and incurs flotation cost, if you remember at CA inter level, KE would have been D1 by P naught minus F. You would have done minus F. That is called flotation cost. P naught minus F, which is technically called flotation cost. Why we do minus F is because you gave me 100 but I did not get 100. I did not get 100. I got only 95. I got only 95. So I have to subtract flotation cost in the denominator. Many question it will not be there. Many question it will not be there. Let's see this. The earnings available to equity share, given that it's a company and that the flotation cost will only new equity. Why should it affect the old? Market price will anyway get reflected. Whatever you are incurring, in the end, there is no separate. See, equity you do not have two category called as category 1 and category 2. If the second guy got impacted, automatically the price will reflect it in the market. There's nothing like a separate cost of equity. You do not have two types of cost of equity. Can you please do this? Okay, same 12%. I'll come to 13th concept in some time. The 14th concept is RF plus beta into RM minus RF. That's a normal formula we use. These are, so if you have cost of equity, simple approach. If you are paying dividend, K D1 by P naught plus growth rate. If you're not paying dividend, RF plus beta into RM minus RF. In this, there can be multiple growth rates. That is, growth rate will not be a single growth rate. You can be growing higher or lower. What happens is what we'll see. Appropriate dividend payout ratio I've already discussed. R is greater than KE 0%. R equal to, sorry, the answer is wrong here. This is 100%. This is 0%. R greater than KE 100%. Give me a minute. Sorry. R is greater than K is 0%. R is equal to K indifferent. R less than K is 100%. Can you do this example and tell me the answer? First, tell me what is the return on equity here? What is the return on equity? Total earnings divided by value of equity. K is equal to 1 by P multiple whenever you pay 100%. Whenever you pay 100% dividend, K is equal to 1 by P multiple. The logic for the formula is P multiple is equal to MPS by EPS. Opposite of this is EPS by MPS. If you are paying 100%, if you are paying 100%, earnings per share and dividend per share is same. That is the KE formula. K is DPS by MPS. K is equal to D1 by P naught, no growth because you are paying 100%. You are paying 100%. So what is the cost of equity you said? Cost of equity can be taken as inverse of P multiple, can be taken as inverse of P multiple. What is why we are taking as inverse of P multiple is very simple, because if you're paying 100%, P multiple is MPS by EPS. Inverse is EPS by MPS, where EPS is equal to dividend per share, MPS is equal to P naught. If you pay 100%, retention is 0, growth is 0. Growth is 0. So technically, inverse of P multiple is D1 by P naught. Technically, the formula is D1 by P naught. Any doubts on this? 16, I'll do it later. Just remind me these two alone, okay? 16 and one more I'm yet to do. Step up growth. I'll just discuss this and then we start doing questions. What is step up growth model is, you said you want to value the perpetuity. You said you want to value the perpetuity. Formula is P naught is equal to D1 by K minus G. I give you three different answers for growth rate. Growth rate can be 20, growth rate can be 10, growth rate can be 5. Growth rate can be 20, 10, 5. 20% for few years, 10% for few years, 5% for few years, or 5% for infinity. For infinity. My Gordon's formula can never be applied till I get single answer for growth rate, because when I ask you what is K minus D, you are giving me multiple answer. Practically K can also change. K can also change. What is K changes? People are now wanting more returns, or people are wanting lesser return. So dividend can change, K can change. Dividend can change and K can change. So how do I give effect to this? If both can change, very simple. You have to wait till growth stabilizes. You have to wait till growth stabilizes, and then you can say P8 is equal to D9 by K minus D. P8 is equal to D9 divided by Ke minus G. P8 is equal to D9 divided by Ke minus G. Once you get that price and the earlier dividend. So the approach says step 1, you calculate dividends till the first year of stabilization. If you remember, when I did FCFF and FCFE, I used to calculate cash flows till the year of stabilization, till the year of first year of stabilization. Get that, discount the earlier dividends, and using the last year cash flow, do perpetuity valuation and get the price. Do perpetuity valuation and get the price. Okay. The concept is maintenance of dividend income. With an MCQ, we will discuss it. Problem, if you want, you do it at home. Even if you don't do it also, it's technically fine. What happened is, a company was doing really well. It was continuously paying dividend. As a shareholder, I was very happy with the company because they are declaring dividend. I was getting it. Suddenly, somebody told company that we have an excellent project. We have an excellent project. You do that project. You do that project. So he got into doing that project, because of which they stopped paying dividend. Because of which they stopped paying dividend for few years, and they'll resume again. They'll resume again. But as a shareholder, when I invested in this company, I wanted that money. I wanted that money every year. I wanted that money every year. Why I wanted? Maybe for my retirement purpose, something. So if company is not paying dividend and you still want that receipt, you have to do partial sale of share. You have to do partial sale of share. So in the example which is there in the ICI material, okay, the same example, dividend per share is rupees 2. Investor owns 500 shares of the company. He wants to continue the same amount of dividend income every year. That is 2 into 500,000 rupees I want. 2 into 500,000 rupees I want. Dividends will not be paid for the next 3 years. Dividends will not be paid for the next 3 years. Dividend of year 4 will be 2.5. Dividend of year 4 will be 2.5. Growth rate is 7%. Cost of equity is 8%. How many shares are to be sold in year 2 to get the minimum amount? How many shares are to be sold in year 2 to get the minimum amount? I want 1000 rupees. I want 1000 rupees. Now, can you value the share? Which year can you value the share in this? P3, not fourth year, P3 you can do. P3 is equal to D4 by KE minus G. Can you tell me the answer? P3 is equal to D4 by KE minus G. 250. Using that Modigliani-Miller, I said P naught is equal to P1 is equal to P naught into 1 plus KE minus D1. P2 is equal to, from P3 you can get to P2, from P2 you can get to P1, from P1 you can get to P0. Can you get to P2 using the Modigliani-Miller formula? The formula is P3 is equal to P2 into 1 plus KE minus dividend of third year. Minus dividend of third year. Apply the formula and tell me the price of second year. Apply the formula and tell me the price of second year. P3 you told me 250. 231 point. There is a lot of interlinkages of the concept. This area concept clarity has to be 100%. That is why I discussed some 15-16 concept before starting the problem. I in fact would have discussed all the concept, but it will become too much heavy for you. That's why I've discussed major chunk of the concept. Any doubts on 231? How much money you want? 1000 divided by 231 is how much? 4 point. Has to be rounded off to the highest number. Has to be rounded off to the higher. Reason is, if you sell 4 share, you will get only 920 rupees. You will get only 920 rupees. So if you round off 4.3 to 4, you will not get the money you want. You will not get the money you want. You will have to round off only to the higher number. You will have to round off only to the higher number. So this uses that concept of Modigliani-Miller which we did, and along with maintenance of dividend income. Along with maintenance of dividend income. Okay, this concept I've already discussed now. Undervalued versus overvalued security. What is undervalued versus overvalued securities? You will calculate the value. Whatever you calculate is called fair value. What market gives is the current market price. If market gives higher value, it is overvalued. And if market gives lower value, it is undervalued. Can you give me answer to this example? ABC has a P multiple of 28. Industry has a P multiple of 38. Assuming EPS is 1 rupee. My company is getting a value of 28. Industry is saying right value is 38. So I'm undervalued or overvalued? Undervalued. I should go ahead and buy. Okay. Components of required return. This is more for your understanding, nothing to do with problem solving. Okay. Whenever we calculate KE, we say KE is the required return. Or assume I say give me a loan. Give me a loan. I ask what is the interest rate you want to charge. How will you calculate? That is sum of 3 items. First is inflation. First is inflation. Why first is inflation? Because minimum I want is inflation. Minimum I want is inflation. Along with inflation, we add something called as real return, a real discount rate. Along with inflation, we add real rate of return on risk-free investment. Real rate of return on risk-free investment. For example, today government bonds are at 7%. Inflation is at 5%. So if you invest in government bond without taking any risk, you don't earn 7%. You earn only 2%. You earn only 2% because inflation eats away 5%. Inflation eats away 5% of your return. Inflation eats away 5%. So first component is inflation. Second component is real rate of return on risk-free investment. And the third component is the extra add-on called risk premium. The third component is extra add-on called risk premium, which can change based on company to company. Now, why are we learning this? Because there's something called as an inflation premium. There's something called as an inflation premium. What is inflation premium is? Any increase in inflation. What does RBI do when inflation increases? RBI increases interest rate. Any increase in inflation will increase my risk-free rate. Will increase my risk-free rate. Any increase in so inflation will increase my risk-free rate, which may or may not increase my market return. Which may or may not increase my market return. Why is this happening? Inflation went up. So RBI increased the interest rate. Now I want more. See, logic is simple. 5 is the inflation. Government is at 7, market is at 12. This 5 went up to 6. This has gone up to 8. I would expect that this also goes up to 13. Why I expect? Because at least the gap is 5%. The gap remains 5% for the risk I am taking. But this may or may not happen. This may or may not happen, because when interest rates go up, practically most of the time market return goes down. Market return goes down. So in short, if a question says there is an increase in inflation premium, it will increase your risk-free rate. That will increase your risk-free rate. That question may say it will also increase your market return. It may also increase your market return, or market return may remain same, or market return may go down also. Market return may go down. If risk-free rate and market rate both are going up by the same rate, the gap risk premium remains same. The gap which is risk premium remain same. If in market this continues to be 12, this becomes 7, this becomes 9, this becomes 8, this becomes 10, and this continues to be 12, what people will do is they'll stop investing in stock market. They'll stop investing in stock market. See, without taking any risk, FD gives me 10. Why should I take risk and earn 12? Without taking any risk, FD gives me 7. By taking risk, you get 12. Okay, 5% extra makes sense. Without taking risk, FD gives 10. Market gives 15 or 16. Then I'm okay. Then I'm okay. So any increase in one inflation premium will increase the risk-free rate, which may or may not increase the market return. What is the impact of this? See this here. Risk-free rate of a security is 9%. Return from a market is 13%. Beta of security is 1.3 times. Growth rate of a security is 8%. What is the required return of a security if inflation premium increase by 3%? Increase in inflation premium will increase RF from 9 to 12. Apply RF plus beta into RM minus RF formula. 9 will become 12. 9 will become 12. Apply RF plus beta into RM minus RF. 13.3. Practically, one thing which can happen is RM can also go up, but theoretically RM will not increase. Theoretically, RM will not increase. Any doubts on this? Clear?
We should not add 2%. Put 1 plus.
Not 1 plus. What can happen is, you are right, 2 percentages cannot be added. It can here become 9%. 3% of 9% is 0.27. 3% of 9% is 0.27. In calculator, do 9 plus 3%, what do you get?
8.27.
It can become 9.27. That I can debate on. This is a pure play increase. That is, RBI will say interest rate increase by 0.25%. You cannot say that I want to do 1 plus and all. You will say 6 became 6.25. 6 became 6.25. So this is an interest rate where you can debate. 9 plus 3% can become 9.27. I did one problem in sensitivity analysis. 6 plus 2.5%. I told you to take 6.15%. I did not tell you to take 6% plus 2.5% as 8.5%. That is something you can debate on, which is what you will see in the solution. Now, some exam question will talk about something called as a fall in growth rate. Something like a fall in growth rate. What is fall in growth rate? It is linear fall in growth rate. Now, example, you will grow at 10% for the first 4 years. Then from 10, you will become 4%. You will reach 4% over a period of next 7 years, 8 years, 10 years, something they'll give in the question. So every year there will be a constant fall in growth rate. Every year there will be a constant fall in growth rate. Like we had 15 and 6. First year 15, second year 15, third year 15, fourth year 15, fifth year 14, then 13, then 12, then 11, then 10, then 9. It could be a constant gradual fall, which could be two types of questions will be there. One question they will tell in how many years the fall will happen. If they mention in how many years it will happen, you can calculate what is the annual fall in growth rate. What is the annual fall in growth rate? How will you calculate? The higher growth minus the lower growth divided by the number of years of fall. You will see a problem on that. Or they may not mention the number of years, then every year 1% fall. Every year 1% fall. Example, dividends will grow at 20% for 4 years. Growth will have a linear fall, stabilize at 14%. Which year they have not mentioned? Stabilize at 14%, which year they have not mentioned. So 20 will become 19 in the fifth year. 19 will become 18 in the sixth year. 18 will become 17 in the seventh, then 16, then 15, then 14 and stabilize. Then 14 and stabilize. Dividends will grow 20% for 4 years and will have a linear fall and stabilize at 14% in which year? Year 7. So 20 will become 14 in another 3 years, from 4th year till 7th year, from 4 years till 7 years. So in 3 years, you will have a 6% fall. In 3 years, you will have a 6% fall, which means every year 2% growth will fall. Every year 2%. So 20 will become 18, 18 will become 16, 16 will become 14, 16 will become 14. So there are two types of question. One, there is going to be a number of years which is mentioned. Ideally, ICI should mention the number of years. In one exam question, they missed. So if number of years is not mentioned, 1% fall every year. 1% fall every year. We will have to still wait till the stability happens. If stability happens in 15th year, you have to calculate dividends till 15 years. If it happens in 10th year, dividends till 10 year. Like there can be a fall in growth rate, there can also be an increase in payout ratio. There can also be an increase in payout ratio. And this is what I have been telling. Whenever there is a change in growth rate with change in payout ratio, you need to first calculate earnings per share, and based on earnings per share, you have to calculate dividend per share. Based on earnings per share, you have to calculate dividend per share. This example and all, if you go through, it will give you good. Okay, there's one more model in your material called as H model. ICI has just added one question in your practical workbook on this. The formula is not that logical, so you may have to remember the formula, but I'll explain the formula first. I'll explain the formula. H model could have been used for the previous question I did. Could have been used for the previous question I did. I need two numbers first. Tell me what is the high growth rate? High growth. Previous question. 40. Not long-term growth rate, that is the stabilized growth. So in this question, they are 12 and 5. They are 12 and 5. What H model says is, you will have to apply your Gordon's model. What is Gordon's model? D1 by KE minus G. But D1 is equal to last year dividend plus the stabilized growth now itself. Plus the stabilized growth now itself. What is the stabilized growth? 5%. So formula is 25 plus 5% divided by KE. What is the KE given in the question? 8% minus 5%. Now the company is saying that, why are you doing this? I will grow at 12% and all. You are saying at 5% only you will give the value, which is wrong. Which is wrong, because you take the last year dividend, add only 5%, whereas I'm going to grow at 12%. I'm going to grow at 12%, but you are saying, no, I don't get into all that. I'll give you only 5%. I'll give you only 5%. And divide by KE minus 5%. 12% is not there itself. 12% is, assuming this question, if I don't say 12%, what will you do? D1 by KE minus G. 25 plus 5% divided by 8 minus 5%. Then they are saying, okay, I agree that you will grow at a higher rate. So we will give you some extra price. We'll give you some extra price. What is the extra price we are going to give? Again, the base dividend. Again, the base dividend. This extra growth is going to come for how many years? 5 years. I'll give the benefit of half of that. I'll give the benefit of half of that. Logic for half is to see 40 becoming 10, which is an extra growth of 30%, which is an extra growth of 30%, but it's not extra every time. 6th year extra is only 24. 7th year extra is only 18. Then extra is only 12. Then extra is only 6. Finally, extra is only 0. They're saying on an average, I'll give you benefit for half of the time period. On an average, I'll give you benefit for half of the time period. No major logic they have built in. Half of the time period, I'll give the logic. I'll give the benefit. So plus 25, which is your last year dividend, half of the transition period, into extra growth. What is extra growth? Is 0.12 minus 0.05. Denominator remains same. Denominator remains same. In case question specifically tells you follow H model. Question specifically tells you follow H model, then you'll have to do this. Otherwise, H model is of no use. H model is of no use. Specific requirement. The same question, no, you can do under step up growth model. How will you do under step up growth model? dividends of first year, second year, third year, fourth year, and fifth year. Then dividend of sixth year, P5 is equal to D6 by KE minus G, and then complete the calculation. So same problem I can do under step up growth model. Problem specifically tells H model. I'll repeat the formula. Formula is D0 into 1 plus the normal growth rate divided by KE minus the normal growth rate plus D0 into half of the transition period into the extra growth divided by the same denominator. So your normal value is 875 and I'll pay you extra 145. Any doubts on this? Clear? Okay. Your material also has two other approaches. One is called P multiple approach and an earnings growth model. P multiple and earnings growth model. What is P multiple approaches? EPS into P multiple. There's nothing much to be done here. But P multiple, if not given in the question, P multiple, if not given in the question, will be taken as 1 by return on equity. 1 by, for this approach alone, 1 by return on equity. I'll give the logic for the formula. ROE, what is the formula? EPS by book value per share. Inverse. Book value per share by EPS. Assumption is this and market price is same. Assumption is this and market price is same. Again, I'm repeating, this is only for the purpose of P multiple approach. If question specifically tells and they give ROE and they don't mention P multiple. What is logical formula for P multiple? They have to give only. Second is earnings growth model, which is same. Just that instead of doing D1 by KE minus G, we will do E1. We will do E1 divided by KE minus G. It's not a new approach. Earnings growth is not a very good model because earnings growth considers everything. If you consider everything, growth cannot be there. Let's quickly look at a question. There's nothing much to be done. Given the following information, current dividend 5, discount rate 10%, growth rate. Moment I see growth rate, only Gordon comes to my mind. Calculate the present value of the stock. Very simple. P naught is equal to D1 by KE minus G. Answer is 63.75. Second part. There is no relationship between the first part and the second part. ICI tested this in your recent mock test paper also. Is the stock overvalued if the price is 40? EPS is 3 rupees. EPS 3 rupees. How much is the dividend? In the original part, 5, which is where I got really irritated seeing the question. EPS is 3 rupees. How can dividend be 5 rupees? EPS is 3 rupees. How can the dividend be 5 rupees? And this has repeated in your mock test paper also. Same numbers. They've done the same thing only. EPS is lesser than your dividend per share. Show your calculation under P multiple approach. Let's do P multiple is equal to EPS into PE. What is PE is 1 by ROE. P is 1 by ROE. 1 by return on equity. Only for this approach. This is, maybe you can say this question to be more of an illogical one, but I cannot do anything. In my concept book, I've clearly covered that this is what you will do. So once you read that, you will automatically be able to do it in exam. What is the EPS given in the question? 3. 1 by 8% is how much? So under P multiple approach, price is 37.5, market is giving 40, overvalued. Next comes earnings growth model. P naught is equal to E1 by KE minus G. E1 by KE minus G. Earnings is 3 rupees plus 2%. What is 2%? Is the original growth rate. I'll follow the original growth rate. Wherever data is not there, we will take the original data. Is there a cost of equity in the second part of the question? Take the original one. 10 minus 2%. You've taken 8. Okay, alternatively, you can take 10%. So they mentioned alternative answer. Let's go ahead with that. Let's not worry much about it. Clear? Any doubts on this? Can we proceed? Okay. Next question. I want you to just make one change. This is 5 rupees. This is 2 rupees. Attempt part 1. I'll do part 2. 5 and 2. There's a reason for doing this. I'll explain later. 5 and 2. Do part one of the question. I'll take you through part two. EPS is 5 rupees, dividend is 2 rupees. Tell me the answer under Gordon's model. 17. 17 divided by 5 is the P multiple. 17 divided by 5 is the P multiple. How much? 3.4. This is called actual P multiple. This is called actual P multiple. Now, what can happen in market is market may give a higher P multiple. Market may give a higher P multiple. What is the P multiple market is giving? 7 times. Why is market giving a higher P multiple? Because market believes you may grow at a higher rate. Market believes you may grow at a higher rate. So listen, using the actual dividend, I calculated the fair price and fair P multiple. I calculated the fair price and fair P multiple. Whereas market is saying no, 3.4 is wrong. We believe the P multiple is how much? 7 times. What could be the reason for that? The reason is the growth rate. The reason is the growth rate. They're saying what is the long-term growth rate implied by your P multiple? Implied by your P multiple. Now, right, computation of long-term growth rate. P naught is equal to D1 by Ke minus G, D1 by Ke minus G. You said 3.4 times. Company is saying no, 3.4 is wrong. We want a P multiple of how much in the market? 7. So P naught is 5 into 7. 5 into 7. Why is this 5 into 7? Because of higher growth rate. Because of higher growth rate. As I have told you, if you grow at a higher rate, market starts giving better multiples. What was the last year dividend? 2. What is the next year dividend? 2 point. How will it be 2.04? That's why I'm trying to calculate. I'm trying to calculate the growth rate. So it is 2 into 1 plus g. Don't write 2 plus g. That's why I change the number from 1. If you do 1 plus g or 1 into 1 plus g, both are same. If you do 1 into 1 plus g or if you do 1 plus g, both are technically same. 2 into 1 plus growth rate. 2 into 1 plus growth rate divided by point. What is the cost of equity? Minus g. Solve and get the g. 35 into 0.14 minus g is equal to 2 plus 2g. Get the answer to growth rate. Give me 4 decimal answer and then do into 100. Solve this and get the growth rate. It can't be negative. What happened? Why so many different answers people are getting? 35 into 0.14 is 4.9 minus 35g, 2 plus 2g, g is equal to 2.9 by 37. G is equal to 2.9 by 37. So that is the growth market is expecting. Market is believing company will not grow 2%. Market is saying company will grow at some 7-8%. That is the market's belief. That's the market's belief. This is called implied growth based on the current valuation. Implied growth based on the current valuation. Market is giving a higher value. Market is giving a higher value. Any doubts on this? Clear? Can you proceed? Any doubts? Go through 26. Okay, Mr. A is thinking of buying shares of 500 each, having a face value of 100. He's expecting a bonus at the ratio of 1:5 during the fourth year. Annual dividend will be 20%. Same will apply on the expanded capital. What is expanded is you will have a higher capital base because once the bonus is declared. He intends to sell the share at the end of seventh year at a price of 900. Incidental expense for purchase and sale. He expects a minimum return of 12%. What is this minimum return of 12% called? Okay, my discount rate. Here you need not do any valuation. They have given what will be the first year dividend, what will be the second year dividend, what will be the third year dividend, fourth year dividend, fifth year dividend, sixth year dividend, seventh year dividend, and also the price at the end of seventh year. Also the price at the end of seventh year. Everything is given to you. Everything is given to you. Our job is just to do discounting and then find what is the value. Now, one caution which is needed is whenever an organization declares a bonus issue, whenever an organization declares a bonus issue, we'll have to be little cautious in calculating the final selling price. Let us assume I purchased 5 shares. I purchased 5 shares. Bonus is in what ratio in this question? 1:5. So my 5 would have become 6. My 5 would have become 6. So when I buy, my initial outflow is for 5 shares, but my terminal flow is for 6 share. My terminal flow is for 6 share. Assuming you bought 1 share, you need to write terminal cash flow for 1.2 share. You need to write terminal cash flow for 1.2 share, which few students ended up missing in exam because your 1 share will become 1.2 by the maturity. 1.2 by the maturity. Second thing, there is some incidental expense on purchase and sale. What I did is I did discounting of cash flow of this building. And I found that the present value of this building is 1 crore. 1 crore. So I can pay 1 crore. I can pay 1 crore. You are the seller. I was to pay you 1 crore. Suddenly a broker comes in between. He says you have to pay me 3%. You have to pay me 3%. If I have to pay the broker 3%, I will not pay you 1 crore. I'll pay you lesser. Because my mind is very clear. All put together, I want to pay only 1 crore. All put together, I want to pay 1 crore. It is not 1 crore minus 3%. It is not 1 crore minus 3% because at few places you have to do minus 3%. Few places you will have to do divided by 1 plus 3%. Divided by 1 plus 3%. 1 crore minus 3% is 97 lakh. If I pay 3% brokerage on 97, it will be 2.91. Put together, it's only 99.91. Put together, it's only 99.91. Whereas I want to pay 1 crore. I want to pay 1 crore or 100 lakh. So how to do the calculation, you'll understand when I do it. But two effect you need to take care. One effect is on the terminal value, you will have to consider the bonus issue. You'll have to consider the bonus issue impact, and also you'll have to consider the transaction cost impact when you calculate the purchase price. Let's do working note 1. Computation of fair value of share. Computation of fair value of share. Year, cash flow, PVF. PVF at what rate? And DCF. Assuming you purchased 1 share only, okay? Assuming you purchased 1 share. What is the first year dividend? 20% on 100. Second year? Third year? When is the bonus happening? So in the fourth year, I will start getting dividend on 1.2 shares. I'll start getting dividend on 1.2 share. Only option is it can be fourth year. It can also be from fifth year. It can also be because we did one question in mutual fund where we had a bonus issue and dividend happening together. Here my assumption is dividend happened later. Bonus issue happened earlier in the fourth year. Bonus issue happened earlier in the fourth year. So year 4, 1.2 share. What is 1.2 is 1 share with extra 1 by 5. With extra 1 by 5. 1.2 into 20. Year 5, year 6, year 7. Year 7 you will sell. You will sell 1.2 share. How much money you will get? Read carefully and let me know. How much money you will get by selling 1.2 share? Read carefully. Read further. Minus 1.2 into 900 minus 5% selling cost minus incidental expense. Brokerage needs to be paid. You need to pay brokerage of 5%. You need to pay brokerage of 5%. So into 95%. I'll come to it. I'm yet to come to the initial price. Let's first close this. You need not worry about this discounting aspect. You just need to write now onwards. Just focus on writing year and cash flow. PVF, DCF, you will not write. Please don't get into writing PVF, DCF. Doesn't serve any purpose. My total is 563.68. I can afford to pay 563.68. What is the price in the market? But you cannot compare. 500 is without brokerage. 563 is with brokerage. There is some confusion because there is a problem of brokerage also there. So listen, my max outflow can be 563.68. What is my max outflow? Price plus 5% of price. Price plus 5% of price. Price plus 5% of price, I can pay 563. Price plus another 5%, I can pay 563. Can you tell me what is the price I can pay then? 563 divided by 1.05. That is what I was saying. At few places we'll do minus 5%. Few places you'll do divided by 1 plus 5%. Divided by 1 plus 5%. What is the price you get? 5. You can afford to pay maximum price of 536.84. That can be compared with 500. That can be compared with, let's say, two ways of understanding it. One way of understanding is you can pay maximum 563. Today, what is the price? 500 plus 5%, 525. Either add 5% here or not, remove 5%, divide by 1 plus 5%, or divide by 1 plus 5%. Either add 5% to your market price or divide by 1 plus 5%. Divide by 1 plus 5%. So 500 can be compared with that 536 and 525 can be compared with 563. 525 can be compared with 563. Both the cases I can go ahead and buy the share. If you want to know maximum price I can pay a maximum price of 536, adding 5% on top of that. But the price I can pay is 536. Price I can pay is 536. Clear? Any doubts on this? This is the impact of transaction cost. Clear? Any doubts on this? Can you proceed?
Subtract 563 minus.
No, you can 563 minus, yeah, you can do.
Minus 525, we get the gain.
But what will you answer for the second part? Maximum price. Okay, next I'll explain the concept of a GDR and then we do a problem on this. What is GDR? Is Global Depository Receipt. In India, Infosys, TCS wanted to issue shares. Now they are in need of 1 lakh crore rupees. Huge capital they need. When they need such money, Indian investors alone cannot contribute that much money. So I wanted to some US investor, UK investor to contribute money for my business. When I asked them, they said we are okay with your company, we like your company, everything, but we don't invest in INR currency. We don't invest in INR currency. Can you issue shares to us in US dollar? Can you issue shares to us in US dollar? That is where a GDR comes. Infosys, if it issues the depository receipt, DR is called depository receipt. In USA, it is called American depository receipt. If it issues in any other country, it will be called global depository receipt. GDR and ADR is same. GDR and ADR is same. US Infosys is listed in India. Infosys is also listed in US stock exchange. It is also listed in US stock exchange. There it is called Infosys ADR. That is called Infosys ADR, American depository receipt. So what happens in a GDR is one GDR will be equivalent of so many shares. So if I want to issue, what I'll do is I will take 5 crore shares. I'll take 5 crore shares, give it to a custodian. What he will do is he'll convert this 5 crore shares. He will keep it with him and issue 1 crore depository receipt. The ratio is 5:1. It can be 2:1, 3:1, 5:1, 1:1. So he will issue depository receipt. Depository receipt will be issued in US currency, US dollar or UK pound, whichever currency it is. So the US investor will invest in it. If Indian share price goes up, ADR will go up. So what happens in a practical world is today morning trading will happen. Infosys will go up here. ADR evening will open there. ADR will go up. Suddenly some other news comes. ADR goes down. Next day morning our share will go down. So because there is a timing mismatch. So here trading will happen. It goes up. Evening when you go to the US stock exchange, that will also go up. If suddenly some extra news come after the trading happened, that will go up or go down. Indian market will go up or go down. This will keep happening. So because of this, a cost of GDR is equal to cost of equity. Company pays dividend. Dividend will go to the custodian. Custodian will distribute it to all the deposit recipients. He will distribute to all the. In equity, you get dividend on one share. In depository receipt, you will get dividend on 5 shares or 10 shares or 3 shares depending on the ratio. What is the formula for cost of GDR? Cost of GDR is equal to D1 by P naught minus F. There will be a flotation cost. Plus the growth rate. Let's see. Odessa Limited has proposed to expand its operation, for which it needs $15 million. Net of issue expense, which amount to 2% of the issue size. 2% is the flotation cost. It proposes to raise the funds through a GDR issue. The expected domestic price of the share is 300. 3 shares underlie each GDR. 1 GDR is equal to 3 share. Underlying shares are priced at 10% discount to market price. When I want to issue the GDR, I want to reduce the price and issue to make it lucrative. Expected exchange rate, compute the number of GDR, cost of GDR, some another loan is there, how much can the company save? Let's first calculate the cost of GDR and the number of GDR, and then automatically other things will get answered. Working note 1, issue price of GDR. Issue price of GDR. Current market price of share. How much? GDR to share ratio. 1 GDR is equal to clear fair value per GDR. If you go ahead and issue it at 300 rupees, fair value is 3 into 300. Rupees 900. It will not be in rupees, it will be in dollars. I'll convert in the end. Into 300 rupees 900. I don't want to issue at 900. I want to issue at what? No. USD is fine. Some discount I want to give. Discount. How much discount I want to give? 10%. So issue price of GDR is 900 minus 10%, rupees 810 or divide by 60 exchange rate. Divide by the exchange rate. Or how much US dollar? So I'm going to issue 1 GDR at 13.5. I'm going to issue 1 GDR at $13.5. In that, I will further incur some 2% expense, which is called flotation cost. Clear? Any doubts till this? Now, number of GDRs. Next, number of GDR. Money to be raised. Issue price. Number of GDR. Money to be raised. Issue price and number of GDR. Money to be raised is in dollar. Issue price is in dollar. Number of GDR. How much money you want to raise? 15 million is 1 crore 50 lakh, but that is after issue expense. So you have to raise more. You cannot raise 15 million. You have to raise more. Can you tell me how much should I raise? What is 300,000? 2%. Okay, 2% of the issue size. So 15 million, another 2%, which is 15.3 million. 15.3 million, which is wrong. That is where I need a lot of caution. I have told you few places. Just some time back I said I can do minus 5%. R divide by 1 plus 5%. Same logic, you can do plus 2% or divide by 1 minus 2%. 1 minus 2%, both have a different effect. What is the different effect is, listen. Gross, expense, net. Gross is 100, expense is 2, net is 98. This is 1 crore 50 lakh. This is 1 crore 50 lakh. If 98 is equal to 1 crore 50 lakh, what is 100? If 98, it will not be 1 crore 53. It is not going to be 1 crore 53. It is going to be a different number. It's going to be a different number. When can plus 2 would have worked? If this is 100, this is 2 and this is 102. This is 102. That is your 2% is on 100, not on the gross amount, it is on the net amount. This you will have to visualize. You will have to visualize. It is like profit margin on cost and profit margin on sales. Profit margin on cost and profit margin on sales. Now, to put it simply, let's assume I put 1 crore 50 lakh. Okay, I put 1 crore 50 lakh. If you put 1 crore 50 is also fine. The issue price is 13.5 minus 2% issue expense, minus 2% issue expense, which is your flotation cost, which is your, again I'm repeating, some places I'll say minus 2%, some places I'll say divided by 1 plus 2%, that you need to understand depending on the situation. So minus 2% if I do, or 1 crore 50 lakh, this is the gross amount to be raised. This is the gross amount. There you divide by 13.5. Gross amount divide by gross issue price, you get the number of GDR. Net amount divide by the net issue price, you get the number of GDR. Both will give you the same answer. 11,33,786. Gross amount by gross price, net amount by net price. What is gross amount? Not 150 plus 2%, not 150 plus. These are usual mistakes which students make. These are usual mistakes which are being made in exam. You will have to visualize the situation. Some places, again I'm repeating, some places I will say plus 2%. Like 500 plus 5%, I said 525. Some places I will say 500 divided by 1 minus 5%. So some places I'll say plus 5, some places I'll say divide by 1 minus 5, some places I'll say plus 2, some places I'll divide it by adding 2% and deducting 2% in the denominator will have almost similar effect, but not exact same effect. Not same effect. Adding 5% in the numerator or dividing by 1 plus 5% in the denominator will have different, adding 5 and 1 minus 5, sorry, 1 minus 5, almost similar effect, but not exactly the same effect. Not exactly the same effect. Any doubts on this? Any doubts on this? Now, cost of GDR. A is equal to D1 by P0 minus F plus growth rate. You can apply this in INR, you can apply this in USD, same answer you will get. I'll show you in USD now in the class. INR is there in the printed solution. One GDR has how many shares? 3 shares. What is the dividend to be paid? 20%. Is the face value given anywhere? I'm assuming face value to be 10. Face value is normally 10 rupees for a share. For a share, face value is normally 10. So I'm assuming it to be 10. Dividend is 6 rupees per share. 6 rupees per GDR, sorry, 6 rupees. 2 rupees per share. 2 into 3 is 6. Divide by 60. $0.1. $0.1. 6 divided by 60. 6 divided by 60. 6 divided by 60. $0.1. P0 is 13.5. Flotation cost is 2%. Flotation cost is 2% plus 20%. Plus 20%. Again, I'm repeating. I have done the calculation in dollars. I've done the calculation in dollars. You can do the calculation in dollars. You can do the calculation in INR. INR is there in the printed solution. I've done it in dollar. I'll repeat. 2 rupees per share. Why 2 rupees? 20% of 10. 20% of 10. 2 rupees per share. How many shares? Into 3. Into 3, which is 6. Which is 6. 6 divided by 60, which is 0.1. 6 divided by 60 is 0.1. 0.1 divided by 13.5 minus 2% plus this. What's the answer you get? 20.76. I am having a possibility of taking a loan at 12%, which I don't want to. Sorry, which I want to, because 12% is the loan, because GDR was at what? 20.76. So take a loan and save 8.76% for the company. Take a loan and save 8.76% for the company. You see, this answer is in INR. 6 divided by 810 minus 2% of 810. 6 divided by 810 minus 2% of 810. Be very cautious about this part, okay? 1 crore 53 lakh 6,122. Don't take it as 1 crore 50 plus 2%. Don't take it as 1 crore 50 plus 2%. Any doubts on this? 810 only. The actual price for us. For the GDR, it is 810 because you issued it at discount. For the GDR, this is for the GDR. Cost of for the investors. This is cost of GDR in this case will be more than cost of equity. Cost of GDR in this question will be more than cost of equity. Reason for that is GDR is a different product, equity is a different product, and to GDR what you did is you gave 10% discount in price. You gave 10% discount in price. That is going to benefit them. That is going to benefit them. To an equity guy, you may not benefit them. I'm not sure. I'm not getting into the equity part of the calculation. But both are equity shareholder. Both are equity shareholder. They will get dividend income. They will get the benefit of share price appreciation. Only thing which I'm not sure is whether they can get voting rights or not. But otherwise, it's exactly similar. It's exactly similar to because when I read about voting rights, there were different views. There were different views. But otherwise, GDR and equity is same. GDR and equity is same. Any doubts on this? Can we proceed? Okay, go through 28. 28 and do part 1. Do part 1. Go through 28 and do part 1 quickly. Tell me the answer to part 1 of the question. What is the firm's expected? The word expected is technically wrong there, but required return on equity. Required return on equity is cost of equity. Required return on equity is cost of equity. K is equal to D1 by P naught plus growth rate. D1 is 1 plus 12%, 1.12. Price today is 20. Growth is 12%. What is the K you get? 17.6. Now comes the second situation, which we have done many times, a step up growth model, where they are saying dividend will grow 20% for 5 years and thereafter it will grow at 10%. Thereafter it will grow at 10%. Now I have a challenge. The challenge is I don't know the cost of equity. I don't know the cost of equity. Formula for K is D1 by P naught plus growth rate, but growth can be 20, can also be 10, can be 20 or can also be 10%. So apply formula cannot be applied. Formula cannot be applied. So what we do is we have to assume some cost of equity, which when I calculate the price of the share, I should get 20 rupees. When I calculate the price of the share, you can assume any random cost of equity and do the valuation, which when you do the discounting should give you 20 rupees. What is the cost of equity you got in part 1? So let's assume 18% is the cost of equity. Let's assume 18% is the cost of equity. Will I get exact 20? May not. You may not. But what will happen? You will understand. What will happen? You will understand. This is calculating the cost of equity. Calculating the price is the easier part. Calculating the price is the easier part. Here the problem is I will do 18. I'll check whether I'm getting 20 rupees. If I get 20 rupees, problem is over. If I don't get 20, then I may try some other rate, whether I'm getting 20 there. If I don't get, then one number can be above 20, one number can be below 20, and then interpolation will be used. Then interpolation will be used to get that answer. Interpolation will be used to get that answer. Let's assume I do 18%. So here cash flow, PVF at 18%, DCF. First year, second year, third year, fourth year, fifth year, and again fifth year. Again fifth year. Fifth year is 6 to infinity. 6 to infinity. What is the dividend of last year? 1, 20%. Tell me 1.2, then, then 2 point. Then add 10%, divide by 18 minus 10. Add 10%, divide by 18 minus 10. 34 point. Now I'll discount. If I get 20 rupees, my problem is over. If I get 20 rupees, my problem is over. I'll repeat 1 plus 20% plus 20 plus 20 plus 20. Everything is there in the concept book. I'll discuss the concept in some time. Plus 20 plus 10%, that is P6. P5 is equal to D6 by KE minus G. P5 is equal to D6 by KE minus G. I do discounting at 18%. One divided by 1.18. You got almost 20 rupees, but it's 20.21. 20.21. I need one number above 20, one number below 20. I need one number above 20 and one number below 20 to use interpolation. To use interpolation, I need one number above 20 and one number below 20. At 18%, we have got 20.21. Now I'll try 19%. I'll try 19%. When I want to do 19%, I'll write the cash flow again. Reason for writing the cash flow again is P5 will become 19 minus 10. Will become 19 minus 10. Earlier we did 18 minus 10. Earlier we did 18 minus 10. So let's increase the discount rate. All this is fine. Tell me P5 alone. Tell me P5 alone. 2.49 plus 10% divided by 19 minus 10. 30 point. I do discounting at 19% now. I do discounting at 19%. I get 17.88. I get 17.88. Somewhere in between is going to be 20 rupees. Somewhere in between is going to be 20 rupees, which you will use interpolation. I'm not getting into interpolation. The same answer, you can also do it under using IRR approach. Using IRR approach, first you get one NPV, that is using a discount rate of 18%. I got NPV as 0.28. What is this NPV of 0.28? The difference between the price we calculated 20.21 and the price in the market. The gap is some rounding off can be there. And the second one you got is minus 2.06. What is minus 2.06? 20 and 17.88 difference. 20 and 1 positive, 1 negative, calculate the IRR. 1 positive and 1 negative, calculate the IRR. Once you get the IRR, you need one guess rate to start with. You need one guess rate to start with. You can get the IRR. You can get the IRR. So logic is simple. I'm putting 20 rupees today. I'm putting 20 rupees today. I discounted at 18%. I'm very happy. Because when I discounted at 18%, I'm generating positive NPV. I'm generating positive NPV, which means I'm generating a return more than 18%. Then I discounted at 19%. Unfortunately, I'm getting a negative NPV. One positive, one negative will give you the IRR. One positive and one negative will give you the IRR. Any doubts on this? 29 you can manage. 30 and all you can manage. Okay, there's a concept called PVGO. What is present value of growth opportunity? Concept is very simple. Market gives a very high value to a company which is going to grow. In the market. Market in fact chases for such companies which are likely to grow. Growth is something which is valued a lot in the marketplace. So a company has a EPS of 10, opportunity cost of capital for the equity shareholder is 16%. What does opportunity cost of capital mean? Assuming this company is not going to grow. Not grow means earnings is equal to dividend. Earnings is equal to dividend. Tell me the answer under Gordon's model. If zero growth is there, earnings is equal to dividend. What is the value of the share? If growth is not there, earnings equal to dividend. 62.5. What is the value market is giving? That extra 17.5 is present value of growth opportunity. That extra 17.5 is PVGO, present value of growth opportunity. Market says, I'm very happy you are going to grow. I'll give you a higher value. higher value. That extra is called PVGO, present value of growth opportunity. Present value of growth opportunity. Clear? Any doubts on this? Okay. Now there is something called as a subjective assessment of cost of equity. To do this, I'll go back to concept book. One thing which will become very critical for you in exam is ratio analysis understanding of ratio analysis, because somewhere in exams ratio analysis will get tested. Not only in this chapter, I did some question in your mergers and acquisition. I said let's use this ratio. Suddenly in some other chapter we'll use mergers ratios. So I'm going to quickly revise all ratios which we would have done at CA Inter, because it's going to be critical from an exam point of view. So this is our format of income statement. We start with sales, deduct COGS, we get gross profit. Deduct operating expenses, you get operating profit or EBIT. Deduct interest, you get EBT. Deduct tax, you get EAT. Deduct preference dividend, you get EAES. Number of equity share, EPS. Now in this first note is on interest. One exam, what they did is they gave something like this: 8% debenture 125, 10% bond 50. What student did? Interest is equal to 125 into 8%, 50 into 10%. 125 into 8%, 50 into 10%. That is what he wrote as interest expense, which is right. But there's one more data given in the question, which says effective interest rate is 8%, which means on your entire 175 you are paying only 8% on your, not, that's not post tax, effective interest rate. They have not mentioned cost of debt. How is it 8% on 175? Maybe some debt was issued at between the year. If you issue something at between the year, 125 into 8% into 9 by 12 or 6 by 12 or 3 by 12. So in case question has data on interest rate for different type of debt and also an effective interest rate. If both are given, overall interest is total debt into effective interest rate percentage. If it's not given, respective debt into respective interest rate. Can you do this question and tell me the profit after tax? Your understanding of ratios will be tested here. What are the total assets of the company? Total assets equal to total liability. Total asset is equal to total liability. Total liability is equal to 600. Total liability is equal to 600. Sales 600 divided by 1.1 or into 1.1? Divide into, I don't know, I'm just 1.1 into 600. Few places it will become divided by 1.1. That is, you need to look at the ratio wordings. Into 1.1, sales is 660. What is the operating profit? 10%. So EBIT is 66. If EBIT is 66, what is the interest here? 175 into 8%. You will get EBT, deduct tax, you get EAT 31.2. I'm not sure which. With this question, 34 is over. The same thing is discussed there. I'll discuss only the requirement. Draw income statement. Sustainable growth rate. Growth rate is ROE into retention ratio. How will you calculate ROE? EAES by amount of equity. Then they're saying what is the price using dividend discount model? P naught is equal to D1 by KE minus G. That MCQ takes care of it. Your you can just read this and understand it. That's more for, in fact, I made the MCQ more complex. Here they gave the total asset figure and all, so I made it more difficult, but you will have to be clear on this, because in one exam they will do the other way around. They'll end up doing, it's not necessary that they have to give you total asset. Most of the important ratios I'm going to discuss. Current ratio, self-explanatory. Current asset by current liability, higher the better, higher the better. Quick ratio, quick asset by current liability, again higher the better, higher the better. Quick asset is equal to current asset minus two items, stock and prepaid expenses. Then you have debt ratio, equity ratio, debt to equity ratio, all the three very critical. Debt ratio means debt divided by debt plus equity. Ignore preference for the time being, ignore preference for the time being. Equity ratio means equity divided by debt plus equity, and debt equity ratio means debt divided by equity. When we did WACC, if they give you debt ratio, debt is 0.4, equity is balance 0.6, equity is balance 0.6. If they give you equity ratio, equity is 0.8, debt is balance 0.2. But if they give you debt equity ratio, debt is 0.4, equity is 1, equity is 1, debt by equity. There's another ratio called capital gearing ratio, where preference is also added. Preference can get added anywhere here, okay? Practical preference is either part of debt or part of equity. That's all. There's no thing called as. But in capital gearing ratio, preference will always be added with debt. Preference will always be added with debt. That is a rule of capital gearing ratio. That is a rule of capital gearing ratio. Preference should always be added with debt. Proprietary ratios, proprietors funds divided by the total assets of the company. Proprietors funds divided by the total assets. Then have coverage ratio. So I'll tell you the formula. Logic is simple. Coverage ratio is what are you paying is the denominator, from where are you paying is the numerator. For example, interest is paid out of EBIT. Interest is paid out of EBIT. EBIT by interest is called interest coverage. Preference dividend is paid out of what in this table? Earnings after tax divided by preference dividend. Earnings after tax. Equity dividend will be paid out of what? EAS. EAS divided by equity dividend. My expense coverage ratio. My income divided by my expense. My income divided by my expense. That is my expense coverage ratio. Coverage ratio higher the better. Coverage ratio higher the better. Then you have asset turnover ratio, where the formula is sales by total asset. But it's not only sales by total asset. You can have a variant called fixed asset, current asset, working capital, capital turnover. So in this, the denominator will keep changing. In one place you will use fixed asset, in one place you will use current asset, in one place you will use working capital. And capital turnover ratio means you use capital employed. What is capital employed? Is debt plus equity plus preference, or fixed assets plus current assets minus current liability. Fixed assets plus current asset minus current liability. Few variant of the turnover ratios: debtors turnover ratio and creditors turnover ratio and inventory turnover ratio. One problem was there in M&A, where I had to use inventory turnover ratio. Suddenly you forgot what is inventory turnover ratio, you cannot do it. So debtors turnover ratio will use credit sales. Creditors turnover ratio will use credit purchases. And inventory turnover ratio will use COGS. That's the only difference. Otherwise everything is sales. Everything is, in fact, few question, you don't have data, use sales for debtors turnover ratio, full sales, not only the credit sale. You don't have for inventory turnover ratio, again use sales, again use sales. Whatever this ratios you calculated, you can convert them into days. For example, you calculated debtors turnover ratio. You want to calculate debtor days. What you can do is 365 divided by this ratio. 365, that is debtors turnover ratio 5 times, means 5 times you rotated the money. 5 times you rotated the money. Once in 73 days we have rotated. Once in 73 days. GP margin, self-explanatory. Gross profit by sales. Variant of that, net profit margin. Operating profit is EBIT. COGS is cost of goods sold. These three are very important ratio. Pre-tax ROI, post-tax ROI, and return on equity. ROI means what the firm gets. What the firm gets is EBIT. EBIT is basically applicable to debt guys, equity guys, as well as preference guy. Denominator is debt plus equity plus preference. ROI or ROC same. ROI or ROC same. It can be pre-tax, it can be post-tax. In pre-tax you write EBIT. In post-tax you write EBIT into 1 minus tax. Return on equity is known to you. Dividend yield, you know, DPS by MPS. Earning yield, EPS by MPS. Dividend rate, DPS on face value. Earnings per share, dividend payout. Now whatever we have understood, let's see whether we are able to apply in the ratio. Total debt is 600 lakh. Debt ratio is 0.4. Can you tell me what will be the equity? Think and tell me. Do calculation. total debt 600, debt ratio 0.4. What is equity? Logic is very simple. Debt ratio is 0.4. 0.4 equal to 600. Equity is 0.6. Equity is 0.6, which is balancing figure. Which is balancing figure. Same example. Debt equity ratio 0.4. Debt equity ratio 0.4. Tell me the equity. Debt equity ratio is 0.4. Sorry, 1000. Debt is 0.4 is equal to 600. 1 equal to question mark. 1 equal to question mark. Interest expenses 400. Interest expenses 400. Interest will go up by 20%. So 400 will become, EBIT will increase by 30%. EBIT will increase by 30%. What is the revised interest coverage? If existing interest coverage is what? 4 times. If today interest is 400, existing is 4 times, which means EBIT today is 1600 and you have 4 times. 400 has gone up to 480. 400 has gone up to 480. 1600 will go up to what? 2000? 2080 by 480. 4 point. This was a 5-mark exam question in one exam. This was a 5-mark exam question and student ended up struggling again because they forgot what is interest coverage. Not exactly this way. They had added certain numbers and all to do the detailed calculation. But broadly, this was the requirement. Broadly, this was the requirement. Dividend yield of industry is 2%. Earning yield of industry is 0.8%. EPS 4. Payout ratio 40%. What is the fair value under dividend yield and earning yield approach? Now I'll explain so many approaches. Now suddenly a new approach of valuation come. Dividend yield approach and earning yield approach. Very simple. If you are paying whatever dividend you are paying, that dividend is 2% of my price. The dividend is 2% of my price. And whatever earnings you are generating, that is 0.8% of price. 0.8% of price. Technically the numbers are wrong. Your earning yield will be more and dividend yield will be less. Earning yield has to be more and dividend yield will be less. The numbers have gone wrong. Let's not worry about it. What is the EPS I'm paying? 4 is equal to 0.8% of price. 4 is equal to 0.8% of price. Price is equal to how much? 500. What is the dividend we are paying? No, that is okay. That's industry. What are the dividend you are paying? How much is the dividend you are paying? No. 4 into 40 plus 1 rupee 60 paise. 1 rupee 60 paise. 1 rupee 60 paise is equal to 2% of the industry. 1 rupee 60 paise is equal to 2%. My price is 80. My price is 500 here. My price is 500 here. There is some error in the number. Let's not worry about that. Okay. This is a very simple question at CA Inter. Many students keep doing this at CA Inter in indifference point analysis. You would do this. Go through this and let me know what will be the EBIT of the next year. You think and let me know. What will be the EBIT of the next year? Think and let me know. Mostly you will get it wrong. Mostly you will get it wrong, but I want you to go through that experience. Mostly you will get it wrong, but I want you to go through that experience so that you appreciate the calculations. Okay. Others do it. What is that return given in the question? What is that return? Return is expected to increase by 2% means what return will increase? ROI or ROC is the only return which is possible here. ROI or ROC is the only return which is possible here. That's why when I gave the formula, I said this is a very important ratio. ROI is equal to EBIT by capital employed 200 by 2000, 10%. 10% will now become, and my capital from 2000 will become 2400. Either debt will increase or equity will increase. Either debt will increase or equity will increase. 2000 will become 2400 and my EBIT is now 2400 into 12%, which is 288, which is 288. Go through this and tell me what will be the PBT. Something which you should be able to tell. This came as an exam question for 12 marks, 10 to 12 marks, with multiple businesses being there. What is the PBT of next year? Very simple question. Please try doing it. I want you to do an income statement. Ratios are the best way of testing your knowledge on the financials. So please do this. Every MCQ you are doing is like one exam question. Most of it, okay? Most of it is created to consider your exam scenario only. Extremely important is ratios understanding. Not only for this area, it can get used in anywhere in AFM. What is the industry sales last year? Next year it will grow by, so industry will become 2000. What is my market share last year? That will go to 30. So it is 660. My GP margin is 40%. So 660 into 40% is my GP, which is 264. What is the COGS? No, COGS is not half. In between, 396. 660 minus 264, and other expenses half of this. Other expenses half of this, which is 198. Other expenses half of the COGS. Other expenses half of the COGS. Simple question. Exams have tested on all this. In fact, I have made the ratio more complicated, but exams have tested on all of this, because without understanding of ratios, you will start struggling. Get me the answer to the next one. I can keep adding any number of ratios here. How is it 20 lakh? What will inventory turnover ratio give you? COGS. It cannot give you sales. It will give you COGS. So COGS is 20 lakh. COGS is equal to 80% of sales. COGS is equal to 80% of sales. You start with 20 lakh, great. Entire problem is wrong after that. There's nothing to be even discussed, because sales you start wrong. What else will happen? You start with a wrong sales number, entire solution will go wrong in exam. Entire solution will go wrong. 25 lakh. Any doubts on this? Like this, you can keep doing any number of ratio. I've just given few MCQ examples, picked from few problems. If you're really interested, then you can go through your CA Inter material a little bit, or my MCQ material is there in CA Inter. Their ratio analysis chapter is there, just to understand the ratios. It is more for your understanding of the ratios. MCQs is the easiest way of testing your understanding. ICI has also added one more ratio called fixed interest and fixed dividend coverage ratio in one exam question. Technically, there is no ratio like this. Why no ratio? Because interest coverage is EBIT by interest. Dividend coverage is EAES, PAT by preference dividend. They said I'll combine them together. You cannot combine them together, because first from EBIT you have to subtract interest. Then from PAT only you can subtract preference dividend. But question said PAT should cover fixed interest and fixed dividend. PAT should cover fixed interest and fixed dividend. One important rule of coverage ratio is source of payment is in the numerator. What are you paying is in the denominator. What are we paying? Interest and preference dividend. When you do your profit after tax calculation, we normally subtract interest. So the formula said please add back interest. Please add back interest. Technically, still there are a lot of challenges, because PAT is after tax, interest is before tax, dividend is after tax. So technically I should not have such a formula, but exam had this question. So if at all they give this PAT plus the interest divided by fixed interest plus fixed dividend, fixed interest plus fixed dividend. Now why are we learning these ratios? The purpose of learning the ratio is to understand whether my company is a better company or a weaker company. If my company is a better company than my competitor, my cost of equity will be lesser. My cost of equity will be lesser, or my P multiple will be higher. My P multiple will be higher, which they tested in one exam. Required return of a security can be taken as required return of a proxy entity. However, this will increase or decrease based on the risk of a company under valuation. One easy way to adjust the risk is through ratio. Just to give an example, capital gearing ratio of industry is 0.75. My capital gearing ratio, can you calculate? I gave the formula for capital gearing ratio earlier. Calculate capital gearing ratio of mine. What is the formula for capital gearing ratio? Debt plus preference divided by equity plus reserves, divided by equity plus reserves. Capital gearing ratio is technically debt equity ratio. What is the capital gearing ratio you got? 2 times. Now 0.75 is better or 2 times is better? Gearing ratios lower the better. Only the debt ratio and capital gearing ratio lower the better. Most of the other ratio higher the better. Most of the other ratio higher the better. Something still can come lower the better. So I am having a weaker ratio. If you have a weaker ratio, you will have a higher cost of equity. You will have a higher cost of equity. How much is the difference in my ratio and them? 1.25. Question says if there is any deviation, you need to increase this by 2 basis point for 1 basis point deviation. 2 basis point for 1 basis point deviation. So I will increase my return on equity or cost of equity by 2.5%. By what is 2.5? 1.25 into 2 times. 1.25 into 2 times. Clear? Any doubts on this? Okay. The next method of valuation, FCFE model. I've discussed FCFE at various places. I'll quickly discuss the model. Listen, what FCFE says is free cash flow to equity shareholder. What is free cash flows? The earnings which you generate minus you need some money for meeting capital expenditure. You need some money for meeting working capital. Capital expenditure and working capital. Leftover money is free cash flow. Leftover money is free cash flow. In an ideal scenario, FCFE1 will be equal to D1. FCFE1 will be equal to D1. Why will it be equal? Because that is the free money available. Please pay us dividend. That is the free money available. Please pay us dividend. Don't keep the money with yourself. Give the money to your shareholder. Give the money to your shareholder because you don't need that money. You don't need that money. When you are not in need of money, please give it in the form of dividend. Please give it in the form of dividend. So ideal scenario, Gordon's model will give a lower answer. FCFE model will give a higher answer. Ideal scenario. Why? Because I have free cash flow 10 rupees. Company says we will pay dividend of only 7 rupees. Company says we'll pay a dividend of only 7 rupees because FCFE is the free money. FCFE is the free money. So in exam scenario, they asked a comparison between FCFE and dividend discount model. FCFE is a superior model. FCFE is a superior model. But in that question, unfortunately, dividend was more than FCFE, which is not possible. Which is not possible. What is FCFE? Is free money. If I have free money 1000, I can spend 1000 only. I can spend only 1000. If I have only 1000, how can I spend 5000? By borrowing, by extra borrowing. So that is what that question had ended up doing. So ideal scenario, Gordon's model will give lesser answer. FCFE model will give higher answer. Gordon's model is at the mercy of the board of directors. They may decide to declare dividend. They may decide not to declare dividend. FCFE is not at their mercy because if free money is available, I will consider it in valuation. At some point of time, FCFE model and Gordon's model has to give same answer because why will you keep having the free money with yourself? Why will you keep retaining the free money with yourself? In some rare scenario, dividend can be more than FCFE. How it can be? One, either you borrow money or you had past money. You had past money. Past last year you earned 10 rupees. You paid only 2 rupees. then you again earn 20 rupees. You paid only. When I'm saying earned is after everything. Okay, I'm not talking about EPS. I'm not talking about EPS, because FCFE means entire free money should be paid, which means you can still grow. You can still grow because free money is after capex, after working capital. Free money is after capex and after working capital. Let's see this in question. Mr. Amit is happy with the investment in a company as it paying good dividend for the last few years. Last year it paid a dividend of 2 per share. Share is currently trading at 150. He is of the view that if he applies dividend discount model, the share is undervalued. The share is undervalued. As a financial expert, examine his view. All this data, whenever they give data like capex per share, depreciation per share, change in working capital per share, they are indirectly telling you to follow FCFE model. They are indirectly telling you to follow FCFE model. I will do FCFE model. Give me the answer under Gordon's model. D1 by KE minus G. D1 by KE minus G. Get KE RF plus beta into RM minus RF. All that you do. D1 by KE minus G. D1 divided by KE minus G. Whatever is the answer. 2 plus 8% divided by, what's the cost of equity? 8.86 minus 8%. 8.86 minus 8%. You got to answer how much? Market is undervaluing it only at 150. Market is valuing this at only 150, but Gordon is not the right model. So we have been using extensively Gordon model. FCFE is also Gordon model only. FCFE is also Gordon model only. The formula is FCFE 1 by KE minus G. In an ideal scenario, FCFE 1 and D1 should match. FCFE 1 and D1 should match. Any doubts till this? Computation of FCFE. Computation of FCFE. EPS equal to what the profit made by the company. How many shares are there? No, that's not the number of shares. 1500 is the capital value. Number of shares is how much? 32.5. Give me a 4 decimal EPS. Right? 4 decimal EPS. 290 by 92. Now, out of this 8.9231, I need to meet my capital expenditure and working capital. I need to meet my capital expenditure and working capital. After that, if I have free money, I'll give to the shareholder. After that, if I have free money, I'll give to the shareholder. That is what the approach says. Approach says if you have any free money, after meeting all the expectation, please pay us dividend. Please pay us dividend. It's not that I'm increasing the dividend, decreasing the dividend and all. Whatever free money is available. Net capex and working capital per share. Depreciation adjusted for capex is net capex. What is the depreciation per share? Capex for 8 rupees. Okay. And working capital together is, now I have a problem. My earnings is only 8.9231. You are saying you need 11.45. That is where a combination of debt and equity comes into picture. A combination of debt and equity comes into picture because I do not have 11.45. There's a debt ratio given in the question. What does 27 mean is, listen, debt 27%, equity 73%, debt is 27%, equity is 73%. So of the 11.45, 27% will come in the form of debt, 73% will come in the form of equity. So in 8.9231, you need not give 11.45. You can give only 73% of 11.45. If anything is left over still, that is FCFE. If anything is left over. So next, equity funding. Equity funding for capex and working capital. Equity funding for capex and working capital 11.45 into 73%. Point. I have some money left over. FCFE 0. Why FCFE 0? Because year got over. FCFE 0 is equal to subtract 8.9231. Point. Ideally, last year company should have paid dividend of 0.5646. Last year company should have paid dividend of 0.5646. How did they pay 2 rupees? By using some past earnings. By using some past earnings. Now value of share is equal to FCFE1 by KE minus G. 0.5646. What's the growth rate? FCFE will also grow. Divide by 8.86 minus 8. Divide by 8.86 minus 8. 70 point. So that is the fair value of the share, and that is what ideally the value should be. Market is giving some 150, which is like overvalued in the scenario. Dividend discount model was giving some 200 something. That is also wrong. So question wanted some commentary on this. They are saying, as a financial expert, examine the view. You being an expert is required to evaluate the market value. So I'll answer 70 and then give a commentary saying that dividend discount model is not a good model. What is a good model is FCFE, which is what is presented here. In the dividend discount model, analyst considers the stream of expected dividend, which can be even less than the cash available with the firm. Company may voluntarily pay lesser dividend. Company may voluntarily pay lesser dividend, because of which market may start undervaluing the company. So that is why they finally say using the free cash flow provides a better measure of valuation in comparison to the dividend discount model. You can just go through the theory explanation, but basic thing is FCFE is a superior model to dividend discount model. Is it a different model of valuation? No, it is the same Gordon model. It is the same Gordon model. Then why did I get a different answer? Because you did not follow the FCFE approach in paying the dividend. In paying the dividend, ideal dividend is 0.5646. You should not pay more, you should not pay less. Paying more means some past profits were there, or past cash was available in the company. I used that and paid it. I used the past cash and paid it. Otherwise I cannot manage. Otherwise I cannot manage. Any doubts on this? FCFE approach will be used in an exam situation wherever you have data on capex, depreciation and change in working capital. Wherever data you have on this, you will have to use FCFE approach. Get me answer to this. What is the net capital expenditure? 10. Working capital increase is given, decrease can also be given. So 12. In this 12, debt will bring in 7.2. Debt will bring in 7.2. Equity has to bring in 4.8. 10 minus 4.8 is FCFE. 10 minus 4.8 is FCFE. Leftover money. Leftover money. Stock lending, also known as security lending, is a financial practice where one party, lender, temporarily lends their shares of a particular stock to another party. Lender, they lend their security to borrower in exchange for a fee. In exchange for a fee, often which is a percentage of value of the lent security. Borrower needs to pay this fees to the lender for the privilege of borrowing this security. Income for the person who is lending the stock. If I've lent this stock, I get lending fees. I'll continue to get dividend income. I'll continue to get dividend income. How do I continue to get dividend income? I am telling the other party that I've just lent it to the other person. I've just lent it to the other person. When dividends are paid, I should get my dividend income. I should get my dividend income. For a person who is borrowing the stock, he has to pay lending fees. He has to pay some bank guarantee charges, and he may be making a profit or loss on a short sale. He may be making a profit or loss on doing a short sale. Example, Mr. A is holding 1000 shares of face value of 100 each of ABC Limited. He wants to hold the shares for long term and have no intention to sell. On 1st January 2020, Messrs XYZ Limited did a short sell, of ABC Limited shares and approached Mr. A to lend his shares under stock lending scheme. So one company did a short sell. He's coming to me. I am Mr. A. He's coming to me and saying that, can you lend the share? Can you lend the share? I'm saying you have to pay me a lending fees. You have to pay me a lending fees, which is 30,000. Bank is saying that you give. I am also asking for a bank guarantee. I'm asking for a bank guarantee. So bank, you have to pay. In the interim, company is paying a dividend. In the interim, company is paying a dividend, and share price was at 1,000 and it has increased to what? 1,200. If you do short sell, you expect the price to go down. You expect the price to go down. If price goes up, there's a loss there also. There's a loss there also. So for a person who is lending the stock, he gets two things. One is 30,000 and 20 into 1,000. 20 into 1,000. So he is getting 50,000 rupees. He is getting 50,000 rupees. For the person who is borrowing the stock, unfortunately, 1,000 becoming 1,200 is a loss. 1,000 becoming, share price should go down. Share price going up is a loss. So 200 into 1,000 is my loss. On top of that, I have to pay lending fees. I have to pay bank guarantee charges. I'll have to pay bank guarantee charges. There is one more angle which can come. There's a dividend which the company declares. That's a dividend which the company declares. What the lender is saying is, I will get the dividend. I will get the dividend. So the borrower, what he did, he gave the share to someone else. No, he gave the share to someone else. That someone else could be asking, can you give the dividend? Can you give the dividend? But lender is saying, I will not give the dividend. I will not give the dividend. So borrower may be asked to compensate even the dividend also. Borrower may be asked to even compensate the dividend. That's an extra loss. That's an extra loss for the borrower. Exam solutions don't consider that, but borrower can be asked to compensate even for the dividend. So borrower can have four items. One is lending fees, second is the bank guarantee charges, third is the dividend to be paid. Whom is he paying the dividend? He is not paying the lender. He is paying the dividend to the person whom you lend the share. Because when company paid dividend, ABC is saying, I am the owner, you pay the dividend to my bank account. ABC says, I am the owner, you pay dividend to my bank account. Company paid dividend to my bank account. But that other guy is saying, why are you not giving me dividend? Why are you not giving me dividend? And there can be a short sell income or loss. Let's do this. First is Walter's model of valuation. Guys, please listen. Walter's model of valuation, D by KE plus R by KE into E minus D divided by KE. I'll not be doing again a revision of the entire security valuation. So I'm doing it now because security valuation is a huge. There are 100 concepts already there in this chapter. So D by KE plus R by KE into E minus D divided by KE, where D represents the dividend per share, which is EPS into the payout ratio. K represents the cost of equity, investors' required rate of return, opportunity cost of capital, return required by an equity shareholder, return earned by an equity shareholder, different name you can give. R represents to return earned by the company, ROE or IRR or rate of return on retained earnings. Then comes the Gordon's model, where D1 by KE minus G or D0 into 1 plus G divided by KE minus G or EPS 1 into 1 minus retention ratio divided by KE minus G. G is equal to IRR into retention ratio or ROE into retention ratio or based on past dividend. Based on past dividend. How do you calculate price of different years? P1 is equal to P0 plus the KE. It's technically in the calculator, it's not into 1 plus KE. You can just add the KE and subtract the dividend of that year. Subtract the dividend. When you do reverse calculation, be a little cautious. So P2 is equal to P1 into 1 plus KE minus D2. Holding period return is equal to D1 plus P1 minus P0 divided by P0 into 100. Ex dividend price and cum dividend price. Cum dividend price is share price inclusive of dividend. Ex dividend price is share price excluding the dividend. Whenever we are doing valuation, we can only get the ex dividend price. Whenever we are calculating cost of equity, we can only use the ex dividend price. So everywhere only ex dividend price can be used. If you have cum dividend price, please remove the dividend, make it ex dividend. You want to compare with the market price and decide on buying and selling. Your model will give you the ex dividend price. Model will give you the ex dividend price. Add the dividend to it, you'll get the cum dividend price, and then do comparison with the market. How do I compute growth rate? Formula I said ROE into retention ratio. R based on past data. Present value is equal to future value divided by 1 plus R the whole power n. R present value is equal to future value into present value factor. Future value is equal to present value. Present value is the earlier period. Future value is the later period. You can see there is an example to understand. Growth rate can be calculated based on EPS, based on DPS. Calculation based on EPS is more relevant as compared to calculation based on dividend per share. Time value of money concept. Future value is equal to present value into 1 plus R the whole power n. Present value is equal to future value divided by 1 plus R the whole power n. That is what you do divided by. So you can say future value is equal to present value into future value factor. Present value is equal to future value into present value factor. What is present value factor? Is 1 divided by 1 plus R the whole power n. If you have multiple cash flow, do year cash flow, PVF, DCF to get the present value, year cash flow, future value factor, and future value for finding out the future value. For finding out the future value. Present value of an annuity, if you want to value an annuity, annuity amount into the annuity factor. Perpetuity, CF1 divided by KE minus G. This annuity factor can also be used to calculate the loan EMI. Loan EMI. So you can do something called as annuity amount into PVAF is the loan amount, and that can give you the loan EMI which you need to create. Link between EPS, BVPS and ROE. EPS is equal to book value per share into ROE. Or ROE is equal to EPS divided by book value per share. How do you calculate return on equity? Return on equity is equal to EAS divided by amount of equity, or EPS divided by book value per share. What is the cost of equity? K is equal to D1 by P naught plus growth rate. D1 by P naught minus F plus growth rate if you have flotation cost. And if there are multiple growth rates, then you need IRR approach. You need IRR approach. Start with one guess rate, get the NPV positive, increase, get the NPV negative, one positive, one negative, and apply the IRR concept. If you have non-dividend paying company, or you do not have data, RF plus beta into RM minus RF. How do you link the dividend payout ratio? R is greater than K, great company, no dividends to be paid. R is lesser than K, bad company, 100% dividend payout. R greater than K is called growing company. R less than K is called declining company. Equal means normal company. How do you compute cost of GDR? Cost of GDR is equal to cost of equity. Only thing is you will have to use P naught minus F because there will be flotation cost. There will be flotation cost, and dividend will not be for per share. Dividend will be for per GDR, which can be 3, 4, 5, 6, whatever it is. It can be higher. So in this question, when you do at home, please do all this. Come dividend price is given. Wherever come dividend price is given, you will have to remove first. You will have to remove that and get the ex dividend price. Limiting value, I did not discuss this. Limiting value is following a payout ratio which is opposite of optimum payout ratio. Following a payout ratio. So you will use the Gordon's formula to do, Walter's formula to do the valuation. But you will follow a payout ratio which is opposite of optimum. For example, what is the optimum here? Return on equity 20, cost of equity 15. What is optimum? 0. Then you will have to calculate at 100% payout. You will have to calculate at 100% payout following a ratio which is opposite of the optimum payout ratio. Step up growth model is find out the year of stabilization, calculate dividends till the first year of stabilization, price at the end of the or the beginning of the stabilization. Beginning of stabilization is beginning of year 3 is end of year 2. P2 is equal to D3. Many question this P2 could be directly given to you saying that it is 70 rupees. Follow 70. Last question we did, they gave 70, I copied 70. Some question will say 300, follow 300. Some question will say the 5th year price is EPS into P multiple. Follow that, whatever the question is. Linear fall in growth rate. If there's a linear fall in growth rate, if they don't mention the number of years, every year 1% fall. If they mention the number of years, higher rate minus the lower rate, divide by the number of years of fall. Divide by the number of, like there's a linear fall in growth rate, there can be a linear increase in payout ratio. There can be a linear increase in payout ratio. Change in growth rate with change in payout ratio. If there is a change in payout ratio happening, then be cautious. You have to forecast EPS as well as DPS. You have to forecast earnings per share as well as dividend per share. Implied growth rate based on the current P multiple. In one question I said use the current P multiple given in the question and take the growth rate as the balancing figure. Take the growth rate as the balancing figure. There's an example to do this. You will understand this when you do at home. Present value of growth opportunities, the value of the share today minus value of the share if there is no growth. Value of the share if there is no growth. The gap is called PVGO. Multiple cost of equity. When there is a change in cost of equity, be cautious in PVF calculation. PVF calculation is whenever there is a change in cost of equity, 5th year, 14%. You should not do 1 divided by 1 plus 14% power 5. You take the previous factor and divide by the new factor. Divide by the new factor. There is an exception to this rule which we'll see in bond valuation. Impact of bonus on terminal value. Whenever there's a bonus happening, one share can become 1.2 or 1.5 or 1.2. Consider that when you do your calculation. If there is any transaction cost that can impact my maximum purchase price, whatever you calculated is the fair market price or the fair value, divide that by 1 plus the transaction cost. Divide that by 1 plus the transaction cost percentage. Each model of valuation basically says there is a base dividend which is paid. Consider that growing at the stable rate. Divide by KE minus the stable growth rate. KE minus the stable growth rate plus extra growth into step up into the half of the transition period into the base dividend, again the same denominator, again the same denominator. Maintenance of dividend income. If you want to maintenance dividend income, company should pay dividend. Company is not ready to pay dividend, I will do partial sale of share. I will do partial sale of share. How do I calculate the number of share? By calculating the price of each year. How do I calculate? Modigliani Miller approach. You'll have to calculate the price of each year and then find the number of share. If you get 4.97 rounded off to 5, and if you get 4.01 again rounded off to 5, again rounded off to 5. P multiple approach is equal to EPS into P multiple, where P multiple is equal to 1 by ROE, 1 by ROE. Earnings growth model is equal to E1 divided by K minus G. FCFE approach is equal to FCFE1 divided by KE minus G, where FCFE1 is equal to earnings per share minus equity needed for capex and working capital. Equity needed for capex and working capital will follow if you have data on capex, depreciation, working capital change, debt ratio in the question. In case you do a question and the question says I'm going to do a project, and in that project gives positive NPV, share price will go up by the amount of NPV per share. Share price will go up by the amount of NPV per share, and share price will go down if you have negative NPV per share. If you have negative NPV. Undervalued or overvalued is done by comparing the actual market price with the fair market price. In fact, we have multiple ways. One, actual market price with fair market price. And when we were doing in portfolio, actual return versus the required return. Actual return versus the required return. And we also had actual beta versus the fair beta. Actual beta versus the fair beta. So there are many ways of finding which is undervalued and overvalued. Components of required return. There are three parts to the required return. Inflation plus real rate of return plus risk premium. Any increase in inflation premium will increase my risk-free rate. Will increase my risk-free rate. Format of income statement, I start with sales, deduct COGS, I get EBIT, deduct interest, I get EBT, deduct tax, EAT, deduct preference dividend, EAES, number of equity share, EPS, P multiple, MPS. When you do your interest to approach, one is respective debt and respective rate, but if they give you an effective rate, please use the effective rate in the formula and then do the calculation. Some of the important ratios we use: current ratio, current asset by current liability; quick ratio, quick asset by current liability; debt ratio, equity ratio, debt to equity ratio, interlink. Debt ratio is debt divided by debt plus equity. Equity ratio is equity divided by debt plus equity, and debt equity ratio is debt divided by equity. Capital gearing is an exception where preference has to be added only to debt. Debt plus preference divided by equity. This alone lower the better. Lower the better, lower the better. 3, 5, 6 is lower the better. All others in this are higher the better. Higher the better. Proprietary ratio, proprietary funds divided by total asset. How much is proprietary bringing in? Interest coverage. What are you paying is the denominator. From where are you paying is your numerator. So interest coverage is EBIT by interest. Preference dividend coverage is EAT by preference dividend. Equity dividend coverage is EAES divided by the amount of equity dividend. Then I have turnover ratio where sales is my numerator. Asset. Fixed assets can be there, current assets can be there, total assets can be there, working capital can be there, capital employed can be there, or debtors can be there, creditors can be there, and inventory can be there. But for them, for debtors you use credit sales, for creditors you use credit purchases, or for inventory you use COGS. Inventory you use COGS. This ratio can be converted into days. How do you do? 365 divided by the ratio you have calculated. 365 divided by the ratio you have calculated. The days alone lower the better. Days alone lower the better. Everything else ratio is higher the better, but days is lower the better. GP margin, GP by sales, and a variant of is MP margin, operating profit, COGS. Then we have ROI. We used this when I was doing that question. ROI is equal to EBIT divided by capital employed, pre-tax, post-tax is into 1 minus tax. Post-tax is into 1 minus tax, and return on equity is EAES by amount of equity. Then I have dividend yield, which is DPS divided by MPS. Earning yield, we had used it when I was doing in mergers and acquisition. For deciding sale of share, I told calculate the earnings yield and compare with opportunity cost of capital. So earnings yield is EPS divided by market price per share. And using this to, in fact, we saw a problem of valuation also. We saw a problem on valuation also. Dividend rate is DPS by face value. Earnings per share self-explanatory. Dividend per share self-explanatory. Dividend payout ratio self-explanatory. Ratios are very, very critical. Please do revise them. Please do revise the ratios very clearly. One variant ICI asked in exam: fixed interest and fixed dividend coverage ratio, which is PAT plus the interest divided by fixed interest plus fixed dividend. Why are we calculating the ratio? To adjust the required yield. To adjust the required yield. If I'm a stronger company, required yield will go down, and if I'm a weaker company, required yield will go up. Weaker company, risk increases, K increases. Stronger company, risk reduces, K reduces. We saw one problem of doing this adjustment, and we saw one question on lending. Lending part is, if you are lending, you get two incomes. One is lending fees and second is dividend income. And if you are borrowing, you have two costs. One is lending charges and second is bank guarantee charges, and the third one can be a profit or loss. If price goes up, you have a loss, and if price goes down, you have a profit. When you short sell, you want the price to go down. You want the price to go down. Clear? Any doubts on this? We'll continue with the balance area, which is on your balances: bond valuation, money market instrument, rights issue, and a related area called as hybrid valuation. We'll see that in the next session. I'll end with this. Good morning, friends. Okay, let's now proceed with our discussion of security valuation. In the last class, we have done with the equity valuation. We have certain allied areas with equity valuation. One is rights issue, buyback, and for equity, we also have something called as a hybrid valuation, which is combining equity and debt. And then I move to long-term debt valuation and short-term debt. Short-term debt is called money market instrument, and a smaller area in between called enterprise valuation. Let's quickly discuss the rights issue part of it. The rights issue part is very simple. It is an issue made to the existing shareholders of the company. Normally, this issue happens at a price which is lower than the current market price. Because it happens at a price lower than the current market price, once the rights issue is completed, the price is called X rights price, which will be technically a weighted average of the existing price and the new price at which we are making an issue. It's a weighted average. It's a weighted average which has a formula called existing shares into existing price, new shares into new price divided by existing shares plus new shares. Technically, we are doing weighted average. Some question will mention, what are we going to do with the rights money? What are we going to do with the rights money? When you know that it can generate positive NPV, it can also generate negative NPV. So in the formula, we will add plus NPV. We will add plus NPV, because if it's generating positive NPV, my X rights price will go up. If it's not generating, my X rights price may get impacted. So an example, current market price is 130. Today I have 10 lakh shares. I am in need of 2 crore for a new project. What will be the X rights price if the firm offers rights in the ratio of 1:2? 1:2 is basically, in 10 lakh we will be issuing 5 lakh. I am in need of 2 crore. I am in need of 2 crore. So 2 crore divided by 5 lakh is technically 40 rupees. So today the price is 130. Rights issue is happening at 40 rupees. Rights issue is happening at 40 rupees. Because of this, my ultimate price is going to be weighted average of 130 and 40. How will it be calculated? 10 into 130 plus 5 into 40 divided by 10 plus 5. That's the weighted average we are talking about, which is turning out to be 100. Then the question will ask, what is the value of one right? In the same example, 130 is my today's price. Rights issue is happening at 40 rupees. So if I subscribe to a rights issue, a 40 rupee share will become a 100 rupee share. A 40 rupee share will become a 100 rupee share. Is that mean I'm making any money? No, you're not making any money. Your 130 rupee share is becoming 100. But what happens in few times in the marketplaces, I don't have money with me. So I will go ahead and sell this right to someone else. I'll go ahead and sell this right to someone else. So theoretical value of a right is equal to X rights price 100 minus the rights issue price. So 100 minus 40, 60 is the theoretical value of a right. That is if one right can give you one share. Many a times the rights ratio is slightly different. 1:2, 1:3, 1:4. So the same number, few places ICI writes as 60. Few places they say 60 and I'll divide by this ratio. Which is 1:2. So theoretical value of a right can be defined as X rights price minus the rights issue price, or value of one right at a per share level, because one share may not give you one right. 1:2 means two shares you need to have to get one right. Two shares you need to have to get one right. So you divide by the rights ratio. Some question, instead of giving the data to calculate the X rights price, they'll directly give you the X rights price. They'll directly give you the normal formula is theoretical X rights price. But if the question has given you the expected or actual post rights price, if it has given you the expected or actual post rights price, directly use that in the formula, because you are already giving. For example, current market price of a stock is 50, rights issues at 40, rights ratio is 1:5. What is the value of a right at a per share level? What is the value of a right at a per share level when the stock will sell X rights at what? 50. I am telling X rights it will sell at 50. I am telling X rights price will be 50. You don't apply the formula. If you apply the formula, you will not get 50. If you apply the formula, you will not get 50. They are saying after the rights issue is completed, price will be 50. You believe that price is going to be 50 after the rights issue is completed. So value of one right is 50 minus 40, 10. 50 minus 40, 10. That is at a per right level. Per right per share level is 10 divided by the rights ratio. 10 divided by the rights ratio. It is 2 per right per share. 2 per right per share. Clear? If I calculate X rights price for this question, existing share 50 into 5. Let's assume there are 5 shares. New share 40 into 1 divided by 6, you will get 48.33. You will be getting 48.33. But the question is saying, no, I am telling you X rights price will be this much. If the question has told me the X rights price, let me follow the X rights price. Why should I get into formula application and calculate an X rights price? Problem has told me, I'll follow that X rights price and proceed ahead. Now, a rights issue will have zero impact on the wealth of a shareholder, provided you subscribe to the rights issue or sell your rights in the market. But if you ignore the rights issue, wealth will go down. Wealth will go down. In this example, if I'm an existing shareholder, my 130 is becoming 100. I'm losing 30 rupees per share. I'm losing 30 rupees per share. Assuming I had two shares. Two share will give me one right. 30 into 2 is my loss. How will I offset that? Either by selling the right at 60 or by subscribing to right share and earning 60 rupee profit. But if you ignore the rights issue, you'll only have loss and profit will not be there. So my existing wealth is existing shares into existing price. Revised wealth is, if I subscribe, my number of shares will go up. But I have to pay cash for getting this. Cash paid is technically like a borrowing. So that will reduce my wealth. If you sell the rights, existing shares into existing price, existing share into X rights price, and there's a cash received on sale of right. There's a cash received. If you ignore, which is where the problem is. Ignoring is where the problem is. If you ignore, your wealth will go down. Current share price is 100. Rights ratio is 1:4. Rights price is 80. Can you tell me the X rights price here? Tell me the X rights price. Apply formula. Assuming there are 4 shares. Assuming the company has only 4 shares. 100 into 4 plus 80 into 1 divide by 4 plus 1. Divide by 4 plus 1, which is 96. 96. Today I am holding 1000 shares into 100. Tomorrow I will hold 1000 shares into 96. Tomorrow I will hold 1000 into 96. My net worth will go down. As I said, if you have any positive or negative NPV, it is going to impact the calculation, and net worth will go up, or it will get added to your numerator. Example, P multiple of a company is 12. Company does a project which will cost 200 lakh. Company is expected to earn 8% on the project. Current market price 200, 1 lakh share. Rights issue 2 lakh shares at 100. Today you have 1 lakh shares at 200. Rights issue is 2 lakh shares into 100. First I need to calculate what is the NPV of the project. My project is worth 200 lakh. I'm going to earn 8% on the project, which is, and the worth of the project, see, though you're spending 200 lakh, the worth of the project is pat into P multiple. The worth of the project is pat into P multiple. Pat is 16 lakh, P multiple is 12. Worth is only 192. Worth is only 192. I don't know why we spent 200, but the worth of the project is only 192, which means you're losing 8 lakh. You're losing 8 lakh, negative NPV of 8 lakh. In the formula, you need to bring negative NPV in the calculation. In the formula, you'll have to bring negative NPV into the existing shares into existing price, new shares into rights issue price, plus or minus NPV, plus or minus NPV, and this is going to impact my NPV. This is going to impact my price. Any doubts on this? If you generate a negative NPV or a positive NPV, wealth will increase or decrease. That's not because of the rights issue. The wealth increase or decrease is because of the NPV which is getting generated. Rights issue can neither increase the wealth nor decrease the wealth. Neither increase nor decrease. Okay. We're done with the rights issue part of it. Now I'll do the buyback part of it. Let's first discuss what is buyback. See, buyback is basically a situation where an organization is having a lot of surplus money. It is having a lot of surplus money. So it is thinking, I should go ahead and distribute this to my shareholder. I should go ahead and distribute this to my shareholder. Impact of buyback is there on multiple things. First thing, buyback will reduce my number of shares. Buyback will reduce my number of shares. Second, buyback can reduce my profit after tax. Can reduce my profit after tax. How does it reduce? I had surplus money of 500 crores. Earlier, this 500 crore was giving me 50 crore interest income. This 500 crore was giving me 50 crore interest income. Now what happens? I gave this 500 crore to my shareholder. I gave this 500 crore to my shareholder, because of which what will happen? My PAT is going down. My PAT is going down. Most of the time PAT will not go down, but some question they will tell that you had surplus money. It was either earning you income or you did not have surplus money. You took a bank loan. You took a bank loan. Only caution is when you take a bank loan or your income, that is before tax, and this is after tax. So you have to give the tax effect. You will have to give the tax effect. So one, your numerator EPS formula is PAT divided by number of equity share. Equity share will go down. PAT in few questions will not go down because they will not give any data. If, so PAT in few questions will not go down, but in few questions it will go down. How will it go down? Is buyback is, there is a size called as, I am doing a buyback of 10,000 crores rupees. 10,000 crore rupee came from where? It came from my fixed deposit which I had created. It came from fixed deposit which I had created. This fixed deposit was giving me 1,000 crore interest income. That 1,000 crore interest income was part of my profit after tax earlier. Was part of my profit after tax earlier. Now that is not there. That's one reason. Second, this 10,000 crore came from a bank loan. Came from a bank loan. On this bank loan, now you have to pay interest. Now you have to pay interest. So if you're paying interest on the bank loan, either there's an opportunity cost angle or there's a real cost angle. Buyback can increase the EPS if the total earnings remain the same and the number of shares reduced due to buyback. Example, today I have 10,000 share. I'm doing a buyback of 50,000 divided by 100. 50,000 divided by 100. Buyback size is 50,000. How many shares we are buying back? So 10,000 will become, PAT is maintained. PAT is maintained means earlier PAT was 10,000 into 3. Earlier PAT was 10,000 into 3. Same 30,000 continues. Number of shares go down. Post buyback EPS is increasing. Second, buyback can impact the total earnings if buyback is funded with debt. If buyback is funded with debt, revised PAT is equal to existing PAT minus interest cost into 1 minus tax rate, because interest has a tax angle. Interest has a tax angle. The question can also ask for reverse working to find out the amount of acceptable interest expenditure and the amount of debt. What happens is, question says you are planning to do a buyback. You're planning to do a buyback. My only requirement is I want EPS to be maintained. I want EPS to be maintained. EPS will be maintained if my denominator fall in number of shares and numerator fall in PAT is exactly same, proportionate. It's exactly. So earlier it was 30,000 divided by 10,000. Now denominator is 8,000. So numerator has to be, which means you can afford to pay 6,000 interest. You can afford to pay 6,000 after tax interest, then before tax interest. Once you get the interest, you can say you can afford to take a debt of 10 lakh rupees. If you can afford to pay so much interest, you can afford to take a borrowing of so much. Example, existing EPS is 10, number of shares is 1 lakh. So my profit today is 10 lakh. My profit today is 10 lakh. P multiple is 20. P multiple is 20, which means price today is company is going to do buyback of 20% of share. Buyback of 20% of share. So my 1 lakh share will become now 80,000. My 1 lakh share will become now 80,000. These 20,000 share, I'm doing a buyback at what? Premium of 50% to current market price. So I'm doing a buyback at 300 rupees. 20,000 into 300 is how much? On the 60 lakh, you have to pay 10% interest. On the 60 lakh, you have to pay 10% interest. After tax, it will be 7%. And your profit of today will go down. Profit today was 10 lakh. It goes down to 5 lakh 80. It goes down to 5 lakh 80. Profit goes down. Number of shares go down. EPS may go up, may go down, may remain same. May go up, may go down, or may remain same. Buyback also has an impact on my net worth. Buyback also has an impact on my net worth. Whatever amount you buy back, it will be deducted from your net worth. It will be deducted from your net worth, because in accounting what happens is whatever amount you are paying, bank account, whatever amount you are paying, share capital account debit, reserves and surplus account debit to bank account, whatever extra you are paying in addition to face value will get deducted from my net worth. So existing net worth minus the buyback size. What is buyback size? Is the number of shares bought back into the buyback price. Into the buyback price will become my revised net worth. Will become my revised net worth, which can have an impact. Can you try this? Please try this. It can have an impact on my book value. Try this. What is the existing net worth of the company? 900 lakh. We are doing a buyback of 10 lakh. So 900, 10 lakh rupees, 10 lakh rupees. So 900 lakh will go down to 890 lakh. I'm not sure if it's rupees 10 lakhs or 10 lakh shares. I don't know whether it could be a wording issue. We'll see in some time. 890. How many shares you would have done buyback in this example? With 10 lakh rupees, how many shares can you buy back? If price today is 5 rupees, I would have done buyback of 2. So existing 50 has now gone down to 48. Existing 50 has gone down to 48. Okay, it is rupees only. It is rupees only. It is assumed that buyback is happening at current market price. To cut it short, buyback can have impact on PAT, number of equity share, and net worth. 3 items will get impacted. Depending on which is getting more impacted, less impacted, your EPS, MPS will come. If PAT is getting impacted severely and number of shares is not reducing, EPS will go down, MPS will go down. If net worth is getting impacted severely, number of shares is not going down, book value per share will get impacted. It's a game of 3 things: PAT, number of equity share, and your net worth. PAT, number of equity share, and net worth. Okay, next segment of the chapter is on convertible instruments. There are many terms which are associated with convertible instrument, but all are fairly simple. Most of it I could cover only with the concept book itself. As such, in this area, if you are able to solve these MCQs itself, it kind of takes care of the entire area of convertible instrument. I haven't seen very tricky question in exam in convertible instrument. Only thing is you should be aware of each of it. Formula logic I can give you. If you get the logic correctly, you need not even remember the formula. First is conversion value. What is conversion values? The value of the instrument if conversion happens today. A convertible instrument is one which is either optionally convertible or compulsorily convertible into equity share. So if it gets converted today, example, face value of bond 100, rate of interest on bond 8%, return on similar bonds 9.5%, term 4 years, all this is irrelevant for conversion value. Bond is convertible into 5 shares. Current market price of equity share is 15. 5 into 15 is conversion value. 5 into 15 is the conversion value. That is, if you convert them into shares today, your value will become 5 into 15. Conversion premium. What is conversion premium is, you said 5 into 15 is 75, but market is saying pay 100, 120, 130, 140. See, I have two choices. Either I can buy shares directly. If I buy shares directly, 5 into 15, 75. If I buy debenture, I'm paying 100 or 120 or 130. What extra you are paying is the conversion premium. What extra you're paying is the conversion premium. Let's assume you're paying 120. 120 minus 75 is how much? 45 is the conversion premium per debenture. 45 is the conversion premium per debenture. Same thing, if you divide by that ratio of 5 is to 1, that will give you the conversion premium per share. Conversion premium per share. And this 45 you can express as percentage. 45 divided by 75, 45 divided by 120. 45 as a percentage of conversion value, 45 as a percentage of current market price. So conversion premium is equal to current market price minus conversion value. You can divide by the number of shares, you will get the per equity share. And when you want to express in percentage, it can be a percentage of conversion value. It can also be a percentage of current market price. You can end up writing both also. For example, face value 100, current market price is 100. I'm interested in this only. Current market price is 100. Rate of interest 8%, 9%. Bond is convertible into 5 shares. So 5 into 15, 75. 5 into 15, 75. We are paying extra how much? 25 is per debenture. 25 is per debenture. One debenture will get converted into how many shares? So 25 divided by 5 is the conversion premium per share. 25 divided by 5 is the conversion. 25 per bond or 5 per share. 25 per bond or 5 per share. Convertible instrument, straight value, intrinsic value, floor value, minimum price. What is straight value, intrinsic value, floor value, minimum price? A convertible instrument, because of its option of conversion, carries a better price in the market. Carries a better price in the market. Then what is intrinsic value? Real worth. What is real worth? Year cash flow, PVF, DCF. Year cash flow. Real worth of a debenture is year cash flow, PVF, DCF. For example, face value 100, rate of interest on bond is 8%. You are paying 8 rupees every year. You are paying 8 rupees. What is the return people need? Year cash flow, PVF, DCF 1 to 4, 8 rupees. At the end of year 4, 100 rupees, discounted at 9.5%. Discounted at 9.5%. That is called straight value, intrinsic value, floor value, minimum price, because that's the real worth of the bond. That's the real worth of the bond. Then why are we paying extra? Extra is very simple. In the last day, you said 100 rupees will come, but assume 5 shares become 1000 rupees. 5 shares become 1000 rupees. Then instead of getting 100 here, you will get 1000. You will get 1000. That is why we are paying extra. We are paying extra because there is a potential. There's a potential to get extra. Clear? Any doubts on this? Next, downside risk. What is downside risk? Because this has happened in many companies. Example, Suzlon. Suzlon had issued convertible bonds. When you issue convertible bonds, you are telling the other party that it will get converted into shares. But unfortunately, share price from 15 crashed to 10, 5, 4. I will not opt for conversion. I will not opt for conversion. If you are not opting for conversion, your current market price will fall to the straight value. If you are not opting for conversion, current market price will go down to what? Straight value. Will go down to straight value. Why does it go down to straight value? Because straight value is the real worth. Straight value is the real worth. I am telling you that this conversion option exists. I was happy with the conversion option when price was 15, 16, 17. I had hopes that it may start going up. But when price crashes down to 2 rupees or 3 rupees, I say let me think it as more like a bond rather than a convertible bond. If it is only a bond and not a convertible bond, 100 will crash down to 95.26 in my example. That gap is called the downside risk. That gap is called downside risk, which can be expressed as a percentage of 95.26 or as a percentage of 100. So straight value, current market price minus the straight value. Downside risk in percentage, it can be percentage of straight value, it can be percentage of current market price, and some question uses the word premium over straight value. Premium over, what is premium over straight value? How much extra are you paying on top of straight value? How much extra are we paying on top of straight value? Conversion parity price. You decided to do conversion. In my example earlier, 100 rupees is the market price. 15 into 5 is 75. What is conversion parity prices? If you do conversion, you should get 100. You should get the current market price. You should get the current market price. Conversion parity price means no loss on conversion. No loss on conversion. How do I get current market price of a debt instrument divided by the conversion ratio? Divided by the conversion ratio. Conversion parity price, market conversion price, minimum market price, break even price, which is very simple. Current market price is 100. Bond is convertible into 5 share. 100 by 5 is conversion parity. 100 by 5 is conversion parity price. Okay, this is a very good term. Favorable income differential. See, what I did is I bought one debenture. This is giving me interest income of 10 rupees. This one debenture will get converted into 5 shares. Will get converted into 5 share. What I did is I wanted to buy the share, but I still said I will buy debenture and let it get converted into share after few years. Let it get converted into shares after few years. I wanted only the share, but I still did not buy the share. I bought the debenture. One reason could be the interest income. What is the interest income? One debenture will give you 10. 5 shares will put together give you only 4 rupees. Will put together give you dividend is 0.80 per share. Dividend is 0.80 per share, which means I have a favorable income differential per bond of 6 rupees. I have a favorable income differential per bond of rupees 6. That is, the bond gives me 6 rupees extra. This can be defined at a per share also. 6 divided by 5 shares. 6 divided by 5 share. What is the use of this? The use of this is I paid some premium, no, conversion premium. I can recover that conversion premium through favorable income differential. I can recover the conversion premium through favorable income differential. You paid 20 rupees extra. See, if you wanted to buy 5 share, pay only 80 rupees. But you were adamant in paying 100 rupees for the bond. So you paid 20 rupees extra. This 6 rupees will get recovered in the first year. 6 rupees in the second year, 6 rupees in the third year, and maybe 6 rupees in the fourth year, provided the interest remains the same, dividend remains the same, provided dividend remains the same. So in 3.33 years, ignoring the time value of money, you'll be able to recover the extra payment. You'll be able to recover the extra payment. Interest income per bond minus the dividend income for equity share. Face value of a bond is 100. Interest rate on bond is, so 10 rupees you will get. 10 rupees you will get. Bond is convertible into 10 share. Likely dividend per share is how much? 0.2. So dividend income is only 2 rupees. Dividend income is 2 rupees. Interest income is, favorable income differential per bond is 8. 8 divided by 10 shares is per share. 8 divided by 10 share, which is 0.80. What is the use of this? As I said, premium payback period. Premium payback period. Whatever extra premium you paid per bond divided by the favorable income differential per bond, or your conversion premium per share, it can be defined per bond per share divided by the favorable income differential per share. Clear? Any doubts on this? Valuation of convertible bond. See, value of any instrument is present value of future cash flows discounted at investors required rate of return. So for a bond, very simple: year, cash flow, PVF, DCF. First year interest, second year interest, third year interest, fourth year interest, fifth year interest, and principal. But in the convertible bond, the redemption value is higher of the two number. Redemption value is higher of two number. What are the two number? First number is redemption as debt. Redemption as debt. What's the second number? Conversion into equity. Conversion into equity. That is, you should determine what will be the price at the end of fifth year. You'll have to determine what will be the price at the end of fifth year and then do the valuation. Ultimately, it does not happen. That's not my worry. I'm doing valuation based on certain assumption. How can I get the fifth year price? Maybe Gordon's formula. P5 is equal to D6 by K minus G, or maybe Modigliani-Miller approach from year 0 to year 1, year 1 to year 2, year 2 to year 3, year 3 to year 4, year 4 to year. Some question doesn't have that data. Then I'll ignore this part of it. I'll ignore this part of it. Floor value or minimum price of a convertible bond, I've already told you. Floor wise or minimum value is nothing but the straight value. Straight value, that is the real intrinsic value of the bond. The real intrinsic value of the bond. It does not include that option of conversion. Okay, some question will ask, should I convert my shares into bond? I will do conversion only if by doing conversion I don't lose money. What is not losing money? Today the bond is at 120. If I convert, can I get 120? That is, what is convert? Number of shares into the current market price of a share. So if you convert, can you get 120 or not? You need to check. If you are getting 120, okay. If you are not getting 120, don't convert. Don't convert. So decision on conversion is a bond can be converted into equity share if the conversion value is higher than the current market price of a bond. If it's not, then please don't do convert. Continue it as bond. Continue it as bond. And in the end, you're still not getting a higher value. Redeem it. That's all. Go ahead and redeem it. Clear any doubts on this? Before I get to bond valuation, I'll quickly summarize what we did in rights issue, what we did in buyback, and what we did, because I'm not going to revise because this chapter is so huge. I cannot revise all of them together. Now coming to rights issue. In rights issue, we have a very simple concept. First is called post rights price, which is existing shares into existing price, new shares into new price plus the amount of NPV divided by existing shares plus new shares. Mostly our X rights price will be lower than the current market price. Will be lower than the current market price because there is going to be a fall. There's going to be a fall. So existing shares into existing price, new shares into new price. I will make losses on my existing share. I gain on my new share. I gain on my new share. That's called theoretical value of a right. What is value of a right? Post rights price minus post rights price minus the post rights price minus the rights issue price. If you divide by the rights ratio, you will get value of right per share level. Per right per share level. In the question, if they give you the X rights price directly, don't apply formula and all, directly apply that. Directly substitute that in the formula. Shareholders' rights issue will impact the wealth of the shareholder in either zero or negative way. Zero or negative. How will it have negative if you ignore the rights issue? So if you subscribe, number of shares will increase. Number of shares into the post rights price minus the amount borrowed. Minus the amount borrowed. If you subscribe, number of shares remain same, but the post rights price go down. That's the value, and you will get cash by selling the right. You will get cash by selling the rights. And if you ignore, the value is going to be impacted. If you have any positive NPV or negative NPV, please add that in your denominator in the formula. Buyback will have buyback can have a favorable impact on EPS if my profit after tax remains same and my denominator number of share goes down. But profit after tax will not remain same. It can go down because of two reasons. Either because of loss in interest income or because of actual interest paid. Loss in interest income or actual interest paid. So buyback funded with debt, PAT will go down, number of shares will go down, EPS may remain same, may go down, may go up depending on what is the interest we are paying. Depending on what is the interest we are paying. And buyback will also impact my net worth. Buyback will also impact my net worth. My net worth will go down because of the buyback. If net worth is going down because of the buyback and number of shares are also going down, you will see ultimately an impact on book value, which can be going up, going down, or remaining same. Ultimately, three things change in a buyback. Number of shares go down, PAT go down, and net worth go down. How much, which is going down more? If number of shares is going down more and PAT and this is not going down that much, EPS will improve, book value per share will improve. Conversion value is, if you do conversion today, what is the value of the bond? So current market price of share into the conversion ratio. Conversion premium is extra paid gap between current market price of a bond and the conversion value. Gap between current market price of bond and the conversion value. That can be defined at per bond level, divide by the number of share per share level, divide by the conversion value percentage, divide by the current market price, again percentage. Convertible instrument has a straight value, intrinsic value, floor value, or minimum price. We had calculated minimum price in one of the question and floor value in one of the question. That is basically without conversion option. Without conversion option. Here cash flow PV of DCF without doing any conversion. Without doing any conversion. Downside risk is, in case the equity markets do bad, then conversion option is eliminated. Conversion option is eliminated. If it's eliminated, the bond will fall down to the straight value. Bond will fall down to the straight value. So the gap between the current market price of the bond and the straight value is called downside risk in rupees. Downside risk in rupees, which can be converted into percentage by dividing by the straight value or by dividing by the current market price. Downside risk can be per bond, can also be defined per share. If you want, you can define per share, but that's not more relevant. Only the per bond is relevant.
Ideally, the
Maximum fall, yes. Conversion parity prices, if you do conversion today, I don't want any loss. So current market price of the bond divided by the conversion ratio. Favorable income differential is bond has a higher income, dividend in share has a lower income. The gap is called favorable income differential per bond. If you divide by the number of share, favorable income differential per share. Compare this with conversion premium per bond, favorable income differential per bond, premium payback period. Conversion premium per share, favorable income differential per share will give you something called as the premium payback again. How do you value a convertible bond? For valuing a convertible bond, do year cash flow PV of DCF. 1 to 5, write the interest income. Do discounting at whatever is the investor's required rate of return. Year 5 is higher of the two number. Higher of the two number. Redeemers, debt are converted into share. Redeemers, debt are converted into share. Redeemers, debt, take whatever the normal numbers you have. Convert into debt is you will have to evaluate what will be the price at the end of year 5. In one question, we saw most likely price given in the problem. In one question, they gave today's price and they told keep adding the growth rate. In one question, we could not get that number. We could not get that number. If you are not able to get, ignore it. Ignore it. So that will give you, based on the valuation or the current market price given in the question, you can decide whether to do conversion or not. How do you decide? That is, whatever is the current market price of the bond divided by the divided by the conversion ratio will give you the minimum price. Will give you the minimum price. If the actual market price is higher than that, go ahead and do the conversion. Otherwise, don't do the conversion. Floor value or minimum price of convertible bond is equal to nothing but straight value or intrinsic value. That is doing the valuation of the bond as if conversion is not going to happen. As if conversion is not going to happen. Normally, we take redeemable values higher of the two. Redeemable values higher of the two. Here, redeemable value is only the principal redemption value and not the higher value. In short, it's the straight value. In short, it is the straight value calculation. Decision on conversion by comparing the current market price of the share with the current market price of the bond. If I opt for conversion, do I get any benefit? If I get a benefit, I'm okay. If I don't get any benefit, I am not going to go ahead with the conversion option. Clear? Okay, now I move to bond valuation part, which is again one important segment of the chapter. Uh, like we have equity valuation to be done, bond valuation also the basic rules remain same. Value of a bond is present value of future cash flows discounted at investors required rate of return. Like we saw multiple models of valuation, here we don't have any multiple models of valuation, only one model of valuation: year cash flow, PVF, DCF. Your job is to write the year and cash flow properly. Valuation will automatically come into picture. So that is what we do. And variant of this was convertible instrument, where at least I had to check in the year last year saying whether it is redeemed as bond or convert into equity. In case of bond, we don't have all of this. Let's see certain basic terms. Once I go with the basic terms, then we keep discussing few questions. When I do valuation of a bond, majority of the question, my focus will only be on year and cash flow. PVF, DCF part, we are not going to do it in the class. If at all needed, I'll see. Face value or coupon value. This is basically the value written on the face of the certificate. The utility of this is the interest which is paid is always on the face value. Coupon rate is basically the interest rate. What is the interest amount? Always on face value into coupon rate. Maturity value or redemption value. Maturity value or redemption value, because a bond has a limited life. Most of the instrument which we are going to do will have a limited life. So when it has a limited life, you need a redemption value. That redemption value will be at par if the problem is silent. If the problem specifies something, please follow whatever the question is saying. Yield to maturity, cost of discount, discount rate, required rate of return, expected return, opportunity cost, market rate of interest, prevailing interest rate, going rate of interest. Different names are there. Different names are there. This is basically the return which the investor is earning. This is basically the return which the investor is earning. Yield to maturity, cost of debt, discount rate of the bond, required return of investor, expected return, opportunity cost, market rate of interest, prevailing rate of interest, going rate of interest. All this is basically the earning of the investor. Earning of the investor. How will you get? One positive NPV, one negative NPV, and you need to calculate IRR. You need to calculate IRR of the investor. Again, for doing IRR of the investor, we will do few questions. Balance, I'll only discuss the year cash flow part of it. Current yield is more useful in case of a perpetual bond. In case of a perpetual bond, current yield is mostly very useful. What is current yield? Is interest divided by current market price. That is, I invested 120 rupees. You are paying me 10 rupees interest. So I say my yield is 10 divided by 120. We had used this concept in doing one valuation in mutual funds chapter. In mutual funds, in one question, they had given the bond instrument and they say investor is expecting so much. So I said interest divided by current market price is current yield. So interest divided by the current yield will give you the fair value of the bond. Current yield is very useful only in case of a irredeemable bond. Can I do it for a redeemable bond? Yes, you can do it, but the utility is on the lesser side. Okay, how do I do valuation of bond? Present value of future cash flows discounted at investors required rate of return. That is for year 0. Year 1, what will you do? Modigliani Miller. P naught into 1 plus KE. P naught into 1 plus KE plus discount rate is into 1 plus KE, my interest rate of year 1. You want the second year into 1 plus KE. K is KD here. K is KD minus the interest rate of year 2. You can keep moving forwards like this. For example, nominal value of a 10% bond is 100. Redeemable value is 120 in 2 years. Investors required rate of return is 14%. What should be the value of the bond? Discounting part we will discuss later on. Our focus is getting year cash flow. What is the first year cash flow out of this bond? 10. Second year 10 plus 10 plus 120. Discount this at 14%, you will get the answer. Discount this at 14%, you will get the answer. Current market price of a bond is 1000. Face value of the bond is 1000. Interest rate on the bond is 12%. YTM of the bond is 15%. YTM is basically the discount rate. YTM is basically the discount rate. What will be the price of the bond at the end of year 2? Year 1. Year 1 is equal to P naught into 1 plus cost of debt minus I1. Minus I1. What is the price today? 1000. Add 12% in calculator. Sorry. Yeah. No, add 15%. YTM. Cost of debt. Add 15% in the calculator. Minus 120 rupees interest. Minus 120 rupees interest. This is the price at the end of year 1. Price at the end of year 1. Again add 15%. YTM is investor expectation. Minus 120. 1064.5. 1064.5. Very simple. See, though I have a formula, but my logic is very simple. My 1000 rupees today should become extra 150. Should become extra 150, which can come in the form of interest or in the form of price increase. So interest is only 120. So price increase is 30. Price increase is another 30. What we do calculation is start with the base price, add the investors required return, and deduct the interest paid. Deduct the interest paid. Half yearly bond. Some question will say bond is paying half yearly interest. What student do is year cash flow. No year cash flow. Period cash flow, and period is half yearly periods. Half yearly periods. A bond can pay half yearly interest. You need half yearly discounting. Quarterly interest, quarterly discounting. Example: 10% bond pays interest in September and March of every year. Face value is 100. YTM is 12%. 12% is understood as 12% per annum. Normally yields are per annum. Nobody understands when I did mutual fund, holding period return is not understood. Only the annualized return is understood. What is the current market price with balance life of 2 years? What you need to do is period cash flow PVF at 6%. PVF at 6%. DCF. How many more years are there? 2 years. It's not 2 years, 4 half years. 4 half years. So 1 to 4 and at the end of period 4. 1 to 4 and at the end of period 4. What is the half yearly interest bond will pay? 5 rupees. At the end of period 4, you will get 100. At the end of period 4, you will get 100. You need to discount this and then get to the answer. 5 into 0.943, 5 into 0.890, 5 into 0.840, and 105 into 0.792. Okay, let's come to 59. Mr. X wants to invest 1 lakh in these 7 years, 8% bond, which were issued 2 years ago. I'm least bothered about the balance 2 years. Now only 5 years I'll focus. I'll focus only on 5-year period. You are required to advise him what is the price he can pay if he needs a minimum return of how much? This is my discount rate. Okay. If he needs a minimum return of, again it's the discount rate. Present rate of similar bond, again it is the discount rate. Present rate of similar bond, again it's the discount rate. So four different discount rates can be there. Four different discount rate. As I was in the theory, I have given the various names which the ICI can use: yield to maturity, cost of debt, discount rate, required rate, prevailing interest rate. In this question, they have used the word required rate and prevailing interest rate. Required rate and the prevailing interest rate. So I have copied different names from every question and clubbed them together as a single point, saying that these are the different names ICI will use. These are the different names which are going to be used in exam scenario. Any doubts on this? Clear? Now let's focus on writing year and cash flow. Tell me the year and cash flow for this. 1 to 5, and at the end of year 5. At the end of year 5, 1 to 5 is how much? 8. At the end of year 5, done, close. If the bonds are available at par, very important word, if the bonds are available at par, if bond is available at par, interest equal to YTM, interest equal to YTM, that is what the bond is paying is equal to what you are wanting. What the bond is paying is equal to what you are paying, and that is what 1% transaction cost. What is the effective yield? Now write, bond is trading at par, bond is trading at par, and hence interest rate on bond equal to investor yield. Interest rate on bond equal to investor yield. Interest rate on bond is equal to investor yield. I'll come to it. Let me first close this. Interest rate on bond is equal to investor yield. What is the interest rate on bond? So investor yield is equal to 8%. Okay, I am planning to buy this bond. Okay, let's assume yield is 8 on 100. 8 on 100. Now, what is the transaction cost? 1%. Unfortunately, I cannot buy at 100. I cannot buy at 100. I have to buy at what? 101. This is my yield. This is my yield. Earlier it was 8 on 100, but now it will become 8 on 101. The next part of the question, let me link both of them and then I come back to this question again. They're saying what is the number of days required to break even the transaction cost? Break even the transaction cost. This extra one you paid will be recovered by you in some time period. When will it be recovered? By the time you earn 1 rupee income. By the time you earn 1 rupee income. So I paid 100 rupees, extra 1 rupee I paid. Extra 1 rupee I paid. In a year I earn 8 rupees income. In a year I earn 8 rupees income. So I break even that extra 1 rupee in 1 by 8 of the year. In 1 by 8 of the year. Now they are asking what is my effective yield? My effective yield is technically 8 divided by 101. 8 divided by 101, which ICI has done it in a slightly different manner. Both will give almost the same answer, but there is a difference. 8 by 101 is the right answer. 8 divided by, what is 8 divided by 101 into 100? Some rounding of different. ICI answer is also 7.92 only, but your number will be slightly more in the rounding of 7.92. What you got? 7.92? Something like that. ICI answer is exact 7.92. Exact 7.92. Is there a difference in this? The difference is I did that Odessa limited question in cost of GDR, adding 2% you did and divided by 1 minus 2% I said. That is the difference which is coming here. Right approach is dividing by 101. Right approach is dividing by 101. Now ICI answer right. Investor yield, which also is logical only. Investor yield is equal to 8% into 100 minus 1%. What is 100 minus 1% is, for example, if you invest in something, or not 100 minus 1%, sorry, 1 minus 1%. Listen. If you are investing and earning 10% return, I ask you what is the after tax return? You will do 10 into 1 minus tax rate. 10 into 1 minus tax rate. Same logic they have done. 8 into 1 minus transaction cost. 8 into 1 minus transaction cost. Like you do 10 into 1 minus tax rate. Here we are doing 8 into 1 minus the transaction cost. 1 minus the transaction cost. So what do you get? 7 point. Any doubts on this? Now you tell me if you have a doubt. 10 into 1 minus transaction cost. 10 into 1 minus tax rate. We are using the formula of pre-tax into 1 minus tax rate. Into 1 minus tax rate. Any doubts? Can you proceed? Clear? What's the next part? Break. If the bond is available at again what? R. Listen, I invested 100 rupees. 1 year will give me 8 rupees. 1 year will give me 8 rupees. But I want 2 rupees in how many year? Because my transaction cost is 2 rupees. 1 year will come in, sorry, 1 year will give me 8 rupees. 1 year will give me 8 rupees. In what time period will I get that extra 2 rupees? That is my break even period. See, why are we calculating this? Assuming you bought at 102, you bought at 102 and suddenly you sell it in the next day. You sell it in the next day, you will suffer a loss. You will suffer a loss. Why will you suffer a loss? Because your selling will again happen only at 100. Again will happen only at 100, and it can be even 100 minus the transaction cost. It can be even 100 minus the transaction. So whatever 2 rupees I paid, I'm waiting for 2 rupee income. I'm waiting for 2 rupee income, which is how much?
By 8 of 1 year.
91 days. 91 days. Clear? Any doubts on this? That's okay. That's rounding off. Take it. Technically, answer is 3 months for me. Answer is 3 months for me. Most important learning is this, okay? If the bonds are trading at par, yield of the bond is equal to coupon rate. That's the most important learning. Balance is more of a formality. Balance is more of a formality. Important learning is if bond is trading at par, it is equal to coupon rate. It's equal to coupon rate. Any doubts on this? Can we proceed?
Sir, can you please repeat that last part, number of days?
Yeah. Okay. Someone has asked me a doubt in live online. 1 year is equal to 8 rupees income. Question mark is equal to 2 rupees income. Why 2 rupees? Because that's my transaction cost. So 1 year equal to 8, question mark equal to 2, cross multiplication 2 by 8 into 1 year or 2 by 8 into 365.
Basically, 6.92 is IRR including the
Effective yield. Let's come to 60. An investor is considering the purchase of the following bond: face value 100, coupon rate 11%, maturity 3 years. If he wants a yield of 13%, what is the maximum price you should be ready to pay? If the bond is selling for 97.6, what would be his yield? Second part of the question I will take you through, which is called IRR calculation, which is called technically IRR calculation. Now coming to the first part of the question. Tell me year cash flow PVF. First part of the question, year cash flow PVF at what rate? 13%. Year 1 to 3, third year 1100. So nothing much for me to discuss in this. Second is asking what would be his yield. Yield is calculated in two ways. One is called current yield. Second is called yield to maturity. Current yield is for an irredeemable bond. Yield to maturity is for a redeemable bond. Whenever you have to do YTM, you need one rate to start with, because I need one positive NPV, one negative NPV. I need one positive NPV and one YTM is equal to IRR of the investor. You need one positive NPV and one negative. So we do a shortcut. First shortcut you will write in your notebook. Second shortcut onwards, it's all calculator. Work. Now write YTM under shortcut is equal to. This is not the answer. Some students have asked, can I write shortcut in exam? No, that's not the answer, and you should not present that also in exam. Why are we doing shortcut? To know which rate to start with. YTM under shortcut is equal to interest income plus average other income divided by average funds employed. Interest income divided by average other income divided by average funds employed. Is this a new formula? This is the formula you would have learned for cost of debt at CA Inter. For redeemable debt, this is the formula. Interest income plus average other income divided by average funds employed. What is the interest income you get every year? 11. What is average other income is? It can be positive, it can be negative. What is the redeemable value?
87.6.
Redeemable value is 100. What price are we paying today?
87.6.
So if you wait for 3 years, you will earn extra 2 rupees 40 paise in the form of capital appreciation. 2 rupees. What is average other income is P1 minus P0 divided by the number of years. P1 is closing price, P0 is today's price. P1 is the closing price and P0 is the today's price. P1 is not first year price. P1 is the closing price. What is the closing price of the bond? 100. What is today's price? How many years? 3 years. So that is the average other income every year. Average income for every year. What is average funds employed? Opening by closing price 100, 97.6 by 2. 100 by 97.6 by 2.
Interest into agreement.
Redeemable value minus net proceeds divided by number of years. Redeemable value plus net proceeds by 2. 1 minus t alone doesn't come in our calculation. What is the YTM under shortcut? Now you can round off this to 12. None of this has to be presented in the exam. Again, I'm repeating everything in the calculator only, because in case you make an error here also, it will not matter. If you even make an error in this stage, it will not matter. Only thing is, if you make an error, you may not get immediately one positive and one negative NPV. Your calculation will go for a longer time. Your calculation will go for a longer time. So we are now going to do year cash flow PVF DCF. Do year cash flow. Listen for a minute. PVF at 12%. DCF. Listen for a minute. PVF at, I don't know. You need not write this, but you need to have space for at least 8 columns. This I may add if I want. This I may add if I want, because I need to do at least 2 times NPV. Worst case, it can go 3, 4, 5, 6, because I need one positive and one negative. I need one positive and one negative. So we will do a 12%. We may repeat at 13, 14, 15, 16, depending on our calculation. We may end up repeating this. So whenever you do YTM, keep in mind that I may open 8 columns. Keep in mind that I may open 8 column. Year 1 to 3, third year 1 to 3. Sorry, year 0. You'll have to start with year 0. Year 0, 1 to 3 and 3. Year 0, 1 to 3 and 3. Extra columns, don't open it, but I may tell you to open. I may tell you to open them. What is year 0 price? 1 to 3, how much you will get? At the end of 3. PVF at 12%. 1 divided by 1.12 equal to 2.44. Okay, every time before you write the annuity factor, write the third year factor, because if you put MRC, then you will miss out on the third year factor. Every time, this is just a step which you need to do. Every time before writing the annuity factor, first write the third year factor. Then press the grand total or MRC and then write the annuity factor. What is the third year factor? 7.1. I think here you will get exactly 0. If you get exact 0, problem is over at that stage. If you get exact 0, which means this is the IRR. This is the IRR or YTM. Later on, as I do, I will see a question where you will not get exact 0. So first under shortcut, then we will start with one rate, increase the rate, reduce the rate, depending on we get positive NPV or negative NPV. Any doubts on this? Can we proceed? Clear? Focus is again year cash flow. My focus is only on year cash flow. I don't want to go beyond year end cash flow. Any doubts on this? Here we are getting exactly, this is what I was talking about, shortcut method. In exam, I don't expect you to present this. You should not present it. As I do more and more problems, at some stage, this presentation will not be there in the answer. Presentation will not be there. Only thing is, we are saying our answer can be closer to 11.94. So we have started with 12%. We have started with 12. Okay, let's come to next concept. Next concept is step up or step down discount rate. What is step up or step down discount rate is, when I started, you told me that the discount rate will be 10%. Next year, I am saying, no, I am not okay with 10%. I know RBI will increase interest rate. For the next year, you give me 12%. Next to next year, you give me 13%. Next to next year, you give me 14%. I keep changing the discount rate every year. Every year. Follow the approach given in multiple cost of equity while doing share valuation. We need to check whether the given rates are forward rates or spot yield. What is the difference? I'll explain. If somebody tells me 1 year, 2 year, 3 year rate, I ask 10%, 9%, 8%. Forward rate means this is 0 to 1. This is 1 to 2 and this is 2 to 3. That is only for that year. This is the rate. Spot yield. What a spot yield is? This is 0 to 1. This is 0 to 2. This is 0 to 3. Spot yield means from today. Now what is the difference? If it's forward rate, PVF of year 2 is equal to 1 divided by 1.1 and then divided by 1.09. 1 divided by 1.1 and then divide by 1.09. What is spot yield? 1 divided by 1.09, 1.09, both 1.09, both 1.09. When you do 2 years, when you do 1 year, 1 divided by 1.1 only, because this is 0 to 1 and this is 0 to 2. This is 0 to 1 and this is 0 to 2 and that is 0 to 3. Using the spot, I can calculate forward. Using the forward, I can calculate spot. That calculation is possible. I'll explain as we proceed. I'll repeat again. Forward rate means rate only for that specific year. Spot rate means from today till 5 years. From today. So they'll say 5-year yield is 14%. If you want the PVF of year 5, 1 divided by 1.14 for 5 years you have to do. Spot yield for 4 years. 4-year bond is at 12%. Use 12% for 4-year PVF. 10% for 3-year PVF. 8% for 2-year PVF, 6% for 1-year PVF, whatever they give. There are two words again I'm repeating. One is called spot yield, second is called forward rate. If spot yield is given, the approach changes. PVF of year 2 would be computed by taking 2-year yield and discounting the same for 2 years. I'll be able to explain this better when I go to a problem. When I go to a problem, because without seeing numbers, you'll find it difficult. But this is the word. ABC wants to issue 9% bond, redeemable in 3 years at a face value of 1000. The annual spot yield curve. The annual spot yield curve. What is annual spot yield curve? Is this is the rate for 0 to 1. This is the discount rate for 0 to 2. This is the discount rate for 0 to 3. And you see, okay, I'll show the other part later. I'll show the other part later. So here PVF of year 1, see 1 divided by 1 plus 12%, 1 divided by 1 plus 11.62% square, 1 divided by 1 plus 11.33% cube. In short, can I convert from here to there and there to here? It is possible. I'll explain that as we proceed because it will become too many numbers at this point of time in your mind. Only thing is, if they use the word spot yield, then only this approach. If they don't mention anything, they just mention discount rate, then PVF of year 2 is equal to PVF of year 1 divided by 1 plus the new rate, divided by 1 plus the new rate. Expected price of a bond. Expected price of a bond is intrinsic value of bond into beta. There is no logic for this formula, but this is frequently tested. Student requested to remember and apply this. So you'll have to do into beta and then close it. 2-3 times it has come in exam. So I don't want to now say that this is right, this is wrong. I don't want to get into all that. Just do into this and then close it in exam. Any doubts on this? Go through 65. Okay, let's focus on year cash flow PVF DCF. So tell me the year cash flow first. 1 to 4 is 9, 5 to 8 is 10, 9 to 10 is current rate on a similar debenture is how much? 15%. Wait, I'll quickly discuss the concept. You need not get to this. What is to be used as discount rate of the bond? Discount rate should be investors' required rate of return will be taken as discount rate. This can also be called as yield of comparable bond or going rate of interest. That is whatever the other names for YTM. Higher yield offered by company. Sometimes the company may want to give a higher yield to investor. They may want to offer a higher yield to investor. In that case, you will have to discount using the yield they want to offer. If you see in this question, what are others giving? 15%. What others giving is the current rate on similar debenture is 15%. Company is saying no, I will give 16%. I will give 16%. Do discounting at 16%. If you want to give 16%, I will do discounting at 16%. Otherwise, I should have done discounting only at 15%. But company is saying voluntarily, I want to give more. I want to give more. If you want to give more rate, I'll discount it at a higher rate. I'll discount it at a higher rate. Any doubts on this? Clear? Discount rate normally will follow investors' required rate of return is taken as the discount rate. But if the company wishes to offer higher yield, which I cannot stop them from doing so, if they want to offer higher yield, I will do a higher discount rate. Can you tell me what should be the discount rate for this example? I want the discount rate for a AA rated bond, which is AAA rated plus 1%, which is AAA rated plus 1%. What is AAA rated? A rated minus 2%. So first let's get the A rated bond. What is the discount rate? What is the discount rate for A rated bond? 12%. Based on the AAA rated is? Based on AAA rated it is 11%. Clear? Any doubts on this? This is based on the risk we are calculating this. Company plans to issue 10% debenture. Yield on similar debenture is 15%. Company wants to make it in such a manner it gives how much? 18%. What should be the discount rate? 18%. If you want to give more, I'll make it 18%. There is another category of a bond called annuity bond. What is annuity bond? It is not going to pay interest every year. It is going to pay interest and principal every year. It is going to pay interest and principal every year. So how do you decide what is the annuity inflow? Whatever is the face value of the bond, divide by the annuity factor. Divide by the annuity factor. It is not going to pay 10 rupees, 10 rupees, 10 rupees. It's going to pay 100 divided by the annuity factor every year. That includes interest as well as principal. That includes interest as well as the principal. Same amount every year. Same amount every year. Life of an annuity bond is 4 years. Interest rate is 12%. Tell me the 4-year annuity factor for 12%. 4-year annuity factor for 12%. 1000 divided by that number, whatever you told me. That will be paid annual by the bond. That is what the bond is going to pay every year. Bond is going to pay divide by the annuity period. Now comes the concept which I wanted to do. Broken period bond valuation. What is broken period bond valuation is? We wanted bond pays interest on March 31. If you pay interest on March 31, using the concept of year cash flow PVF DCF, I can value the bond only on March 31 or April 1 of any year. You want first year, I can do first year. You want second year, I can do second year. Third year, I can do third year. Any year I can do, but only on March 31 or April 1. Suddenly you are saying, give me the value for June 30 or give me the value for July 31. Very simple. Do the valuation for a prior date and add accrued interest. Add accrued interest. Is this exactly right? No. When you add accrued interest, you need to bring time value of money, which Excel can do, you cannot do. So ICA has given two answers. One by doing that Excel calculation, and then they said simply just add the accrued interest. Just add the accrued interest. So when we are doing valuation, I'll do a valuation of a prior date. Whichever is the earliest date interest is paid. Whichever is the earliest date interest is paid, and then add accrued interest. If it's exactly that date, then Modigliani Miller. P2 is equal to P1 into 1 plus KD. I can do all that. Value of a bond on a date on which interest is not paid. Let us assume a bond pays interest in June and December. The above approach of valuation can help in valuing a bond on July 1 and January 1. However, we are required to calculate the value of a bond on September 1. How will I do? Get the value of July 1. How did you get value of July 1? Year cash flow PVF DCF and add the accrued interest. Example, on January 1 price is 100. Face value of the bond is 100. Interest is 10%. Interest is payable half yearly on June 30 and December 31. What will be the price of the bond on before October 1 when the interest would have been paid? June 30th. There is a lot of concept which is tested here. It may look very simple. June 30, what will be the price? 100. It will be 100 only. Reason is very simple. If a bond pays interest which is equal to investor expectation, if a bond pays interest which is equal to investor expectation, the bond will always quote at par. Now that's the other way around. Bond is quoting at 100. Which means bond is meeting investor expectation. So when you do valuation on Jan 1 2019, June 30 2019, Jan 1 2020, June 30 2020, any date you do valuation, you will get only 100 as the answer. Answer, because this is a bond which is meeting investor expectation. So June 30, the bond value is 100. Bond value is 100. Add accrued interest for July, August, September. You cannot add accrued interest from January 1 because on June 30 interest is paid. See, what normally happens is bond is like this. 100 will become 101. It will become 102, 103, 104, 105. Moment interest is paid, bond will fall by the amount of interest. Bond will fall by the amount of interest. This is what you learnt as share will fall by the amount of dividend. Bond will 100% fall by the amount of interest. Will fall by amount of interest. So every bond, this is the life. January, June. It will go up, go down to 100. Again go up, go down to 100. Go up, go down to 100. Go up, go down to 100. It will go up. Why does it go up? Because accrued interest keep getting added. Accrued interest keep getting added. Why will it fall? I have paid the interest. I have paid the interest. Moment interest is paid, it will again go down. It will again go down. So current market price is equal to face value. Hence interest rate and YTM will be same. This would mean the bond will always quote at par value once the interest is paid out. So on June 30, it will quote at 100. On June 30, it has a lot of concepts. Many concepts are getting tested in this. Be very clear on this. I would want ICI to test such quality of MCQ rather than just random some numbers and use simple calculation. That's of no use. The concept is getting tested because many students in exam will do 100 plus 9 months interest. They will add 9 months accrued interest because they will think from January 1 I have to add till September 30. No, you have to add only for the interest which is not paid. You have to add only the interest which is not paid. This I have already seen. Impact of transaction cost. If there is a transaction cost, yield will be equal to normal yield into 1 minus transaction cost. And if there is any number of days to calculate break even, transaction cost divided by normal YTM into number of days. This example you can do at home for your understanding. YTM of bond. YTM of bond, there are two approaches. One is doing the IRR calculation, which is the right approach. Second approach is shortcut. What is shortcut? Interest income plus average other income divided by average funds. You see post tax. That is only because if you want to do post tax. Otherwise, you can just cut this. Okay, it has to be only interest. We normally don't do post tax. We rarely do post tax calculation. Normally, our calculation is only at pre tax. So do the shortcut. After doing the shortcut, you can keep doing the calculation. What is this? I'll explain later. Post tax YTM. If you want to do post tax YTM, you'll have to work with post tax cash flows. You'll have to work with post tax cash flow. In case we should consider taxation on interest income and consider net flow, net inflow by considering the capital gain. Do all this example, it will give you that clarity. It will give you the clarity to do in exam. This is what I was talking about. Relationship between YTM, coupon rate and bond price. YTM, coupon rate and bond price according to me the most important part of the chapter. If coupon rate is equal to YTM, bond will be at par provided redemption is not happening. So I don't bring the redemption angle here. Okay, redemption has to be also at par only. If coupon is greater than YTM, very good bond, I will pay a premium. And if it's less, it will be a discount. This would mean that the bond, if quoted at par, will continue to quote at par because YTM will be equal to coupon rate. Above relationship will work only if redemption is happening at par value. If redemption is at premium or discount, then please do your calculation. Don't tell this relationship and all will not work there. Regardless of its required yield, the price will converge to par value as maturity approaches. What does this mean is, I told in one question, what is the redemption value? It was some 100. As time passes by, our value will touch that 100. Can you tell me what is the answer to this? Bond will quote at discount. Increase or decrease in interest rate. Some question will say there is an increase or decrease in interest rate. Any increase or decrease in interest rate means increase or decrease in discount rate or YTM. Your bond interest cannot change. So suddenly question will say there is a 2% increase in interest rate. Don't change the year cash flow. Year cash flow cannot change. Yeah, tell me.
On doubt.
Yeah, tell me.
Sir, as per MM theory, if the bond is giving more interest, the price should be low, no, sir. But here it's quoting at premium.
There's nothing like the price should be low as per MM theory. MM theory only said the price will go down. So when we did that example, price was at some 130 and it kept on going down. So it was quoting at premium only. 129 became 126, became 122, became 118, became 114 and became 110. MM never said that the price will be at discount.
Okay, sir.
Increase or decrease in interest rate is a
Okay.
very important concept, because some question will say there's a 2% increase in interest rate. The 2% increase in interest rate, many students think the bond interest will change. Bond interest cannot change because that is once issued, it has to remain same. Then what will change? Only the investor expectation can change. Only the investor expectation can change. This will have a lot of implication when I do a problem, because many times students tell me to change the year cash flow. Year cash flow cannot change. Only the YTM can change or discount rate can change. One exception to this rule is variable bond. One exception to this rule is variable bond. What is a variable bond? Is RBI says the interest rate on my bond is equal to RBI interest rate plus 1%. RBI increased interest rate, my interest rate will also go up. RBI decreased interest rate, my interest rate will also go down. That's an exception, which is a variable bond. What is variable bond? Is bond, for example, today if you take a loan from a bank, they will give you a variable or floating loan only, where what will happen is when you took a home loan, so for example, if you have taken a home loan at 6% 2 years back, today the home loan rates are at 7-8%. So the interest rates have increased, our interest rate will also increase. So exception is variable bond is the one where interest rate changes with investor expectation. Interest rate on this bond will always be equal to yield prevailing on the market. Now what is the implication of this? If my interest can go up with investor expectation and interest can go down with investor expectation, I always meet investor expectation. I always meet investor expectation. Interest went up, investor expectation went up, interest is also going up. What is the final implication of this? It will always quote at par. It will always quote at par, because you're always meeting the investor expectation provided redemption is happening at par. Provided redemption is happening at par. Expected price of the bond I've already told you, which is intrinsic value of bond into beta. Okay, now I'll move to an area called realized YTM. I'll do one question on realized YTM. What is realized YTM? Same as modified IRR. Same as modified IRR. In realized YTM, what happens is I get interest every year. I don't want this money. I don't want this money. You get interest every year. You tell them that you don't want this money. You don't want this money. So you reinvest that at some rate. You reinvest that at some rate. Normal IRR, no reinvestment needs to be done. Normal YTM, normal IRR, no reinvestment. Realized YTM or modified IRR. Or modified IRR, we need to make reinvestment. Mr. X purchases a 5-year 8.5% coupon bond for a price of 907.6 that has a YTM of 11%. You are required to compute reinvested interest amount on this bond. They have given YTM in the question. What is the YTM? 11%. That's the normal YTM. That's the normal YTM. We are going to do reinvestment. We are going to do reinvestment. Reinvestment will happen. They will give a reinvestment rate. They'll give a reinvestment rate. If nothing is given, reinvestment will happen at this rate itself. Reinvestment will happen at this rate itself, which is 11%. Reinvestment will happen at 11%. Now write year cash flow reinvestment period future value factor FVF at 11% and maturity cash flow. Maturity cash flow, year cash flow, reinvestment period, future value factor at 11%, maturity cash flow. Maturity cash flow, FV at 11% and maturity cash flow. How many years? What is the first year interest? Second year, third year, fourth year, 85, and fifth year. Interest plus principal is how much? 1085. What we do is I don't consume this 85 every year. I don't consume this. I reinvest this. So first year what I get, I reinvest this for 4 years. Extra 4 years I reinvest this. This for 3 years, 2 years, 1 year and year 0. 4, 3, 2, 1, 0. Because you bring everything to year 5. You take everything to year 5. You reinvest for 4 years, 3 years, 2 years, 1 year and 0 year. Future value factor 1 plus R the whole power n. So I start with 1 into 1.11 is how much? 1.11 into again 1.11. 1.11 into 1.11 is how much? 1.232, then again into 1.11. 368 and 1.518. That is every amount which you get, you keep reinvesting them. You keep reinvesting them. That is our 85 of year one. How much does it become in the fifth year? 85 of year one. How much does it become in the fifth year? 85 of year one. How much does it become in the fifth year? That is what we are trying to calculate here. Maturity cash flows. Now, what is realized YTM is I am not getting any of this. I don't receive any of this. I just receive single amount, which is 1529.40 after 5 years. I don't receive any amount. Every amount I receive, I reinvest it at some rate. Every amount I receive, I reinvest it at some rate. That reinvestment rate has to be given in the question. There is a small error in the question. It is not YTM of 11%. This seems to be wrong. It is reinvestment rate of 11%. It is reinvestment rate of 11%. Reinvestment rate of 11%. Any doubts on this? Now our cash flow is not this. Our cash flow is year zero. Year zero. We are paying how much? 907.6, and at the end of year 5, you receive a single amount which is called 1529.38. 1529.38. The IRR for this is called as realized YTM. The IRR for this, which I'll do it in some other question. For example, today I invest 907.6, nothing in here, nothing, and in the end you receive 1529.38. IRR for this, I'll explain this in some other question, which is turning out to be 11%. I'll do this in some other question. But IRR of this is called modified IRR. IRR of this is called modified IRR. What is the requirement of the question? Reinvested interest is you invested 85. You invested 85. You got back what? 129. The gap is called reinvested interest. The gap is called reinvested interest. I need to. I'll be back in 10 minutes. I need to do something. Some urgent work has come. What I'll suggest is just give me a minute. Go through 69 and try to calculate the maturity cash flow for this. Please do maturity cash flow for 69. 69. I'll be back in 5 to 10 minutes. Okay, I wanted you to do the maturity cash flow calculation. There is a 1,000 rupees bond which is at a par value of 10%, has a life of 4 years. It is at 1020. Maturity value is coming as 1457.3. The reinvestment rate given in the question is 9%. Now listen. What is the today's price of the bond? 1020. First year, how much interest? Second year, third year, 100. Fourth year, you get 100 plus. This IRR is called normal YTM. This IRR is called normal YTM, which is turning out to be 9.38%. 9.38%. Second type of IRR is you don't get anything here, you don't get anything here, you don't get anything here, and at the end of year 4 you get how much? 1457.3. What was the normal YTM? You have not done the normal YTM, but normal YTM is 9.38%. Coming to the realized YTM, what is the reinvestment rate? 9%. If my reinvestment rate is lesser than the YTM, if my reinvestment rate is lesser than the normal YTM, realized YTM will crash down from 9.38. It will crash down. It will crash down to what? 9.33. It is crashing down to 9.33. That is, if you use this cash flow and calculate IRR, that is called normal yield to maturity. And if you use this and calculate IRR, this is called realized YTM. This is called realized YTM. If you had done reinvestment at 9.38% exactly, then our normal YTM and realized YTM will match. Normal YTM and realized YTM will match. Simple relationship is normal YTM and realized YTM will be same if reinvestment rate is same as the normal YTM. If you are reinvesting at 10, 11, 12 and all, realized YTM will be better also. Realized YTM will turn out to be better than the normal YTM. I'm not getting into the IRR calculation. 4 years, one inflow, one outflow. We have done it through present value is equal to, sorry, future value is equal to present value into 1 plus R the whole power n. If number of years is in decimal, that is 2 years or 3 years or 5 years or 6 years or 7 years, it's not 2, 4, 8, 16, then you will have to do in normal IRR approach. You will have to do that in normal. Here also 2 years you can do 1 plus R square. 4 years you can do. If I have 5 or 6, what happens? I'll explain as we proceed. Any doubts on this? Okay, now I'll come to the next concept, which is duration. Let me first go through the concept book if anything else is left over. Okay, like I calculate YTM for an investor, I can also calculate YTM for a company. That YTM is called cost of debt. Only thing you need to do is we will start with year cash flow PVF DCF. The year 0 will be inflow for the company. Year 0 will be inflow for the company, and every year will be outflow for the company. Every year will be outflow for the company. You can bring tax angle also into picture. You can do a YTM for the company. There is one question which is there. I will not be doing that, but you can just see that. So like you calculate YTM for an investor, you can also calculate YTM for a company. Because the cash flows are opposite in nature, normally if you get a positive NPV, what do? Positive NPV we increase the rate, and negative NPV we reduce the rate. Positive NPV we increase the rate, negative NPV we reduce the rate, so that we get one positive and one negative. Because the cash flows are opposite in nature, you need to follow the opposite rule. That is, if you get a positive NPV for a company calculation, instead of increasing the rate, you should reduce the rate. Instead of increasing the rate, you should reduce the rate. Reason for reduction is cash flows are opposite in nature. Cash flows are opposite in nature. So company will have inflow on day 0 and will have a series of outflow over the life of the bond. Hence, while calculating IRR, we should increase the discount rate if we get negative NPV and decrease the discount rate if we get positive NPV, following an approach which is opposite of the normal approach. Just give me. Current yield of bond. What is current yield of bond? Is interest divided by current market price. We did this example when we were doing the problem. Okay, yield and price relationship. What is yield and price relationship? Is as yield goes up, price will go down. As yield goes up, price will go down, because both of them have an inverse relationship. Both of them have an inverse relationship. For an irredeemable bond, current yield will be used, and for a redeemable bond, you will have to either use the concept of volatility. What is volatility? You will understand as we proceed. Or do the discounting. Realized yield I have discussed. Realized yield assumes that interim cash flow will be reinvested at a realistic reinvestment rate. Once you get this, you will have to calculate the IRR based on this. You will have to get the IRR based on this. There was one exam question where they said intermediate cash flows are not reinvested. Intermediate cash flow are not reinvested. What is the implication of this? Is when I do my calculation like this, I say 4, 3, 2, 1, 0. It is not reinvested means FVF at 0%, future value factor at 0%, because you could not reinvest that money. If you are not reinvesting the money, you are wasting that money. So technically 85 of year 1 will become 85 of year 5. 85 of year 1 will become 85 of year 5. 85 of year 2 will also become. So my maturity values will be like this. And if my maturity values are going to be something like this, 85, 85, 85, you will see a huge fall in IRR. My IRR has now gone down to 9.44%. My IRR has gone down to 9.44%. Not reinvested means you are reinvesting at 0%, which means your maturity cash flow is nothing but just a sum total of all cash flow. Just the sum total of all cash flow. When you reinvest, you earn extra. Question. I'll come to it. The many question reinvestment is different rate only. This is the relationship I was talking about. If my reinvestment rate is equal to IRR, if my reinvestment rate is equal to IRR, realized YTM and normal YTM will be same. If you reinvest at higher, you will realize more. If you reinvest at lower, you will realize less. Example, YTM of a bond instrument is 20%. Reinvestment happened at what? 15%. What is the likely realized yield? More than 20, greater than 20, less than 20? Less than 20, because you have reinvested at a lower rate. You will realize a lower return. You will realize a lower return. Duration. Okay, I'm coming to this concept. Duration is basically every year you keep getting some money every year. Now on its duration, volatility, I don't think so you'll be able to do any question. You will only be in listen mode as far as duration is concerned. It'll take away a lot of time for calculation. So focus would be to understand the calculation rather than noting down things. I have duration of a redeemable bond. I have a duration of an irredeemable bond. I have a duration of a zero coupon bond. What is redeemable bond is? Put year, cash flow, PVF, DCF. Every year, whatever cash flow you are getting, you can attach a weights to it. You can attach a weights to it. How do you attach weights to it? Every year DCF divided by the total of DCF. Every year DCF divided by the total of DCF, and year into weight, that total is called duration. Year into weight, the total is called duration. Whenever question is asking duration, you cannot use annuity factor. You cannot use annuity factor. We keep writing 1 to 10. All that cannot be done. 1, 2, 3, 4, 5. You will have to keep writing separately. You will have to keep writing separately. If you are doing an annual bond, this answer is annual. If you are doing a half yearly bond, the total is called duration is equal to so many half years. Duration is equal to so many half years. You will see this when I do the question. Focus will only be on understanding the calculation rather than noting down, because noting down will take away a lot of time. What is a perpetual bond? A perpetual bond has no end. A perpetual bond has no end. Duration as a concept basically tells for how many years should I invest, for how many years should I invest, so that I'm not exposed to something called as an interest rate risk. I'm not exposed to something called as an interest rate risk. If interest rates go up, it is a problem for me, because if interest rates go up, price will go down. But there's a benefit also. If interest rates go up, my reinvestment can happen at a higher rate. My reinvestment can happen at a higher rate. If interest rates go down, I have a problem. My reinvestment will happen at a lower rate, but my price will go up. My price will go up. There is one time period where the loss in reinvestment or gain in reinvestment is equal to loss in price or gain in price. I had shown this calculation in my regular videos, but there is a time period at which loss which you get from reinvestment or gain which you get from reinvestment is equal to the loss or gain in price. That is technically called duration. That's technically called duration. For a perpetual bond, because there is no end, there's no end, the duration of a perpetual bond is equal to 1 plus whatever the YTM it is generating, again divided by the YTM, again divided by the YTM. If it's a half yearly bond, we should compute the duration in terms of number of half years, and if it's a yearly bond, you will have to do it in the number of years. I'll come to this impact of changes in some time, because this got tested in MCQ in exam. Let's come to 78. 78 I'll do it later. Let's come to 79. Let's come to 79. Go through 79. Go through 79. Okay. Following data is available for a bond: face value, coupon rate, years to maturity, redemption value, yield to maturity. See, focus is always on year and cash flow in this chapter. Like in portfolio, I was saying I want return and probability. Here I need year and cash flow, which is almost readily available. They've asked for current market price, duration, volatility, what is the price if there's an increase in yield, and what is the price if there is a decrease in yield. you be in listen mode only. In case you have a doubt, let me know. I'll first write year, cash flow, PVF at what is the discount rate given? DCF, weight, product. Year, cash flow, PVF, DCF, weight and product. How many years is the cash flow? 6 years. No annuity. I cannot write annuity. What is the cash flow for the first year? Same continues. Last year, 1110. PVF at 15%. 1 divided by 1.15. You keep doing this, you'll get the DCF. The total of DCF is the current market price, which is what you normally do to value the bond. This is called as current market price. If only current market price is asked in the question, you can go ahead and do annuity factor. They've asked current market price, which is done. Second is duration. What is duration? Is every year DCF divided by the total of DCF. Every year DCF divided by the total of DCF. I'll do 4 decimals. I'll do the calculation for 4 decimal. So DCF 95.7 divided by 848.35. Again 83.16 divided by 848.35. Again 72.38 divided by 848.35. You will keep dividing. Technically this is not needed, but the total of this will be one time. The total of this will be one time. It's becoming 0.99. That's a rounding of difference. That's the rounding of difference. Every year DCF divided by the sum of DCF. Every year DCF divided by the sum of DCF. Product is year into weight. Year into weight. You keep doing this. Put a total of this. This is called duration. Duration is 4.5747 years. Duration is equal to 4.5747 years. I'll be doing rework where I'll put in the same format only. I'm not going to do anything beyond this. Duration is 4.5747 years. What's the next thing asked in the question? Volatility is equal to, I'll discuss the formula of volatility in some time. There are certain changes needed there. Duration divided by 1 plus YTM. Duration divided by 1 plus YTM. Volatility is technically called as first derivative of the duration. It's technically called first derivative of the duration. First derivative is divided by 1 plus YTM. 4.5747. The YTM in the question. 1.15. Divide by 1.15. 2 decimal answer, tell me. Sorry? 3.97 percentage. Volatility is expressed as percentage. Volatility is expressed as percentage. Now, what is the use of volatility is, if yield increase by 1%, price will decrease by 3.97%. If yield increase by 1%, price will decrease by 3.97%. And if yield decrease by 1%, price is going to increase by 3.97%. They've asked us to calculate the price again. What are the changes? They've said price with the change. With the yield increase of 1%, 100 basis point is 1%. New price is equal to 848.35. Yield has gone up. Yield has gone up. Price will go down. Price will go down minus 3.97%. Tell me the answer. Minus 3.97%. 81. This is just an approximate answer. This is not the exact answer, and it will not match the exact answer. It will not match the exact answer. Still, why are we doing this approximate answer? It makes it easier for me to do a analysis on the bond. It makes it easier. See, if a bond carries higher duration will result in higher volatility. Higher volatility means high risk. Higher duration will result in higher volatility, and higher volatility indicates higher risk. So if given a choice, I should select low duration bond. I should select low duration bond. Low duration means low volatility. Low volatility means lower risk. Low duration means low volatility. Low volatility means low risk. Now, what is the next scenario? Price with Yield decrease of, if yield is decreasing, new price is equal to 848.35 plus, it will not be plus 3.97 because yield has decreased by how much? 0.75. 3.97 into 0.75 is how much? 2.98%. How much is the answer? Now I will check whether what is the exact answer we are getting. This is just an approximate answer. This is just a approximate answer. What is exact answer is, we started with what discount rate? 15. I'm increasing this to 16 now. Increasing this to 16. Exact accurate answer is 815.24. Formula gave 814.67. Formula gave 814.67. If you want accurate answer, it is 815.24. Our formula gave 814.67, which is more of an approximate answer, which is an approximate answer. Approximate is okay. Whenever volatility is done, I can use the approximate answer.
You can directly do this now.
It takes time, no? It will take more time, no? Do year cash flow, PVF, DC.
Paper it is okay, but
So in exam, say practical world, I'll tell you the utility of a volatility. Once I know the volatility, I know that what will happen if bond RBI increases interest rate or if RBI decreases interest rate. That's the utility of the volatility. You need not calculate revised price using volatility. The utility of volatility is, moment I know volatility, if RBI is going to increase the interest rate, I mentally prepare that this will be fall in my price. This will be the fall in my price. Or if RBI reduces the interest rate, this will be my increase in price. That's the utility of the volatility concept. Concept is not to calculate the new price. New price automatically this will calculate, but it can help me understanding what is the problem I'm going to face if RBI increases interest rate or if RBI decreases interest rate. And the other scenario was RBI decreasing interest rate, which is 14.25. If I do 14.25, I get answer is 874.93. Our formula gave 873.61. Accurate answer is 874.93. So accurate answer only discounting can do. Accurate answer as such, concept of volatility can be used only when there is a very small change in interest rate. Practically, no country changes interest rate by 1 or 2% immediately. They change by 0.25% or 0.1% or 0.5%. 0.25% and all, the formula of volatility can easily accommodate. 0.25 and all, it can easily accommodate. When the change is huge, that is where the problem is. To cut it short, duration is equal to year, cash flow, PVF, DCF, weight, product. Till PVF, DCF, you know, weight is equal to DCF divided by the total of DCF. Product is equal to year into weight. Product is equal to year into weight. Impact of change in variables on duration of bond. This can come as a multiple choice question. Listen, if time to maturity goes down, a 10-year bond will have a higher duration, a 5-year bond will have a lower duration. So shorter maturity bond will have lower duration and longer maturity bond will have higher duration. Duration means price risk. Duration is basically price risk. What is price risk? Duration leads to volatility. Volatility leads to price risk. Coupon rate. If coupon rate increases, my year 1, year 2 initial cash flow increases. My year 1 initial cash flow increases, year 2 increases, year 3 increases, and the later value decreases technically. See, whenever there is a coupon rate increase, for example, here what is the duration? 3.56. I increase this to 100. 100 is 10%. I increase this to 100. When I did this, duration has gone down. If you increase the coupon rate, duration will go down. The reason for that is, you are getting most of the cash flow earlier. Higher coupon means you are getting it early. Weighted average into 1 instead of doing into 7. Into 1 instead of doing the last year into 3 or into 4. The third part is yield to maturity. If you increase the YTM, again the impact will be on lower duration. Reason for that is, if you increase YTM, somewhere these will be penalized more. The last years will be penalized more and the earlier years will be penalized less. So when you penalize them more, automatically the weighted average. For example, if I do 8%, My duration again has gone down. Duration again has gone down. Duration will keep going down in case there is a increase in YTM. There's an increase in YTM. So three things: time to maturity, coupon rate, yield to maturity. All the three have an impact on duration. All the three have an impact on duration. Time to maturity, if you reduce, duration will go down. Coupon rate, if you increase, I'm very happy about it. I'm very happy about it. My duration will go down. And YTM is increasing. YTM is increasing. This will result in lower duration.
team increasing is 10 to 11 or 10 to 8, sir.
7. What did I do?
You did 8.
Okay, that's an error then. Let me make it 12. I make it 12. What happened? 3.5463. What is the answer you got earlier? So it has gone down. It has gone down. YTM has gone up and this has gone down. Modified duration. Be very, very important concept. Okay. Understand this very clearly. Modified duration or volatility is equal to, why I'm discussing all this, I've done the problems on this, but I'll have to relate to the question which we are going to do now. Duration divided by 1 plus YTM. Be very careful. If it's a half yearly bond, if it's a half yearly bond, denominator will be 1 plus half yearly YTM. Denominator will be 1 plus half yearly YTM. But numerator will always be in years. Numerator will always be in years. There's a reason for this. There's a reason for this. Price change is equal to volatility into yield change. Volatility into yield change. 1% changes, we took the same answer. 0.75 change happened, I did 0.75 into 3.97. Volatility and the yield change, that is the numerator. The numerator which you use in the formula, both will be annual change. Both will be annual data. Both will be annual data. For example, duration of half yearly bond is 5.85. Duration of a half yearly bond is 5.85 years. YTM is 10% per year. YTM is 10% per year. Volatility formula is duration in years divided by 1 plus half yearly YTM. Duration in years divided by 1 plus half yearly YTM. Now you may ask, why only numerator is in years? Reason very simple. Duration in years will be multiplied with annual change in yield. Will be multiplied with annual change in yield. This yield change is always annual. The yield change is always annual. I'll explain again. Duration in years divided by 1 plus the relevant YTM. 1 plus the relevant YTM. I will park this for some time because I have a question on this. I'll explain there again and I may come back to this. But concept is very simple. My numerator should always be in years. My numerator should always be in years. YTM, if it's a half yearly bond, I need half yearly YTM. Annual bond, I need annual YTM. Quarterly bond, I need quarterly YTM. You may ask, there is an inconsistency. It is not inconsistency. I'll explain this in some time. I'll explain this in some time again. Duration and churning of portfolio. Duration and churning of portfolio is very simple. I know RBI is going to increase interest rate. I know RBI is going to increase interest rate. Should I invest in high duration bond or low duration bond if RBI is going to increase interest rate? RBI is going to increase interest rate. If RBI increases interest rate, my price will fall. If price is falling, give me low duration, so lower fall happens. Give me low duration, so lower fall happens. RBI is going to decrease interest rate. RBI is going to decrease interest rate. If RBI is decreasing interest rate, what will happen to the price? Price is going to increase. Give me high duration, high volatility, high increase. Give me high duration, high volatility, high increase. Understand again, if RBI is going to reduce interest rate, my price will go up. My price will go up. I want to invest in high duration bond because it results in high volatility and higher increase. And if RBI is going to do the opposite, low duration bond, low volatility, lower fall. Fall has to be lower, increase has to be higher. Let's see this in an example. Duration is 8 years. Duration is 8 years. Yield is expected to increase in current year. Yield is expected to increase in current year. What action should be taken by the investor? Read the 4 and tell me which is better. First thing, tell me, do you want to increase the duration or reduce the duration? Reduce the duration. Why I want to reduce the duration? Because RBI is increasing the yield. If RBI increases the yield, my price is going to go down. I don't want high duration bonds. I don't want high duration. So what I will do is I'll invest in lower duration bond and sell off my higher duration bond. Sell off my higher duration bond. This is volatility and change in price relationship, where that half yearly YTM alone I need to discuss with you. Can you give me answer to this? Read this alone. Volatility is 4.5. Yield will increase by 25 basis point. Yield will increase by 25 basis point. What will be the effect on current market price? Yield is increasing or decreasing? Price is going to decrease. It will not decrease by entire 4.5. It will decrease by what? 4.5 into 0.25 into 0.25. Any doubts on this? Okay, this is the concept I want to use in the current question. Immunization. What is immunization is, I want to protect myself from increase in interest rate as well as decrease in interest rate. How can you protect? If the investment is done for a time period which is equal to duration of the bond, which is equal to duration of the bond. That is, if you want money after 2 years, go to the market and find a bond with 2-year duration. Go to the market and find a bond with 2-year duration. If you need money after 10 years, go to the market and find a bond with 10-year duration. Go to the market and find a bond with 10-year duration. If you are able to do that, you have immunized. If you have immunized. If you are not able to do that, then immunity is not there. Then immunity is not there. Immunization basically means my weighted duration of the portfolio is equal to the time period for which the investment is required to be made. Some question will say, investor needs money after XX year, which is the problem I'm doing now. It somewhere mentions this. If you need money after XX years, duration has to be that much. Duration has to be that much. Fund and outflow after XX years. You need some money after so many years. For example, I need after 10 years 20 lakh rupees. I need after 10 years. So I should find a bond which has a duration of 10 years. I should find a bond which has a duration of 10 years. If you are not able to find such a bond, then you are exposing yourself to interest rate risk. You are exposing yourself to interest rate risk. Okay, we are left with maximum 3 or 4 more concepts, major concept. One is on bond refunding. Second is how forward rates are calculated. And third, I need to cover that volatility concept with a half yearly YTM. Volatility concept with the half yearly YTM. So immunization is covered. Now bond refunding. It's a very important concept. And when we do bond refunding, the concept book covers everything in detail. We'll do one problem on bond refunding that will give you the clarity which is needed. But let's first understand what is bond refunding. Bond refunding is basically a situation where an organization is saying, I am going to close your existing bond and replace it with a new bond. Close your existing bond. Bond refunding means just closing, but it's not bond refunding. We'll do bond replacement. We will do bond replacement. That is, you close out your existing bond and put a new bond. As we did in replacement decision, analyze new bond separately, old bond separately, and do incremental. Analyze new bond separately, old bond separately, and do incremental. This is the broad analysis. This is the broad analysis. When we do step 1, we will do them together. We will do new and old together. Then only you will get the right answer. Then only you will get the right answer. Logic, everything I can explain, but it is easy to do it together. Step 1. Step 2, you should do separately. Step 2, you should do separately. When you do step 2, new bond, analyze separately. Old bond as if it is continuing. Old bond as if it is continuing. So what is the concept is, whenever you issue and redeem an old bond, whenever you redeem an old bond, along with that old bond, there could be some flotation cost, discount on issue of debenture, call premium. Everything related to old bond should be written off on day zero. Should be written off on day zero. What is write off? Get the tax benefit. Get the tax benefit relating to the old bond. Get the tax benefit relating to the old bond. Again, I'm repeating, everything related to old bond, everything related to old bond should be closed on day zero. Then when I come to step 2, I will say imagine as if you are continuing. Imagine as if you are continuing. It may look like that I'm doing an opposite thing. That is what can give you the right answer. Imagine as if you are continuing. In a new bond, you can have flotation cost, discount. This cannot be written off on day zero. This cannot be written off on day zero because the bond still exists. The bond still exists. Where are you going to write off? You are going to write off this over the life of the bond. You are going to write off this over the life of the bond. Then I get in between cash flow, which is comparing old bond and new bond. We should work as if the old bond is continuing, as if the old bond is continuing when we analyze the cash flows of old bond, when we analyze the cash flows of old bond. Then there's a term called overlapping interest. What is overlapping interest? Is our assumption is the new bond will replace the old bond on day zero. The new bond will replace the old bond on day zero. If replacement is not happening, you have to pay extra interest on your old bond. You have to pay extra interest on your old bond. Many students think extra interest is paid on new bond. No, new bond to anyway has to be paid. New bond to anyway has to be paid. Extra is getting paid on your old bond because you could not close it. On overlapping interest, tax benefit will also be there immediately because it is related to old bond. It is related to old bond. This is the extra interest paid because old bond could not be redeemed. Extra interest paid on old bond into 1 minus tax rate. These are various items which can come. Redemption value of old bond. Redemption value of old bond is an outflow. Call premium on old bond is an outflow. On the call premium, you will get tax benefit. On the call premium, you will get anything related to old bond. Anything related to old bond. Tax benefit on write-off of unamortized flotation cost or discount of old bond. Issue value of new bond is an inflow. Overlapping interest is on old bond. Tax benefit. Anything related to old bond, please write it off on day zero. Then comes the in-between flow. Then comes the in-between flow. Old continues, new separate analysis. First, you will pay interest face value into interest rate. Tax on interest is a saving. Tax on flotation cost is a saving. Tax on discount is a saving. And net you get net cash flow. Net you get net cash flow. Old bond will have a higher outflow. New bond will have a lower outflow, and that's the saving. That's the saving. And it got repeated, I think, step 2. Then your step 3 is terminal flow. What is terminal flow? Is redemption value of new bond, redemption value of old bond if it had continued. Redemption value of old bond if it had continued. Just an example. Bond was issued 5 years ago. Bond was issued 5 years ago with a flotation cost of how much? 30 lakh. It has a balance life of. So what is the overall life of this bond? 30 years. Tax rate is 30%. Bond is to be replaced with new bond. What will be the tax benefit on flotation cost? Flotation cost is 30 lakh for 30 years. In this 5 years, you have already written off. In this 5 years, you have already written off. Leftover is how much? 25 years, which is 25 lakh. On that 25 lakh, immediate 30% tax benefit. Immediate 30% tax benefit. Face value of bond is 200. Call premium. What is call premium? Is when you recall a bond before its life, you need to pay something extra. That is called prepayment penalty. Any call premium paid, immediate tax benefit. Any call premium paid, immediate tax benefit because it is related to old bond. How much extra we are paying? Which is 20 lakh rupees. On this 20 lakh, immediate 20% tax benefit. Immediate 20% tax benefit. A company is making a new issue of equity shares of the, okay, this is to calculate the entire bond refunding. I'll do the calculation later on. And the last part is discount rate. If problem gives you after tax cost of debt, please take it. After tax cost of debt. If it is silent, it is after tax cost of your new borrowing. After tax cost of your new borrowing. Why new borrowing? Because that is what you are doing today. That is what you are doing today. Clear? Any doubts on this? So there are two things. One is replacement, where old and new have to be analyzed together. Another example is only refunding. Only refunding, where I have one example. I'll show that later on. come to 95, where I'll be able to touch upon that concept which I was talking about, that is volatility and change in YTM. Go through 95. Go through 95. Okay, some part of it we'll do it together, some part of it will be in listen mode. Let's see what is the requirement first. They want us to calculate the NAV calculations, value of all assets minus value of all liability. Coming to value of all assets, I have four assets whose purchase price is given in the question and duration is given in the question. Whose purchase price is given and duration is given in the question. This is a annual bond, this is a half yearly bond, this is a half yearly bond, this is an annual bond. Two bonds are annual in nature, two bonds are half yearly in nature. First thing, I need to check whether this duration is in years or in half years. If clarity is not there, I assume this is in years. Now question says all securities were purchased when YTM was how much? 10%. On NAV date, the yield has increased by 75. If yield increases, price will decrease. So we need to use the concept of volatility. 75 basis point is the annual decrease in yield. So with the annual decrease in yield, you can use annual duration. With annual decrease in yield, you can only use annual duration. If this is half yearly decrease, then you can use half yearly duration. This is the annual decrease in yield. Into annual duration divided by 1 plus relevant YTM. I had told earlier that I'll discuss this, why we do divided by half yearly YTM, but the numerator will always be annual duration. So for example, this today value is 1 lakh into 104.78. This will go down. Why will this go down? Because YTM has gone up. The volatility of the first bond is duration divided by 1 plus 10%. But the second bond will be duration divided by 1 plus half yearly YTM. Third will be again duration divided by 1 plus half yearly YTM. Fourth one will be duration divided by 1 plus YTM. Once you get the volatility, you need to multiply that with 0.75. To find out the decrease in price. Let me just focus on bond 1 and bond 2. Let me not focus on the other bonds. First bond, when you bought, the value is 104.78 into 1 lakh. 104.78 into 1 lakh. Now this is going to go down. This is the cost for me. Duration given in the question is how much?
7.3494.
Volatility is whatever duration you had divided by whatever volatility you had. Now duration will also change, volatility will also change, but I don't know. I have no idea on that. Divide by 1.10. Percentage fall in price is equal to annual volatility into annual change in yield. What is the annual change in yield? This will be the percentage fall, and new value will be this into this fall, into whatever the fall is happening. That is 1 crore 4 lakh 78 will go down to 99 lakh 52,952. Second bond, how many bonds did you buy? 50,000 into 100. What is the duration? volatility is divided by 1.05. Volatility is divided by 1.05. I am assuming that these given bonds are annual duration. Looks logical also. 2016 I am in, 2023 is another 7 years. In 7 years, if you tell me 5, it will be 5 years and not 5 half years. It will be 5 years and not 5 half years. If it's 5 half year, I have no problem. But then you have to multiply with half yearly change in yield. You have to multiply with half yearly change in yield. The consistency is needed in the numerator. The consistency is not needed in the denominator. Denominator is only half yearly YTM or quarterly YTM or annual YTM. Do you denominator, because everywhere we did valuation. If we have a half yearly bond, we have used only half yearly YTM. If you have a half yearly bond, we have used only half yearly YTM. So my denominator is 1.05 again into 0.75, and this is the price. This is the price. So this is one part of the calculation, revised value. Clear? Second part of the calculation is, when are we doing the valuation? 1st July. This bond paid interest on 31st March. April, May, June is an asset for me. April, May, June is a accrued interest, which is an asset for me. This paid when? Sorry, not this year. 31st March. It paid on 31st March. Again, April, May, June is asset. When did this pay? No asset, no accrued interest. Last one paid on 30th June, no accrued interest. So first thing is you have to do accrued interest calculation. Very good problem. Then you get the value of all security. See, numerator for duration will always be duration in terms of years. However, the denominator for a half yearly bond will be half yearly YTM, and a quarterly bond will be quarterly YTM. Reason for that is you multiply this with 0.75, which is the annual change in interest rate, which is the annual change in interest rate. This is what I was trying to explain that time. This is the concept I was trying to explain that time. Any doubts on this? Any doubts on this? Now just I'll give you two numbers. You let me know what is the answer. Duration 12 half years. Duration 12 half years. YTM 10% per year. YTM is 10% per year. Yield change 0.5% per half year. Yield changes 0.5% per half year. What will be the price change? Tell me the percentage change in price. Increase, decrease and all, let's not worry about it. Tell me the percentage change in price. Give me the answer and then I discuss it. How much? No, it's not 9. No. 5 point? Could be right. 5.71 could be right. Listen, duration is, I'll show you both calculation. Half year, annual. Duration is 12, annual is 6 years. Annual is 6 years. Denominator is going to be 1.05, 1.05. Denominator is going to be 1.05. Denominator is going to both places 1.05 only. Whether you do yearly calculation or half yearly calculation. So I get 11.429, 5.7. Yield changes 0.5% for half year, or yield changes 1% for a year. Yield changes 1% for a year. So both give you 5.71. In the end, both will give you 5.71. Only rule is you can either calculate annual volatility or half yearly volatility. I have no problem with any of that. Half yearly volatility will be multiplied with half yearly change in yield. Annual volatility will be multiplied with annual change in yield. Yield changes 0.5% per half year or 1% per year, or 1% per year. If you are using 1, multiply with 5.71, multiply with 5.71, and if you are using 0.5, multiply with 11.429, multiply with 11. Better to do this because this is what we understand normally. Better to do this. That is duration in years, volatility in years, yield change in years. Duration in years, volatility in years, and yield change in years. Any doubts on this? Any doubts on this part? Can we proceed? Can we proceed? Done? Okay, now I come to the concept of forward rate. Let me first quickly discuss in the concept book and then I come here. Okay, now listen. Forward rate will be calculated in the same manner as that of step up or step down discount rate. As that of step up or step down discount rate, which is PVF of year 1 is equal to 1 plus forward rate of year 1. PVF of year 2 is equal to PVF of year 1 divided by 1 plus forward rate of year 2. This is a formula you are going to learn when I do interest rate futures. When I do forward rate agreements, there I explain it. But let me do it without the formula. Without the formula. 1 year interest rate is 10%. 2-year spot interest rate. Understand it as spot interest rate. Okay, the wording is not added there, but 2-year spot interest rate is 12%. What will be the forward rate of year 1 to year 2? How do I get this? PVF of year 1 is equal to 1 divided by 1.10. Tell me 1 divided by 1.10 is how much? PVF of year 2, do 12% 2 times. 0. Okay, if I had told you to use the forward rate concept, PVF of year 2 is equal to PVF of year 1 divided by 1 plus the forward rate of year 2. PVF of year 2 is equal to PVF of year 1 divided by 1 plus the forward rate of year 2. That is 0.797 is equal to 0.909 divided by 1 plus FR2, forward rate of year 2. Can you get me this forward rate? If I had told you to use the forward rate concept, tell me the FR2. 14.05, which is there's a formula. The formula is, if you want to know forward rate from year 1 to 2, future value factor for 2 years divide by future value factor for 1 year. You want to know forward rate to 2 to 3. 2 to 3. Future value factor for year 3 divide by future value factor for year 2. You want to know 3 to 4. Future value factor for year 4 divide by future value factor for year 3. You want to know 2 to 4. You can do 2 to 4 also. Future value factor for year 4 divide by future value factor for year 2. That is a 2-year answer. That is a 2-year answer. You need to discount it, or you need to take a square root and then get to the answer. You need to take a square root and then get to the answer. To cut it short, this is the rule. Now write 1 plus spot rate of year 1 is equal to 1 plus forward rate of year 1. Spot rate of year 1, forward rate of year 1 is same, because this is only for 1 year. This is only for 1 year. 1 plus spot rate of year 2 square. 1 plus spot rate of year 2 square. Year 2 square is equal to 1 plus spot rate of first year multiplied with the forward rate of second year. Multiplied with the forward rate of year 2. 1 plus spot rate of the first year multiplied only with the forward rate of year 2. I expand this. 1 plus spot rate of third year. Spot rate of third year. Power 3. Power 3 is equal to 1 plus spot rate of year 1 into 1 plus forward rate of year 2 into 1 plus forward rate of, in fact it is not 1 plus spot rate of year 1, it is 1 plus forward rate of year 1 into 1 plus forward rate of year 2 into 1 plus forward rate of year 3, because spot rate of year 1 and forward rate of year 1 is same. Spot rate of year 1 and forward rate of year 1. That is, you can multiply 3 forward rates, or you can multiply the spot rate itself for 3 times. Spot rate itself for 3 times. 1 plus spot rate of year 4 power 4 is equal to 1 plus forward rate of year 1, forward rate of year 2, forward rate of year 3, forward rate of year 4. You can use this if interest rates are given. You can use this if interest rates are given. Some question interest rates will not be given, then we will use this logic. PVF logic we will use. We will use the PVF logic to get to this. 6-year spot rate is 7%. 5-year spot rate is 6%. I want the 1 year forward rate 5 years from now. I want the 1 year forward rate 5 years from now. That is year 5 to year 6. I want the rate for year 5 to year 6. Now write FRA forward rate 5 by 6 is equal to, forward rate 5 by 6 is equal to future value factor for 6 year divided by future value factor for 5 year minus 1. Future value factor for 6 year divided by future value factor for 5 year minus 1. You apply the formula, and this is what I was talking about. 1 plus spot rate of year 1 is equal to 1 plus forward rate. 1 plus spot rate of year 2 square is equal to 1 plus spot rate of year 1 into 1 plus forward rate, or you can say 1 plus forward rate of year 1 into 1 plus forward rate of year 2. You can keep interchanging this. You can keep interchanging this. Nature of yield curve. Normal yield curve, long term instrument will be higher than short term instrument. I discussed this in one of the question. Inverted yield curve, long term is lesser and short term is higher, and flat yield curve, both are same. Both are same. Both are same is called flat yield curve. I'll come to the last concept, which is on bond convexity. Again, a concept where you will not be doing solving. I'll only be doing the solving part of it. Let me first explain the bond convexity concept, and an important concept from a practical understanding point of view. Exam, nothing much has got tested. Only once it has come in exam. Okay, I think twice it has come in exam. Let me first explain what is bond convexity. I did this year cash flow, PVF, DCF. Just give me a minute. Okay, we did one problem where 848 came through your discounting, and using the formula you got some 847. There was some difference. That difference can be eliminated if I use bond convexity concept. That difference can be eliminated if I use bond convexity concept. Just to give a number, year cash flow, PVF for 10%, DCF, weight, product. I'm not going to do any discounting. Okay, without discounting, I'm explaining this. Let's assume it's a 4-year bond. It's a 4-year bond. 10 rupees interest, 10 rupees interest, 10 rupees interest, 110. Discounting at 1 divided by 1.1 to get the DCF. I have a detailed video on convexity in my YouTube channel. If you are interested, just go through the detailed video. This is just to quickly discuss the concept. Weight is product year into weight. This is the answer to duration. Now yield went up to 11%. Yield went up to 11%. So price will be 100 minus this. 100 minus this. This is the volatility. 100 minus this percentage. 100 minus this percentage. Yield went up by 1%. So price if yield is 11, and price if yield is 9. If yield is 9. If yield is going up, price will go up, which is 100. This percentage, okay, 100 plus, not this percentage, volatility. Volatility is divided by 1.1. Volatility is divided by 1.1. So 100 this percentage, 100 minus this percentage, 100 this percentage. Got this answer. Then I told no, I don't want to do. I want to do 11% directly here. I want to do 11% directly here. So I do 1.11. When I did 1.1, I got 96.898, which is a difference of some 6 paise. There is a difference. There is a difference of 6 paise. I said no, let me try 9%. Let me try 9%. I tried 9%. I got answer as 103 point some number. Again, there is a difference. If you want to bridge this difference, this can be bridged through convexity adjustment. This difference can be bridged through convexity adjustment. Duration assumes there is a linear relationship. What is linear is price will go up by 3.15%. Price will also go down by 3.15%. In reality, price does not go up or go down by the same percentage. And if you take 2%, then it will say 3 into 2, 6%, whereas it is not a linear relationship. It is not a linear relationship. So how do I measure convexity? Convexity is basically taking one price for an increase, one price for a decrease. Taking one price for a increase, one price for a decrease. The question will tell how much change you have to take. Question will say you start with 10, increase it by 1%, decrease it by 1%, increase it by 2%, decrease it by 2%. So if I increase the price or decrease the yield, increase the yield and decrease the yield, I'll be getting in reality this price. I'll be getting in reality this price. Consider these two, okay? The increase and the decrease, and subtract 2 into your base price. Subtract 2 into your base price. Subtract 2 into your base price. You will have to do the calculation. You will have to do the calculation. One with higher yield, one with lower yield. The actual calculation. The actual calculation needs to be done. You do into 2 into 100. This is the deviation which is happening on the price. This is the deviation which is happening in the price when it went up and when it went down. This is for two price changes. So you have to divide this by 2. To divide this by 2. This is the approximate convexity adjustment. This is the approximate convexity adjustment. What I do with the convexity adjustment is whatever price I got through duration formula, whatever price I got through duration formula, I will add the convexity adjustment. I will add the convexity adjustment irrespective of yield going up or yield going down. Irrespective of yield going up or going down. In volatility, yield going up, you reduce. Yield going down, you increase. Convexity, nothing like that. Irrespective of price going up or price going down, convexity adjustment needs to be added. Calculation, I'll come to it. Just understand the logic. So in both, you have to add 0. What is this doing? This makes my calculation more accurate. This makes my calculation more accurate. Will this lead to 100% accuracy? No, because technically duration is the first derivative. Convexity is the second derivative. There is a third derivative, there is a fourth derivative, there is a fifth derivative, there is a sixth derivative. There is no end to this. Using the differentiation formula, you can keep finding more and more derivatives. So till I do two derivatives, which is duration, convexity, that is duration, volatility, volatility, convexity. If you do these two, your answer will become more accurate. Your answer will become more accurate. For the time being listen mode, I'll tell you when to do formula. Fair value of a bond at 10% YTM is 100. At 9% YTM is 100. What is fair value? Is doing discounting. Doing discounting. And fair value at 11% YTM. Do along with me. 103.89 plus 96.3 minus 2 into 100. Minus 2 into 100. This is the deviation which is happening for two bonds. This is the deviation which is happening for two bonds. Divide that by 2. Divide that by 2 and give me an answer first. 0.09. This is called convexity adjustment. This is called convexity adjustment. This is not convexity. This is called convexity adjustment. How is convexity calculated? Convexity expresses this in percentage. Convexity expresses this in percentage. So what you do is this number which I said will be finally added or subtracted. Will be finally added or subtracted. Then what is convexity adjustment? What is convexity? Sorry, what is convexity? What is convexity? Divide this by the base price. Divide this by the base price. Into two things you have to do. Yield change. Into the yield change. Why you do into the yield change 2 times is when you do convexity adjustment. When you do convexity adjustment, you will again multiply with the yield change 2 times. See, convexity is dividing by these two. Convexity adjustment is again multiplying these two. Convexity adjustment is again multiplying with these two. First you have to divide by price and the yield change twice. Price and yield change twice. Is there any use? Zero utility. Zero utility. But question may ask you to write only the convexity. Question may ask you to write only the convexity. If only convexity is asked, you have to divide by the price and the yield change 2 times. What is the yield change? 10 becoming 11, 10 becoming 9. 10 becoming 11 and 10 becoming 9. We did 2 times analysis. We did 2 times analysis. So yield change you have to do 2 times. And again multiply with the yield change and the price. Again multiply with the yield change and the price. What will you ultimately lead to? Ultimately you will lead to this number when you divide it by 2. Ultimately you will lead to this number when you divide it by 2. Why are we doing this 2? Because question may ask you to calculate convexity. Question may ask you to calculate convexity. I'll show this in a problem. I'll show this in a problem. I'll repeat again. For convexity, price with higher yield, price with lower yield, minus 2 times of base price divided by 2, problem is over. divided by 2, problem is over. That's the convexity adjustment. That is the convexity adjustment. Question may ask you to calculate convexity and then the convexity adjustment. For convexity, divide by the base price and yield change square. For convexity adjustment, whatever you got, multiply with the yield change twice and the price. So first divide and then multiply, you'll get the same number. First divide and then multiply, you'll get the same number. When I asked you, you told me 0.095. This is the final convexity adjustment. This is the final convexity adjustment. First, I'll revise what we did in bond valuation. So multiple aspects have been done in bond valuation. Slightly a heavier topic because of too many concepts being there. Otherwise, it is not that it is a difficult area. Once I cover that, then I quickly discuss the enterprise value and money market instrument. I see around 40-45 minutes of discussion still to be done. So let me come to the bond valuation revision. So we first understood what is the face value. Face value is the value written on the bond of the instrument. The reason for the face values, this will help us in calculating the interest amount. This will help us in calculating the interest amount. Face value into the coupon rate is interest amount. Interest amount is always calculated on face value. There's a yield which is associated with face value or a discount rate. There are different names for it. Yield to maturity, cost of debt, prevailing interest rate, going rate of interest, after tax cost of debt, required rate of return, opportunity cost. So these are different names which you can use for the discount rate which you use. Current yield is interest divided by current market price. Valuation of a bond, if you want to value today, present value of future cash flows discounted at investors required rate of return. You want the value of year 1, value of year 0 into 1 plus the discount rate minus the interest amount of year 1 minus the interest amount of year 1. Year 2 you want year 1 value into 1 plus the cost of debt minus the interest of year 2. Half yearly bond, if a bond is paying half yearly interest, please do half yearly discounting, and if a bond is paying annual interest, please do annual discounting. The MCQ examples will make it clear that whenever you do the revision part. Step up or step down discount rate. Whenever there is a step up or step down discount rate, for calculating PVF, we need to be little cautious. How do I calculate PVF? PVF of year 1 divided by the interest rate. PVF of year 2 is equal to PVF of year 1 divided by 1 plus forward rate of year 2, 1 plus R2. PVF of year 3 is equal to PVF of year 2 plus 1 divided by 1 plus R3. But if they give you spot yield, PVF of year 2 is equal to 1 plus S2 square. PVF of year 3, 1 plus S3 cube. S2 is called spot rate, R2 is called forward rate. That's how we normally write. What discount rate do I use? Discount rate to be used is equal to investors required rate of return. But an organization may decide to charge a higher rate, to give a higher discount to the investor. So in that case, if I'm offering a higher yield, please use the higher yield or the lower yield. Higher yield or the lower yield as the discount rate. Annuity bond is one where the interest as well as principal is paid every year. So the formula is annuity outflow or annual outflow is equal to face value of bond divided by the present value annuity factor. You divide by the present value annuity factor. Broken period bond valuation. What is broken period? Is bond is paying interest on Jan 1 and June 30, but you want the valuation on March 1 or April 1. You will have to go back to the earliest date when the interest was paid. Earliest date when the interest was paid, go back to that, do the valuation and add the accrued interest. Add the accrued interest. Transaction cost. If there is any transaction cost in a question, my yield will be normal yield into 1 minus the transaction cost percentage. 1 minus the transaction cost percentage. I can also calculate how much time does it take for me to recover the transaction cost. Normal yield is equal to 1 year. Transaction cost is equal to question mark. YTM, one is doing the IRR calculation, which is the right approach. Shortcut approach is interest income plus average other income divided by average funds employed. What is average other income? Closing price minus the opening price divided by the balance life, and average is closing plus opening by. Spread of yield from a comparable bond is you calculate the YTM of your bond and then compare it with the comparable bond yield, and the difference is called spread of yield from a comparable bond. Post-tax YTM. In case you want to do post-tax YTM calculation, when you write your cash flows, you should not write the pre-tax cash flows. You should write the post-tax cash flow. That is, interest will have a tax angle and capital gain will be there for the maturity cash flow. Relationship between YTM, coupon rate and bond price. YTM and coupon rate and bond price has an important relationship. What is the relationship? If your bond is quoting at par, if bond is quoting at par, or YTM is equal to coupon rate, bond will quote at par. YTM is greater than interest rate, bond will quote at premium. YTM is lesser than coupon rate. Sorry, coupon rate is equal to YTM, par. Coupon rate is greater, premium. Coupon rate is lesser, at discount. All this is provided there is this happening, calculation is happening and redemption is happening at par. Redemption is happening at par. Any increase or decrease in interest rates given in the question would mean increase or decrease in required yield. Would mean increase or decrease in required yield and no increase or decrease in the bond interest rate. Exception is variable bond. A variable bond is one where the interest rate changes based on the changes in investor expectation. Expected price of a bond, which is not a logical calculation, is equal to intrinsic value of a bond into the beta. Intrinsic value of bond into the beta. If you do YTM from a company point of view, day zero inflow, every year outflow, and when you do your calculation, you'll have to follow an approach opposite of the normal IRR. Opposite of the normal IRR. Current yield is equal to interest divided by current market price, useful for irredeemable bond. Yield and price relationship. Yield and price has an inverse relationship. If yield goes up, price will go down, and if yield go down, price will go up. Realized yield is basically you will assume a reinvestment rate and calculate the maturity cash flow. Do 1 or 2 question on realized YTM at home. Calculate the maturity cash flow. Using the maturity cash flow on today's outflow, you calculate IRR. That is called realized YTM. If intermediate cash flows cannot be reinvested, you will just add the cash flows, write the maturity value, and then do the calculation. If there is no reinvestment rate given in the question, reinvestment rate is equal to cost of capital. Reinvestment rate is equal to cost of capital, and if no data on reinvestment is there, I cannot calculate realized YTM. If my reinvestment rate is equal to IRR, realized YTM equal to normal IRR. If it is greater, realized will be more, and if it is lesser, realized will be less. Duration is basically the weighted average time period taken to recover your initial cash flow. It is the time period at which bond is not exposed to interest rate risk, So you can immunize your portfolio using the concept of duration. Duration is year, cash flow, PV of DCF, weight product, sum of the product column. If you have a perpetual bond, 1 plus Y divided by Y, and zero coupon bond, duration is equal to life. If you are doing a half yearly bond, you will have to do half yearly calculation, and your answer is half yearly bond is in terms of half years. Convert that into years. Finally, you will have to convert that into years. Impact of change in variable. If time to maturity decreases, duration will decrease. If coupon rate increases, duration will decrease. If coupon rate increases, duration will decrease, and YTM increases, duration will decrease. Modified duration or volatility is equal to duration divided by 1 plus YTM. Caution: if you have a half yearly bond, please use the respective YTM, which is the half yearly YTM, and if you have a quarterly bond, use the respective YTM, which is the quarterly YTM. Duration and churning of portfolio. I can churn my portfolio based on duration. How do I churn my portfolio based on duration? If interest rates are likely to go up, invest in low duration bond, low risk. If interest rates are likely to go down, invest in high duration bond, high risk. Volatility and price change. I can use the concept of volatility to find out the percentage change in price. Percentage change in price is equal to price volatility into the percentage change in YTM. One caution you'll have to do here is, if you are using a half yearly bond, you need the annual change in interest rate into the annual duration divided by 1 plus half yearly YTM. Immunization means not getting impacted by the changes in interest rate. Question says investor needs money after so many years. That's the duration I need. Investor needs to fund an outflow. That's the duration I need. How do I do? Weighted average format. We'll use a weighted average format. Bond refunding. There are certain items related to old bond. Whichever is related to old bond, write it off, get the immediate tax benefit. Which is related to new bond, write it off over the life of the bond. In between cash flow is the difference between after tax interest of new bond and after tax interest of old bond, as if the old bond is continuing. Overlapping interest is extra interest paid on old bond. And discount rate is equal to after tax cost of new debt. Forward rates is basically two situations. If cash flows are given, PVF of year 1 is equal to 1 plus forward rate of year 1. PVF of year 2 is equal to PVF of year 1 divided by 1 plus forward rate of year 2. If interest rates are given, use the concept of FRA. What is the FRA? FRA 1 by 2 is equal to future value factor for 2 years divided by future value factor for 1 year minus 1. Relationship between forward rate 1 plus forward rate of year 1 is equal to 1 plus spot rate of year 1. 1 plus spot rate of 2 years power 2 is equal to 1 plus FR1 into 1 plus 1 plus SR1 into 1 plus FR2 or 1 plus FR1 into 1 plus FR2. You can do this relationship. There are 3 types of yield curve. Normal yield curve where long term interest is higher than short term interest. Opposite or inverted yield curve where short term interest is higher than long term yield, and flat yield curve where both are same. Bond convexity is basically used because our duration formula cannot give, duration volatility cannot give us the exact price. So in order to make it more accurate, I use convexity. What is convexity? Price when yield goes up, price when yield goes down, minus 2 into the base price divided by 2. That's the final adjustment. That's the final adjustment. You can do adjustment of V0, which is the base price, and yield change square, and again multiply with V0 and yield change square. This convexity adjustment which you calculate can also be expressed in percentage. How do you express in percentage? Whatever is your convexity adjustment, divide just by the price. What is convexity? That is that convexity adjustment you had, no, we'll have another denominator called V0 and yield change square. Again multiply with V0 and yield change square. Valuation of preference share. If it's a redeemable preference share, year, cash flow, PVF, DCF. If it's irredeemable preference share, use the concept of current yield. What is current yield? Is equal to preference dividend by current market price. Current market price goes to the other side. Valuation of a warrant. What is a warrant? Warrant is something which can get converted into equity share. It's like a X rights valuation. Company has issued a warrant which can be converted into 10 equity share at the rate of what? 50. I can convert this into 10 equity share at the rate of 50. Current market price of a share is how much? 80. So with the warrant I get 30 rupees benefit per share. With the warrant I get 30 rupees benefit per share. So 30 into 10, that's the value of a warrant. This is not discussed when I was discussing the concept. Next is enterprise valuation. Enterprise valuation is a very important concept in the practical world. Every company we want to do valuation, ideally we should do enterprise valuation. What is enterprise valuation? Market value of equity plus the value of debt, deduct the cash and cash equivalents. Logic for deducting cash and cash equivalent is I'm acquiring TCS today. I will pay something to the equity guys, something to the debt guys, and I'll use the cash available in the balance sheet because I now become the owner of the company. So I can use that cash even to pay the debt guys. Or even to pay the equity guys. Because I am the owner of the company now. So if you subtract cash and cash equivalent, why minority interest is also added? Because you need to pay them also. See, this is my outflow. This is my inflow. There are variants of enterprise value. One is called operating enterprise value. In operating enterprise value, remove non-operating assets. And core enterprise value, remove the non-core assets. What is non-operating asset? Investment in associates. What is non-core asset? Bharadwaj Institute has CA classes, CMA classes, CS classes. If we decide one of them is non-core, the value of that business is non-core asset first. Book value of equity 1000, market value of equity 2000. This matters. Market value of equity matters. Reserves and surplus does not matter. Value of debt is how much? 800. Cash and cash equivalent is 400. So 2000 plus 800 minus 400. 2000 plus 800 minus 400. Enterprise value is 40 lakh. Value of debt is 10 lakh. Cash and cash equivalent is 5 lakh. What is the value of equity? Enterprise value is equal to equity plus debt minus cash. Do this and tell me what is the equity. 40 is equal to equity plus 10 minus 5. 35 lakhs. Then there are certain multiples which are used in the practical world based on enterprise value. The most important multiple is EV to sales multiple or EV to EBITDA multiple. How can I use this? Like we have been doing relative valuation. For example, Infosys at 1000, EBITDA 250. So its multiple is 4 times. My multiple is also 4 times 50 into 4. Or I can do enterprise value to sales also. EV to sales multiple of the industry, EV to EBITDA multiple of the industry. If you have both, get answer under both and take a simple average. One concept which is there somewhere in ICA study material, it's just there in some wordings at some place. 1 by EV to EBITDA multiple, ICA has used the word cash return on total investment. They have used the word cash return on total investment. I've not covered in any problem in my classes also, but when I was preparing the concept book, I saw this wording being used. So if at all they ask you what is cash return on total investment, inverse of EBITDA multiple. Logic is very simple. The formula is EV to EBITDA is this formula. Opposite is EBITDA by EV. That is, this is what I get. This is what I give. What I get divided by what I give. What I get divided by what I give. So inverse, 5 times inverse of that is 20%. Inverse of that is 20%. Now comes the money market instrument. Money market instrument is basically market for short-term instrument. Market for short-term instrument. First, I'll discuss all the concepts. I may not do many questions in this. There are anyway only 7-8 questions there. I've shared a video in the group where the detailed video is presented, but still I'll discuss few questions. First is yield of a treasury bill, discount of a treasury bill, yield of a certificate of deposit, yield of a commercial paper. Different names you can use. Very simple formula. What I get back minus what I give divided by what I give into 12 by M into 100. What I get back is called maturity value. What I give is called issue price. Divide by what I give is called issue price into 365 by number of days into 100. We normally do in days calculation. We normally do because it's less than a year. It's less than a year. Current market price of a treasury bill is 95,000. Maturity value is July 20. Face value is 1 lakh. What is the yield of treasury bill? One challenge is I'll have to calculate number of days. I'll have to calculate number of days where we ignore the days we are doing the calculation and consider the balance days. What is the maturity value? If nothing is given, maturity value is equal to face value. Maturity value is equal to face value. 1 lakh minus what? 95,000 divided by 95,000. How many days are there till July 20? 30 days of January, 30 days of April, 31 days of May, 30 days of June, and then July. Calculate all the days.
111
into 100. If it's an MCQ, I'll have no problem because in MCQ, automatically whether to extra 1 day or lesser 1 day, we will consider it. Answer is 17.3%. Answer is 17.3%. Any doubts on this? Using this formula, I can calculate the issue price. Using this formula, I can calculate the issue price. They're saying RBI sold 91 days treasury bill at a yield of how much? 12%. What is the issue price? Same formula. What I get back 100. What I issue X. What I issue X divided by X into 365 by 91 into 100 is equal to 12. If you do into 100, you should write 12. If you don't do into 100, you should write 0.12. Calculate, tell me what is X. Same formula we are using. Number of days calculation only. I cannot do the months calculation here. 100 minus X divided by X into 365 by 91 into 100 is equal to 12. Guys, solve, please, please, please. I know you are tired. I'm also tired. I want you to solve, please. Because if you do this, I need not discuss the detailed question. I know what needs to be discussed then. What answer you got? 08. 97.10 is what is coming in the answer. Because there is a none of the above there also. Because you said this, I got a little confused. Any doubts on this? Clear? Okay. Now we do this into 12 by M, no? Technically, 365 by number of days. Technically, this is wrong. Because if you do 365 by number of days, you're ignoring time value of money. You're ignoring time value of money. So then how can I consider without 365 by number of days? I can do effective yield. For example, you do without 365 by number of days. You get answer as 2%. Okay. You get answer as 2% per 3 months. Let's take it as 3 months. You want to do it for a year. What you will do? 2% into 12 by 3. 2% into 12 by 3. We should not do that. We should do 1 plus R power N minus 1. This is the effective interest formula. 1 plus R power N. In 1 year, you have 4 times 3 months. That 12 by 3 you are doing, no. Instead of doing 12 by 3 multiplier, you have to do 12 by 3 power. You have to do 12 by 3 power. That is called effective interest. That is called effective interest. 1 plus the annual rate. 1 plus the annual rate. Whatever your annual rate. What is annual rate? after doing 12 by 3. Without doing 12 by 3, you will get the normal rate. Without doing 12 by 3, you will get the normal rate, power n minus 1. You want to deposit 10,000 in a bank certificate of deposit. You are considering 3 banks. First bank will give you 5.85 annually. This is the final answer. 5.85 annually. This is the final answer. Second bank gives 5.75 monthly. Can you tell me 1 plus 5.75 divided by 12 is how much? 0.47 percentage. 1 plus 0.4797 percentage, power 12 minus 1. Power 12 minus 1. 1 plus 0.4797 percentage. 0.4797 is 0.004797. 0.00. 1 plus r the whole power n minus 1. You would have learnt this when you would have done compound interest at CA Inter or even in foundation. You would have learnt there. I'm not explaining much of it. Only thing I'm saying, when it's daily, we have to use continuous compounding. I'll discuss that in derivatives. 5.9% and 5.87%. Okay, next is, some question will say that you are raising a commercial paper. When I raise a commercial paper, I have to get 10 lakh from the investor. But question says you cannot use 10 lakh. You cannot use 10 lakh. So you have to pay interest on 10 lakh, but you can use only 9 lakh. You can use only 9 lakh. I have to pay interest on entire 10 lakh, but I can use only 9 lakh because he says put 1 lakh in bank deposit. Put 1 lakh in bank deposit. So indirectly what happens is, if there is a compensating balance, my denominator will go down. My denominator will go down. If denominator goes down, your interest yield goes up. Your interest yield goes up, or your cost of CP will go up. Just to give an example, question will say interest cost will be there, cost of placement will be there, stamp duty will be there. All these are cost. All these are cost which you add them. Amount raised is there. In that they are saying line of credit to be maintained. In that they are saying line of credit to be maintained. Unfortunately, my denominator is going down. Unfortunately, my denominator is going down. Normally, I said what is the formula? Minus issue price and divided by issue price. What I get is not issue price. What I get is not issue price. Bank is not allowing me to take it. Bank is not allowing me to take it. I'll show this when I do a problem. I'll show this part when I do a problem. Let's come to the last part of the chapter, which is on something called as clean price and dirty price. The MCQ examples itself will be sufficient to understand the concept. I'll first discuss the MCQ and then I get into a problem discussion. Only MCQ is sufficient. Problem you can just manage. Listen, every bond, when it's quoted in the market, it is always quoted including of accrued interest. It is always quoted including of accrued interest, which is called clean price. Clean price is equal, which is called dirty price. Dirty price is equal to clean price plus the accrued interest. Clean price plus the accrued interest. Now, what is a repo transaction is? I have invested in shares of TCS. I've invested in, not shares of TCS, bonds of TCS. TCS bond has an interest rate of 10%. TCS bond has an interest rate of 10%. I am in need of lot of money now. I am a bank. I am in need of lot of money now. So what I tell RBI is, can you give me money? RBI is saying you have bonds, no, you sell them. RBI is saying you have bonds, you sell them. I'm telling them, no, those bonds are paying me 10% interest. Today the interest rate is only 5-6%. Why should I sell the bond? Why should I sell the bond? So what I do is, I take the TCS bond and give it to RBI as a loan. Give to RBI as a loan. So I will calculate what is the value of the bond. I'll calculate what is the value of the bond today. Value of the bond today is equal to number of bonds into the dirty price. Number of bonds into the dirty price. I hand over these bonds to RBI. RBI is saying I will give you loan against it. I'll give you loan against, but I'll not give you the full amount. I'll not give you the full amount. I'll subtract 2%, 3%, 5%, 10%, my wish. I'll subtract some percentage and give the money to you. It's not from RBI. Someone else can also give. Bank B can give to Bank A. Bank A can give to Bank B. But why I did this? Because the interest rate on the loan I took, the interest rate on the loan I took is only 5%. The interest rate, the repo loan will come at 5%. The repo loan will come at 5%. I will continue to earn 10% on TCS bond. I'll continue to earn 10% on TCS bond. So understanding is, I am in need of money. I have TCS bond, not TCS, practically government bonds. Practically government bonds. These government bonds give you higher yield. These government bonds give you higher yield. So you are adamant not to sell it, but you are in need of money. You are in need of money. So you give this bond to them as a security. They give you some loan. On this loan, they will charge some interest. On this loan, they'll charge. The amount which they give you is called first leg of the transaction. First leg of the transaction or start proceeds. The amount which you repay is called as the second leg or the repayment. So dirty price is equal to clean price plus accrued interest. Accrued interest in this example will be calculated at 10%. Accrued interest will be calculated at 10% because I said accrued interest is on what? The TCS bond. TCS bond. What I do, I give this to the other party. I give this to the other party. I say, please take this. He does this calculation, values them, and subtracts a margin. Subtracts a margin. He's saying, I'm not giving you full amount. I'm not giving you full amount. I take that, and on that I pay rate of interest as per the repo rate. I pay rate of interest as per the repo rate. I'm going to pay only rate of interest as per the repo rate. Why am I doing this? You'll understand here. Bank A entered into repo transaction at the rate of what? 8%. What is 8%? Bank A will be paying 8% interest. But on which bond? 12% GOI bond. So I had a 12% GOI bond. Why should I sell that? Why should I sell that? Clean price is how much? 95. I need to calculate dirty price. I need to add accrued interest. Accrued interest is at 8% or 12%? 12%. Now write accrued interest is equal to 100 face value into 12% into 240 by 360. 360 days question has mentioned. Question has mentioned 360. Otherwise we take 365. Otherwise we take 365. What is the accrued interest? 8. Add to your clean price. Add to your clean price. That will give you your dirty price. Add to your clean price. I'll again repeat. Accrued interest is on my bond, not on the repo. Not on the repo. What is the use of this? I will take this and then go to the other party. I'll go take this and go to the other party. How do I go? Amount of face value for repo transaction is 4 crores. I have 4 crores worth of RBI bond. I have 4 crores worth of RBI bond. Clean price is how much? 98. Accrued interest is how much? 4. 98 does not matter. 98 does not matter. The price is 102. The price is 102. So I go to them and say 4 crore divide by 100 is the number of bonds. Divide by 100 is the number of bonds. Assuming face value is 100. Assuming face value is 100 into 102 is how much? Into 102 is how much? 4.08 crore. So I am telling them I have 4.08 crore value. Can you give me a loan? He is saying no. I will subtract 5%. I will subtract 5% and then give you the loan. I'll subtract 5% and then give you the loan. How much loan he will give? 3.876. I took the loan. I took the loan. Now I need to repay the loan. I need to repay the loan. The loan repayment will happen based on the repo rate. The loan repayment will happen based on the repo rate. Example, Bank A entered into repo on what? This 12% has nothing to do with the repayment done by me. Repayment done by me, because this 12%, what is the utility? To calculate the clean price and dirty price. To calculate the clean price and the dirty price. Initial proceed, I got a loan of 7 crore 95 lakh 20,000. On this, you should pay 5% interest for 14 days. On this, you should pay 5% interest for 14 days. 5% interest for 14 days, which is 152, and repay 796. Repay 796. There is one, the original rate. Why I am not selling it? Because the interest rate on that is higher. The interest rate on that is higher. I don't want to sell it. Why should I sell it when I am getting higher interest rate? But I am in need of money. So I give you this as a security and take a loan. Take a loan.